So I believe we are live. Let me check the audio video once. Am I audible to you properly? Am I audible to you properly? Can you all hear my audio video properly? Please let me know. Yes, sir, audible. Okay. So, hello everybody, and welcome to the CA Final Direct Taxes and International Taxations English International Taxation Marathon. I welcome you all to this very beautiful session. Sir, what is this session all about? How we are going to produce, or what material we have to use? Everything will be discussed in a minute or two. You just have to be patient today. You just have to sit back and listen and try to cooperate with everything that I ask you. So simple. Sir, we got you. We got you. Absolutely, we got you. So first of all, this session will be in complete English session. Complete English. I will try not to use even a single word of Hindi. Okay. So if you don't understand Hindi, this marathon is absolutely for you. If you understand even a bit of Hindi now, then I had already taken international taxation marathon in Hindi. You can refer that. So this marathon is only for those students who doesn't understand Hindi even a bit. Second thing, sir, what is this? For whom this marathon is applicable? First of all, sir, if you are aiming for second round of revision, or sir, you are referring it last day. So it is optimum for both of them. It is optimum for both the people who are aiming second round of revision, or if you are referring this last day, in both the cases it is applicable to you. Sir, okay, sir, we got it. Sir, what is the coverage that we are going to do? Sir, we are going to cover entire international taxation right away from non-resident taxation, transfer pricing, double taxation avoidance agreement, advanced ruling, equalization levy, base erosion profit shifting, model tax conventions, tax treaties, and latest developments in international taxation. All in all, sir, 9 chapters we are going to cover in least possible time. Sir, but we don't have your material. How can we get it? Or sir, is our material okay? See, whatever book you are referring, whatever book of any faculty you are referring, sir, I have no issue whatsoever. See, income tax remains the same. You can refer any material of any faculty, sir. I have no issue with that. It's absolutely fine to me. Whatever the income taxes will be same in my book also will be same in your books also. So you need not to refer any other material. Whatever material you have, it's okay. But sir, some questions I will be referring in this session. Those questions, PDF, that super 100 questions PDF has been already shared by me in my Telegram channel. Just have a PDF of that along with, so that whenever I am referring to certain questions, it is easier for you all to refer all those questions and solve questions along with me. Sir, we got that point absolutely clearly. We got that point absolutely clearly. Sir, also, will you be taking the other marathons also? Right answer is yes, sir. This is first marathon in the series which covers international taxation. Tomorrow, that is the next session, we will be having for small topic marathon, whereby we will be having nearly 10 chapters covered in that marathon also. What will be those, sir? First of all, it will be, sir, for example, we have miscellaneous provisions, we have tax audit, we have black money law, we have appeals, we have DRC, we have GAR, we have clubbing, we have set off, sir, we have ICDS. So these are small topics that are being ignored by everybody. So we will have tomorrow Tomorrow we will have another marathon on these small topics, and that will be also entirely in English. So, sir, most of your DT will be sorted with these marathons. If you all cooperate, sir, we will have another marathon that will be covering entire remaining portion. So with that, now entire DT will be completed for last day before examination. With that, we are going to start. First of all, a very, very, very good morning to all of you, and a humble request, just like down the video, do comment down how you are doing. Sir, good morning. We have with us Shubham, we have with us Shravani, we have Hidayatullah, we have Navi, we have many people joining. Do not forget to press the like button. If you have not yet subscribed to the channel, do subscribe to the channel also. Okay, sir. Okay, sir. Okay, sir. We got your point. We got your point. Sir, first of all, we have to start with non-resident taxation. Non-resident taxation, sir, three steps to be followed. First of all, we have to identify the non-resident. Sir, we have to identify his Indian income, and then later on we have to tax it. So for that matter, first topic that will come our way is residential status. We have to find whether the person is resident or whether the person is non-resident. Sir, once the person is being identified as non-resident, sir, whatever Indian income that he's earning shall be taxed. And at what rate it will be taxed, that will be discussed in the third part of the topic. So for that matter, we have a residential status. So residential status is not the area that is going to be asked in exam. At least for individual, it is not going to be asked because it is a topic from C intermediate. So sir, let's cover it quickly. Sir, how residential status of individual is taken out. Sir, understand whenever we study residential status, now it is considered for every year. For a previous year, one may be resident. For the next year, he may become non-resident. Again, for the third year, he may become resident. So residential status changes every year. Sir, how individual is assessed, how individual is found his residential status. For that matter, sir, we have to check for section 6(1) two of the basic condition. Sir, one basic condition says if any individual stays in India for 182 days or more in previous year, he shall become resident. Or his stay in India for previous year 24-25 was 60 days or more, and sir, his stay in India was 365 days or more in preceding 4 previous year. Sir, if any of the basic condition is satisfied, he shall become a resident of India. Okay, sir, we got this point. Sir, there are three instances. There are three instances in which the second condition, 60-365 days condition, is not to be checked. What are those instances? So first of all, if any of the person leaves India for employment outside India, for example, I got a job in Google and I go outside, so second condition not to be checked. Second case, sir, if I am crew member of Indian ship, sir, if for example, I go on a ship and that ship is Indian ship. So in that situation, sir, my second condition will not be checked. If I satisfy the first condition, I shall become resident. If I fail to fulfill first condition, I will become non-resident. So third question. So third case, if we are Indian citizen or person of Indian origin, sir, visiting India, and our total Indian income is up to 15 lakh rupees. In these three cases, sir, we don't have to check for the second condition. If we satisfy the first condition, sir, we shall become resident. If we fail first condition, sir, we will become non-resident. Sir, we got it. Absolutely, we got it. In all the three cases, sir, whatever the day you enter the India, sir, that day shall be considered as stay in India also. The day on which you go out of India, that day will also be considered as stay in India. Sir, we got this point. Sir, once you become a resident of India, you have to check for section 6 subsection 6, sir, additional conditions. There are two conditions mentioned, sir. If you satisfy either of them, or if you satisfy none of them, sir, you shall become resident, not ordinary resident. If you satisfy both of them, sir, you will become resident, ordinary resident. Sir, what the additional conditions are? Such additional conditions are, sir, stay in India for at least 730 days or more in preceding 7 previous year. So prior to previous year 24-25, sir, preceding 7 previous years, sir, your stay should be more than or equal to 730 days. And sir, you should be resident of India for at least 2 years. At least 2 years out of last 10 previous years. Sir, previous year prior to 24-25, you must be resident of India for at least 2 years. Sir, if you satisfy both the conditions, you shall become resident, ordinary resident. If you fail any of them, or if you fail both of them, in that case, you will become resident, not ordinary resident. Sir, with this, you will be able to identify whether you are resident person or you are non-resident person. So you will be able to identify. Sir, but there is a catch. Sir, we right now studied that if you are Indian citizen or if you are person of Indian origin, plus visiting India, and your total Indian income is to 15 lakh rupees. In that case, you are not supposed to check the second condition, 60 to 65 days. You just have to check the first condition. Correct? That is what we studied. Sir, but what if your sir total income increases, total Indian income increases by 15 lakh? Then what to do? In that case, sir, you have to check the second condition. You have to check the second condition, but sir, in the second condition, you don't have to check the 60 days. You have to make this 120 days, and you have to check 120 in previous year and 365 days in preceding 4 previous years. And sir, the most important thing, if you become a resident because of the second condition, sir, you don't have to check additional conditions. Sir, you will become resident, not ordinary resident by default. Sir, am I clear on this point? Sir, if you become resident because of the second condition, sir, you shall become resident, not ordinary resident by default. Sir, you don't have to check additional conditions. Sir, if you become a resident based on first condition, sir, you have to check for additional condition. You might become ROR, you might become RNOR, but if you satisfy the second condition, you by default will become RNOR. Sir, we got this point, sir. We got this point. Also, there is a concept for deemed resident. What this implies, sir, if you are a person who is Indian citizen or person of Indian origin, sir, who visits India, who is non-resident everywhere, who is non-resident of India, who is non-resident in Dubai, who is non-resident of every country. Sir, he is not a resident of anywhere. Sir, for that matter, sir, if his total income, Indian income exceeds 15 lakh rupees, then sir, he shall become a resident of India and he shall be considered as RNOR. Sir, are we clear on this front? Are we clear on this front, sir? If a person is resident, if a person is citizen of India or person of Indian origin, he is not a resident of any country. In that case, he shall become a resident of India. So if his total Indian income exceeds 15 lakh rupees, and he by default he shall become RNOR. So this concept is called deemed resident. Sir, who is called Indian citizen? Who has nationality of India? Who is called person of Indian origin? Any person whose parents were born or whose grandparents were born in undivided India shall be considered as Indian or person of Indian origin. Sir, if you have any doubt, just drop me in the comment section. If you don't have any doubt, just drop clear so that we can proceed further. With that, we understood how to find out the residential status of an individual. Moving forward, sir, we have residential status for HUF. How HUF is being assessed for residential status. Sir, HUF, for that HUF, we have to check how affairs of HUF are being considered. If affairs of HUF are being considered or managed outside India, wholly outside India, then such HUF is considered as non-resident only. But sir, if affairs of HUF are being controlled wholly or partly from India, either from India or wholly from India, in that case, sir, HUF shall become resident. Good morning, Kanika. Wholly and partly from India, then such HUF shall become resident of India. Sir, once HUF becomes resident, sir, you have to check for additional conditions. Sir, if Karta of HUF satisfies the additional conditions referred under section 6, subsection 6, then HUF shall become ROR. If Karta fails any of the condition, if Karta fails both the conditions, sir, HUF shall become RNOR. Sir, HUF is very simple. It is very unlikely for you to see this question in exam. Examiner has too much of points to cover from this chapter. So asking residential status of a topic that has already been covered in CA intermediate is very less likely to happen. So if you are looking for a firm, if you are looking for residential status for a AOP, local authority AJP, you just have to check whether affairs of such entity are being wholly managed outside India, then it shall become non-resident. If it is partly or wholly managed from India, it shall become a resident. So there is no concept of ROR, RNOR in these cases. So you just have to check whether its affairs are managed from India, it is resident. If outside India wholly, then in case it is non-resident. Sir, important segment might be possibility. This is a topic which might be asked in exams. Sir, very less chances even from this topic also, but this just still has certain chances. Individual, no chance. Sir, but company might be asked. Sir, how residential status of a company is identified. First of all, sir, identify whether the company is incorporated in India or sir, company is registered in India. If either of the condition is fulfilled, incorporated or registered in India, sir, by default it shall become resident of India. By default it shall become resident of India. But sir, if company is neither incorporated nor registered in India, in that case, sir, you have to check for POEM. Sir, if POEM is in India, then company shall become resident. If POEM is outside India, then company shall become non-resident. Sir, what the poem implies? Sir, poem implies place of effective management where key managerial decisions are taken for the conduct of the business. Sir, for the conduct of the business, key managerial decisions. Sir, who takes the key managerial decision? Where such key managerial decisions are taken, sir, that place becomes poem. You have to identify where the place of effective management is. If it is in India, it shall become resident of India. If it is outside India, it shall become non-resident. Sir, how poem is identified? First of all, sir, all of you, please do a pinky promise to me. Pinky promise to me that you will not look for a company whose turnover is less than 50 crore. Only if turnover exceeds 50 crore, you have to check for poem. Otherwise, sir, you don't have to check for poem because it is only applicable for the companies having turnover exceeding 50 crore Indian rupees. Okay. How a poem is identified, sir? For identifying poem, we have two steps. First of all is the ABOI company test, and second one is other company test. Sir, how and what ABOI test means and how and what other company tests imply. Sir, if a company fulfills all the five conditions, if a company fulfills all the five conditions, then such company is said to have active business outside India, and such company shall become non-resident. Sir, repeat after me. Company fulfills all five conditions, sir, then that such company shall become non-resident. Such company shall be said to have active business outside India. Sir, what are those five conditions? First condition, sir, passive income is up to 50% of total income. Passive income is up to 50% of total income. Sir, assets located in India are less than 50% of the total assets. Sir, employees resident of India are less than 50% of the total employees. And payroll cost on the Indian employees is less than 50% of the total payroll cost. Plus, sir, majority of the board meetings happen outside India. If all the five conditions are met, then such company is said to have active business outside India. Such company is said to have active business outside India. Sir, I request you to just speak it out. I just want you to speak it out, sir. Without speaking, it is very less likely that you will. It is very likely that you will forget this. So try speaking out. If passive income of a company, if passive income of a company is up to 50% of the total income, assets in India are less than 50%. If employees in India are less than 50% of the total employees, payroll costs of Indian employees are less than 50%, and majority of the board meeting take place outside India, then such company shall be considered to have active business outside India. Such company shall become non-resident. Sir, during this process, sir, you will find certain difficulties. Sir, what difficulties you will find? Sir, what is meant by passive income? Sir, five kinds of incomes are called passive incomes. First of all, sir, any kind of interest income, any kind of dividend income, any kind of royalty income, any kind of capital gain income, or any kind of income in which purchases and sales both are being done to associate enterprise. You bought goods from associates, you are selling goods to associates. If you are doing both things with the associates, then such income is called passive income only. So five, so interest, dividend, royalty, capital gain, and sir, transaction in which purchases and sales both are being made to associate enterprises. Such transactions are called passive income. Sir, total assets. Sir, for total assets, you might have to check depreciable assets. Sir, for depreciable assets, you have to check opening and closing WTV divided by 2. Other assets, sir, take as per books of accounts. Sir, employees, sir, every employee that has been employed in your work, at your place, it can be contract employee, it can be part-time employee, take every detail. Sir, payroll expenditure, sir, whatever employee cost you are incurring on your employees, sir, it can be any kind of social benefit expenditure, it can be wages, it can be bonus, it can be commission, whatever employee benefit expense you are incurring, sir, that shall be considered for poem determination. Sir, I hope it is clear. Sir, many times certain companies try to use aggressive tax planning to avoid poem. Sir, in that case, sir, provisions of GAR will apply. Sir, provisions of GAR will apply. Sir, if you are given multiple year data, then just do average of all the 3 years. If you are given 3 years data, then you just have to do average of all the 3 years to find out the optimum poem. Sir, please repeat after me. Please repeat after me, sir. 5 conditions to be fulfilled. Passive income up to 50% of the total income. Assets in India less than 50%. Employees in India less than 50% of the total employees. Employee costs in India less than 50% of the total employee costs. And majority of the board meeting take place outside India. All the 5 conditions to be satisfied. Then in that case, OM shall be outside India. Company shall become non-resident. Company shall be assumed to have active business outside India. Are we clear on this front? Just tell me, sir, are we clear on this front, or do you have any doubt on this topic? If you have any doubt, please let me know. Otherwise, we can proceed forward. Just give me a minute, huh? Oh my God, I think I made a small mistake. I think I made a small mistake. I think I made a small mistake. Okay. I think I made a small mistake. See, I started off the small topic marathon link. Oh my God, sir. Is it now? I think I made a small mistake. Yes, sir. Okay, sir. How do I get that corrected? Just give me a second. Just give me a second, please. Just give me a second. Sorry, really sorry, really sorry. Huh? Okay. Perfect, perfect, perfect. I really sorry. I'm really sorry for the inconvenience caused. No issue, sir. No issue, sir. No issue. We got your point. Sir, once a company fulfills the ABOI test, it is assumed to become non-resident. Once a company fulfills the ABOI test, it shall be assumed to be a non-resident company. Sir, we got this point absolutely clear. Sir, even if ABOI test is fulfilled, company becomes non-resident. Sir, we have to check for other company test. We have to check for other company tests. Sir, we have to check for other company tests. Sir, how other company tests is being checked? Sir, for that matter, we have to check, we have to identify the person who makes the key decision making. For example, if board of director take this decision, sir, identify who in the board of director take this decision. If board of director take decision, so from which place such directors take decision, so that is what constitute the poem. Sir, you have to identify the key decision makers and you have to identify the place from which they are making the decision. Okay, sir, we got this point. Sir, if board is not exercising its power, sir, if board is not exercising power, sir, board has given this power of decision making to some other authorities. Provision says check the places of such other authorities and you will have to find out the poem of that places. Sir, we got this point. We got this point. Sir, many of the times what happens is board of director give the powers to certain executive committees. Sir, you have to check the place of executive committee. If board of director has given power to senior management, sir, check the place of senior management. Sir, if board of director has given this power to any of the via circular resolution, sir, you have to check from which place actually in fact the decisions are being made. Sir, a board constitute, sir, via remote means, sir, you have to take the place on which the senior manager, the most senior management takes place. Sir, wherever the most senior management is sitting, you just have to take the poem of that place. So if board has left over certain decisions, if board have left certain decisions on shareholders, so remember that is always irrelevant for determining the poem. Any of the decision that have been taken by the shareholder is irrelevant for determining the poem. So you have to remember this point clearly. So if any of the decision making that has been left on the shareholders, so that is irrelevant for poem determination. So it may happen sometimes that company is located in India and 100% subsidiary is located in USA. So just because 100% shares are being held by the Indian company will not make such foreign company as a resident. So just because 100% shares are being held by this Indian company, so this will not make such foreign company resident of India. For a company to be resident in India, it has to either fulfill ABOI test or it has to fulfill the other company test. So are we clear on this front? Are we clear on this front? Sometimes what happens is, sir, board of directors outsource a certain payroll work, accounting work, HR work, IT network work, supply chain work, routine banking operations work. So this would not imply that poem has been shifted to India. Only outsourcing certain mechanical works, this would not constitute poem shifted to India, sir. Only outsourcing the mechanical IT work, payroll work, this would not mean that poem has been shifted to India. Any person having any doubt? With that, sir, we are able to complete the entire residential status. After understanding this residential status, sir, you are in that state of position. You are in that state of position to identify whether a person is a resident of India or person not resident of India. Anybody having any doubt at this point or up to this point, anybody having any doubt? Just give me another minute. Sir, no doubt whatsoever. No doubt whatsoever, sir. Now, once a non-resident has been identified, you have to check for his Indian income. You have to check for his Indian income. Only Indian income of a non-resident can be taxed in India. Only Indian income of a non-resident can be taxed in India. Sir, it is important to identify what is Indian income. And with Indian income, I mean any income which fulfills any of the three conditions, it shall become Indian income. First of all, sir, if any income that is received in India, for example, any income received in bank account of India, sir, I am giving any money to Shravani, it is Indian income for her. If I am transferring any money in the bank account of a Shravani might be having bank account in India, so that income shall be Indian income. So any income that is any money that is received in India, it is Indian income only. It is assumed to be received in India, so it shall become Indian income only. Second thing, so any income that is deemed to be received in India. So this is less asked topic. So less asked topic. Section 7 talks about the income which is deemed received in India. See, sometimes what happens is that you contribute to your pension fund. You contribute to your pension fund while you are in employment, but you receive that pension fund when you are at retirement, when you are retired. You might be receiving it in United States. You might be receiving it in Dubai. You might be staying outside India after you retire now. So wherever it is received, it is assumed to be received in India. Sir, if you receive any kind of money on account of unrecognized provident fund, sir, wherever it is received, it is assumed to be deemed received in India. Sir, if your employer is contributing exceeding 12% to your recognized provident fund, if your employer is contributing exceeding 12% to your recognized provident fund, provision says, sir, such contribution exceeding 12% wherever received shall become deemed received in India, and whatever the interest that you received on such provident fund exceeding 9.5% shall be deemed to be received in India. So all these 4 points shall be considered as deemed received in India. Deemed received in India. Sir, you don't have to learn these points because very less likely to be asked in exam. Very less likely to be asked in exam. So we are very much clear on that. Sir, this means we understood what is meant by income received in India. we understood what is meant by income deemed to be received in India. So now we have to understand, sir, what is meant by income accruing or income deemed to be accruing arising in India. Income accruing, income deemed to be accruing arising and in India. Sir, what does that mean? Sir, for that we have section number 9. For that matter, we have section number 9, and section 9 clearly states, if any of the non-resident does business in India, comes, set up a branch, set up a office, set up a sales outlet, so in that case, sir, it is assumed to be business in India, and that business in India is always Indian income. That business in India is always Indian income. But sir, there are many foreign people who do business with India, and doing business with India never constitute Indian income. Normally, if somebody is doing with India, that means, for example, person sitting in United States are exporting goods to India. This may not constitute Indian income. Indian income. But sir, there are many poor, many very bad non-residents. There are many very bad non-residents. Sir, they stay in United States. They stay in any of the country outside India. Sir, they hire a dependent agent in India. It may appear that they don't have any of the business in India, sir, but ultimately, sir, they are doing business in India via this agent. They will show that they are doing business with India, but in fact, they are doing business in India. Sir, for that matter, provision says if any of the non-resident has an agent in India who conclude contracts on behalf of this non-resident, if they have any agent who habitually maintains a stock for this non-resident, or sir, if such agent, sir, secures order wholly and mainly for this non-resident, so this non-resident shall be deemed to have business connection in India. And such business connection, whatever the income arises from such business connection, shall become taxable in India. Sir, are we clear on this front? If the things are clear, do write clear, so that it brings confidence in me that whatever I am saying, you are able to accept that. Sir, if non-resident having any agent in India, and such agent does conclude contract in India on behalf of such non-resident, such agent maintains a stock on behalf of non-resident, such agent, sir, habitually secures order mainly for such non-resident, such agent is deemed to have, such non-resident is deemed to have business connection in India, and sir, whatever income arises from that agent shall become Indian income. Sir, we are clear on this front. We are absolutely clear on this front. Sir, remember, sir, what if this agent works for other people also? For example, instead of just working for non-resident, so this agent is working for other non-resident also. For multiple non-resident, he might be working now. So in that case, sir, this agent may not be a dependent agent. Sir, he shall become independent agent, and this independent agent would not constitute business connection. This independent agent would not constitute business connection. Only a dependent agent, solely dependent agent for this non-resident shall become business connection. Sir, this independent agent will not constitute business connection. Sir, we are clear on that front. Sir, many a times what happens is, sir, if there is a foreign company who does not have any branch in India nor any office in India, sir, nothing in India, nothing, sir, nothing, bilkul nothing, sir, but it has online presence in India. It has many downloads. Sir, if it has more than 3 lakhs downloads in India, or sir, if it has more than 3 lakhs downloads users in India, sir, or it collects more than 2 crore worth gross receipts from India. In that case, such foreign company, despite not doing business in India, sir, shall deemed to have a significant economic presence in India. If any of the foreign companies, sir, for example, Spotify does not have any of the offices in India. It shows that it does not do any business in India, but sir, ultimately it is collecting money from Indian people. It is having 3 lakh or more, sir, users downloading its app. So it is assumed that this Spotify would have business connection in India via significant economic presence. Business connection via significant economic presence. Provision says, whatever the income this Spotify earns from showing advertisement to Indian resident, if any of the ad is being shown to Indian resident person, or any of the IP address user of India, if anybody outside India uses the IP address of India, if any advertisement is shown to them provision says whatever the income is being earned to this Spotify on account of showing ads to the Indian residents, sir, shall become Indian income for this Spotify. That shall be taxable in India. Second thing, sir, if Spotify collects the data of resident person, collects the data of any person who uses the IP address of India, sir, collects the data of these two people, provision says, and sells it and sells this data to somebody else. For example, Tinder. For example, this data is being sold to Tinder. So whatever the income on account of sale of data collected from person resident of India or person using IP address of India shall become Indian income. Sir, for example, I was saying I was very happy in my life. But all of a sudden I struck from a breakup. I happened to have a breakup. And because of which my singing, listening pattern in Spotify changed. Earlier I used to listen Taylor Swift, but now I have to listen Jagjit Singh, I have to listen Arijit Singh, I have to listen to these songs. And all of a sudden, Spotify got to know about my breakup. So it sold my data to Tinder. Provision says whatever the sale of data income that Spotify is earning, sir, that shall become Indian income. Sir, further, if Tinder sells me its subscription, further, Tinder sells me its subscription, sir, that further sale made from the data sale shall also become Indian income. Sir, what I am saying is just listen to this carefully. So if residents' data is being sold by this non-resident, so this shall become Indian income. If on the basis of this data sale, any subsequent sale is being made to the Indian, subsequent sale is being made to this Indian resident, sir, such sale shall also become Indian income. So, for example, if my data is being sold by the Tinder, sorry, by the Spotify, that shall become Indian income. So, if further sale is being made, further sale is being made to me. For example, Tinder sells its subscription to me based on the data given by the Spotify. The provision says that shall also constitute Indian income. That shall also constitute Indian income. I hope you got the point. Sir, sir, if you are doing, if any of the company has significant economic presence, whether there is agreement or not, sir, it is not relevant. If such company has no fixed place of business, sir, we don't have any issue. Sir, if does not have residence in India, sir, we don't care. Sir, whatever the things are, we don't care. Simply, sir, such income shall be taxable in India. Such income shall be taxable in India. Sir, business advertisement related income, data sale related income, and further sale of goods and services related from their data shall also become Indian income. Sir, there are four transactions which are not considered as business connection. There are four transactions which are not considered as business connections. Sir, what are those four transactions? Sir, first of all, if any of the news collecting agent comes to India, for example, we have a news channel in Middle East called Al Jazeera. If you have heard of that name, we have certain news collection agencies. We have news company called Al Jazeera. Many of the reporters come to India, they collect news. Sir, can government of India say that you are collecting news from India, you have an agent in India, income will become Indian income? The answer is no. News collection is said free. If any of the person comes India for collection of news, it is India, it is not Indian income. Sir, no business connection is established. Second thing, if some of the non-resident, non-citizen shoot movie in India, can government say that you are shooting movie in India, so your movie will become Indian income? Any income from movie will become Indian income? The answer is no, no. So any shooting of films by non-resident, non-citizen crew, sir, shall not constitute business connection. Sir, any of the purchase of goods for export. Sir, for example, if any non-resident has any agent in India who helps exporting goods, not for importing, but helps in exporting goods. Sir, because of which this non-resident might have certain profits in India because he might have purchased from outside. It would have costed him more, but he's purchasing from India through that agent. So he's buying things at a lower price. For that matter, he might have certain profits. Provision says it shall not constitute any business connection at last. So very important, sir, very important point for examination. So this might be asked in exam. So if any foreign company comes to India in special notified zones for display of uncut, unassorted, and unpolished diamonds. A foreign company comes to India, special notified zones for display of uncut, unassorted diamonds in special notified zones, so that shall not constitute business connection. But sir, remember we have an amendment. If foreign company comes to India in special notified zones for uncut, unassorted diamond, not display but sale, sir, safe harbor rules are applicable. Sir, we will discuss the safe harbor rules and transfer pricing. Sir, we must remember, sir, any foreign company coming to India for uncut, unassorted diamonds display in special notified zone shall not constitute business connection. Sir, yes, sir, we got that point. This was the first income that is not taxable in the hand, that is taxable in the hands of non-resident, or that shall become Indian income. Second kind of income that shall always become Indian income is, sir, if any of the asset is located in India. Sir, for example, we have Miss Rachel. Miss Rachel. Miss Rachel has a flat in Coimbatore, or I should say Chennai. Miss Rachel has flat in Chennai and she is earning rent from this flat. This flat is located in India now. Provision says if flat is located in India, then whatever income arises from such assets shall become Indian income only. Okay, sir, we are absolutely clear on that front. We are absolutely clear on that front. Third thing, sir, very important. For example, Miss Rachel has a flat in Chennai. And sir, Rachel sells this flat to Mr. Ross. Rachel sells this flat to Mr. Ross. Provision says if any of the non-resident sells any asset to another non-resident, but sir, if such asset is located in India, then provision says such asset, such capital gain arising shall become Indian income. It is very simple now. If asset is located in India, then whatever income is arising on account of that asset, that shall become Indian income only. Sir, we got your point. We got your point, sir. We got your point. We got your point, sir. Absolutely clear. Sir, another thing we have, sir, for that matter, I need 5 minutes of your entire 5 minutes of your undivided attention. Sir, for example, there is a company called Hutchison SR. Hutchison SR, okay? Hutchison SR is an Indian company. This company is held by a parent company called CGP Mauritius. Sir, 67% of the 67% of this Hutchison SR are being held by the CGP Mauritius. 100% of the CGP Mauritius are being held by HTIL. Okay. And we have a Vodafone. Now, Vodafone wants to buy this Hutchison SR. Vodafone wants to buy this Hutchison SR. If they would buy from India, then capital gain would arise in the hands of CGP. Capital gain in India would arise in the hands of CGP. So instead of buying the shares of Indian company, Vodafone India rather bought CGP in itself. Sir, seller is HTIL, buyer is non-resident Vodafone. Asset transferred outside India. Asset transferred is also outside India. Provision says normally this shall not become taxable in India, but there is a provision for indirect transfer. What provision says if any of the foreign company which is outside India, so such foreign company shall be deemed to be situated in India. This foreign company will be deemed to be situated in India if such foreign company derives substantial value from the assets located in India. If this foreign company derives its value from Indian assets only, then why to consider it outside? Sir, we'll consider this company to be located in India only. If any of the foreign company deriving substantial value from asset located in India shall be considered as Indian asset only, any gain arising from such transfer shall become Indian income. Sir, we got this point to the fullest. We got this point to the fullest. Sir, only one doubt we have. Sir, why are we not liking the video? Why are we not liking the video? If you have not liked it, shame on you. Do like the video first and then continue. Or yeah, it takes real hard work to speak for this long. So don't I expect this much? Sir, we got it. Sir, what I was saying. Sir, this CGP shall become Indian assets. This CGP shall become Indian assets, sir, if it derives substantial value from asset located in India. Sir, keep everything aside. What I'm asking you to do is, sir, follow 3 steps. Follow just the 3 steps. If you fulfill any of the 3 steps, sir, if you fulfill all the 3 steps, sir, you shall become a resident of India. Okay. Sir, first of all, you have to check the valuation date. Sir, you have to check now substantial value deriving or not. You have to check now whether foreign company derives substantial value or not. Sir, on what date you are supposed to check, that is what the most important thing is. Sir, we have normally 2 kinds of date. Sir, we can have either balance sheet date or we can have date of transfer. First of all, we need to find out the valuation date. Sir, for finding out the valuation date, we have 2 dates, sir. We have balance sheet date and we have date of transfer. Either of 2 has to be valuation date. Okay, sir. Sir, For a no, check out the book value of total assets. Book value of the total assets. Book value of total assets on balance sheet date, and check out the book value of total assets on date of transfer. Book value of total assets on balance sheet date, book value of the total assets on the date of transfer. Sir, you have to check out both the things. Sir, if increase, sir, not change, increase in book value is more than 15%, then take off the balance, take off the date of transfer, otherwise take off the balance sheet date. If increase in the book value of the asset is by more than 15%, then you have to check for transfer date, otherwise sir, take the balance sheet date. So that is how you will arrive at the valuation date. Once valuation date is arrived, sir, you have to check further, sir, but are we clear on this valuation date? Sir, whether the foreign company derives as value from asset located in India, first step we have to check is on which date we are going to do the valuation. On which date we are going to find out whether such foreign company derives value from Indian assets or not. Sir, that is the first important thing, first and the most important thing. On which date we are supposed to find out the things? On which date? Sir, for that matter, we took the valuation date. Step 1 done. Focus on the date of transfer, before transfer, and date of transfer. Identify the valuation date. If increase in book value of the assets is more than 15%, then date of transfer shall be considered as valuation date. Otherwise, sir, uh, date of balance sheet shall become valuation date. Sir, can we find out valuation date in this given example? Sir, we have balance sheet date in which total book value of assets is 8,000 crore. Sir, on the date of transfer, sir, transfer took place on 30th September 2025. On that day, sir, we have assets worth rupees 9,500 crore. Balance sheet date, we have assets 8,000 crore. On transfer, we have 9,500 crore. Sir, increase is more than 15%. So, sir, date of transfer shall become valuation date. Sir, whatever the valuation that we are going to do is on the valuation date. Sir, you can ignore any of the prior balance sheet. Sir, we are clear with the date of valuation. Sir, once we identify the valuation date, sir, we have to follow the next step. Sir, what next step? Sir, you have to find out, sir, FMV of the Indian assets held by such foreign company. Whatever the Indian assets this foreign company is holding. Whatever the Indian assets this foreign company is holding, sir, take FMV of Indian assets, sir, without reducing liability, divided by FMV of the total assets. Total assets. Clear, sir. Beautiful, beautiful, Monisha. You have to find out the FMV of the Indian assets divided by FMV of the total assets. This would show how much of the total assets we have Indian assets. Of the total assets, how much assets are Indian assets? So this will give us the information. Sir, in our case, this on the valuation date, this foreign company has 10,000 crore worth total assets. Out of this, Indian assets are 8,000 crore, and of the Indian assets, sir, we are holding just 67%. So it is having 5,360 crore Indian assets out of the total 10,000 crore assets. Sir, provision says, hi Mohit, provision clearly says, sir, if FMV of Indian assets without liabilities divided by FMV of total assets without liabilities exceeds 51%, then such company shall be substantially located in India. If such company is having more than 51% of the assets located in India, provision says that company is bound to be located in India only. Okay, sir, we got your point. Plus, sir, value of Indian assets exceeds 10 crore, then in that case, sir, such foreign company is deemed to be located in India. Sir, in this case, sir, 53% of the share, 53% of the total assets are Indian assets now. So the CGP would be considered as assets located in India. Sir, we got this point. Plus Indian assets also exceeds 10 crore. In that case, sir, it shall become taxable in India. Okay, sir. Remember, sir, how capital gain would be calculated? So whatever the full value of consideration is, take that. Whatever the cost of acquisition is, take that. Whatever capital gain is being arrived, sir, not the entire capital gain would be taxable. Not that entire capital gain would be taxable. Sir, only a percentage of that capital gain would be taxable. Sir, whatever the percentage of Indian assets that this foreign company has will be the percentage in which, sir, this capital gain will be taxable. Sir, capital gain would be only taxable to the extent of 53.6% because that is only the value of Indian assets this foreign company has. That is how you are going to compute capital gain in case of Sir, indirect transfer. That is how you are going to compute capital gain in case of indirect transfer. So any doubt on up to this point? Any doubt up to this point? Do let me know. Otherwise, sir, we can continue further. Sir, oh, you have to follow the 3 steps. Mohit, message me personally for that matter. Sir, 3 steps. First of all, you have to find the valuation date. Second step, what you have to do is, sir, find out whether it holds 50% or more. And third step, sir, with how to whatever the capital gain you arrive, just multiply it with the percentage of Indian assets held by such foreign company. I hope you got the point. So there are certain considerations to be taken care of. Is, sir, whenever this foreign company, for example, this foreign company holds, for example, this foreign company holds 67% of the Indian assets. I mean, this Indian company, this Indian company, 67% are being held by this foreign company. So there is another company called Rahul Limited. There is another company called Rahul Limited. There is another company called Rahul Limited. This Rahul Limited has 60 crore worth assets. Out of the 60 crore worth assets, sir, 50 crore are Indian assets only. 50 crores are assets in Hutchison SR. But sir, this Rahul Limited only holds 5% of Hutchison SR. Provision says even if there is a foreign company, even if there is a foreign company who might have substantial value deriving from assets located in India, who might have Indian assets exceeding 10 crore. But sir, if such foreign company holds only up to 5% of the Indian assets, provision says no indirect transfer provision would apply. No indirect transfer provision would apply. See, if you have studied this point, you will be able to relate with it. If you have not studied this point, it would be difficult for you to relate. For that matter, what can you do? You can revise this topic. Just listen to the slide again and again, so you will be able to understand it. Sir, we got this point. Sir, if any Indian company declares dividend, for example, if any Indian company like Reliance distributes the dividend, sir, can I say that this will be Indian income? Right answer, yes, sir. Since asset is located in India, then it shall become Indian income. Sir, but if any of the foreign company, sir, which derives its value from assets located in India, can any dividend declared by this foreign company be Indian income? Right answer is no, no. If any foreign company who's deriving substantial value from assets located in India can be considered as Indian income also, the answer is no, no, sir. It is not logical to call it Indian income. Sir, we got this point. Sir, we got this point. Sir, last point of indirect transfer. Sir, what it says, sir, if any of the indirect transfer takes place, remember, sir, if any of the indirect transfer takes place, it is the duty. It is the duty of the Indian concern, that is the Hutchison SR, to tell it to Government of India that sir, indirect transfer of its parents has taken place. So up to when it has to disclose, sir, up to within 90 days, from end of the financial year. The financial year in which the indirect transfer took place, sir, and let that financial year and within 90 days from the end of the financial year, sir, this Indian company has to report, sir, what if it failed? What if it failed? Sir, first of all, reporting is to be done in Form 49D. If this Indian company fails to report such indirect transfer, sir, what will happen? Sir, if it fails, normally penalty leviable is 5 lakh rupees. But sir, if control or management of the parent entity has taken place, control or management has changed, then in that case 2% of transaction value is the penalty leviable in the hands of the Indian company. If control has changed, management of the parent entity has changed, and still this Indian entity has not reported the indirect transfer, provision says in that case, sir, it will be leviable for 2% of the transaction value. Are we clear on this front? Are Baba, are we clear on this front? Sir, are we clear on this front? If things are clear, do write down clear. Sir, if things are clear, do write down clear. Sir, this is the provisions of indirect transfer. Sir, with that, we complete clause 1. Sir, what was clause 1 all about? Sir, clause 1 started off with the business connection. Sir, business connection may be done via agent. Business connection may be done via significant economic presence. After that, we had assets located in India. After that, we had capital gain on account of direct transfer of the assets. Then we had capital gain on account of indirect transfer of the assets. Sir, with that, we completed, sir, clause number 1. Now we have clause number 2. Sir, what clause number 2 says? Sir, if any of the salary income is earned from services rendered in India, it shall be deemed to be earned in India. Any of the person does employment in India and income is earned in India, whatever the salaries accrued is, is on account of services rendered in India, that shall always become Indian income. For example, if any of the person comes to India, does services in India, sir, whatever the salary accrues is, it shall become Indian income, sir. No doubt whatsoever. Sir, many of the Indian citizen work outside India. Many of the Indian citizens work outside India. Sir, they are normally non-resident. Sir, they are normally non-resident. But sir, they receive salary from government of India. Many of the non-resident are receiving salary from government. Many of the non-resident receive salary from the government. Provision says if any of the Indian citizen, any of the foreign consulates, diplomats who receive salary from government of India, despite of the fact that these are non-residents, sir, this salary shall become Indian income only. But here is a catch. Here is a catch, sir. Any perquisite allowances under Section 10 clause 7 is exempt. Sir, whatever the perquisite, whatever the allowance that these non-resident people are receiving is absolutely exempt. Is absolutely exempt, sir. Only salary component is Indian income that shall become taxable. But whatever the allowance perquisites they are getting, so they might be getting some house, they might be getting some children help, children allowance, they might be getting some perquisites. So whatever they are getting is completely exempt. So later on, we came on to any dividend paid by the Indian company outside India, so that shall always be Indian income. Any dividend paid by the Indian company outside India, that shall become Indian income only. Sir, we have interest. Interest is beautiful point. Sir, what it says? Provision says, sir, if interest is being paid by the government of India, if government of India pays any interest, if government of India pays any interest, the provision says, sir, such interest is always Indian income. If government of India pays interest, it shall always be Indian income. Sir, for whatever purpose such loan has been taken, sir, interest will always be Indian income. Sir, if a resident person pays any kind of interest. For example, Rahul is paying any interest to anybody. Provision says it shall become Indian income only. It shall become Indian income only. But sir, what if, sir, if Rahul has used the loan money to do business outside India? If I have used the loan money to do business outside India, if I have used the loan money to do any kind of investment outside India, then in that case, whatever interest I pay shall not become Indian income. Sir, if I have used the money to do any business outside India, if I have used the money to do any kind of investment outside India, then whatever interest I pay on the loan, sir, that shall not become Indian income. Sir, this is exception only for resident. Government, if doing business outside India, it shall be Indian income only, always Indian income only. But if resident person pays any interest, it shall normally be Indian income. But if it is used to do business outside India, if it is used to do investment outside India, then in that case, any interest on such loan shall not become Indian income. Sir, for example, if a non-resident pays interest to non-resident, if a non-resident pays any interest to non-resident, sir, will that be Indian income? Right answer is no, it is not Indian income. But sir, if non-resident has used this loan money to do business in India, so if this non-resident has used the loan money to do business in India, then it shall become Indian income. Then whatever the interest that this non-resident is paying to non-resident, it shall become Indian income. So another catch. For normal instances, what you study, if non-resident is paying interest to this non-resident to do any investment in India, sir, this is not considered. Any interest paid to do investment in India, sir, this shall not constitute Indian income. Sir, normally only for interest portion, we have this exception that if non-resident is paying non-resident any interest and such loan is used to do any investment in India, sir, such shall not be considered as Indian income. That is not considered as Indian income. But for royalty and FTS, it is considered as Indian income. Okay. We have clause number 6 as royalty. Sir, if royalty is being paid by the government of India, sir, for whatever purposes government of India pays royalty. For whatever purpose government of India pays royalty, sir, it is always Indian income. It is always Indian income. Sir, if a resident person pays any kind of royalty or fees for technical services, sir, whatever we are studying for royalty is applicable for fees for technical services also. Sir, whatever the royalty or FTS, fees for technical services, is being paid by the government of India, it is always Indian income. Sir, whatever the fees for technical services or royalty this resident person pays, it is always Indian income. But sir, if a resident person, sir, has used the royalty services, has used the technical services for doing business outside India, for doing any investment outside India, in that case, sir, such royalty, such technical services is not considered as Indian income. If any of the royalty is used to do business outside India by resident person, if any of the royalty is being paid to do any investment outside India, in that case, sir, it is not considered as Indian income. It is not considered as Indian income. I hope you got my point. Sir, if any non-resident pays any royalty to any non-resident or FTS is paid, sir, normally it is not Indian income. Normally it is not an Indian income. Normally it is not income. Logically it is not Indian income because how income can be Indian income if payer is non-resident, pays is non-resident. But sir, if royalty and FTS is paid by one non-resident to another non-resident to do business in India, this shall become Indian income. If royalty is being paid by one non-resident to another non-resident to do any investment in India, oh sir, it shall become Indian income. So what I say, royalty paid by government, always Indian income. Resident person, normally Indian income. But sir, if a resident pays royalty for doing business outside India, if resident pays royalty FTS for doing any investment outside India, it shall not become Indian income. If non-resident pays any royalty to any non-resident, it is normally not Indian income. But if non-resident paid royalty to do any business in India, to do any investment in India, so in that case, such income is considered as Indian income only. Sir, we have exception for interest. Just remember, only for interest portion. Sir, if interest is paid by one non-resident to no other non-resident for doing any investment in India, then such interest is not Indian income. But for royalty FTS, such royalty FTS for doing any investment in India is Indian income only. So what is meant by royalty? Important, sir, important definition here is, sir, if you are transferring any right to use any patent, invention, or secret design, if you are giving any right to use, if you are earning via giving right to use any patent, if you are actually transferring, if you are actually letting somebody use your patent, copyright, design, it is considered as royalty. Sir, if you are imparting information regarding use of secret formula or design, sir, if you are imparting information regarding technical commercial skills, sir, if you are allowing right to use any commercial equipment, sir, it shall be considered as royalty also. Sir, any kind of services in connection to above shall also be royalty. Sir, for example, if I have a laptop in front of me, I bought this laptop for 50,000 rupees. Sir, this laptop is worth 50,000 rupees. Out of this 50,000 rupees, sir, 30,000 is towards hardware, 20,000 is towards software. Should I say that 20,000 is I have paid for a software, so it shall constitute royalty? Right answer is no. If sir, a single product is being bought in which there is component of hardware, there is component of software, and we are paying single price for that product, provision says it does not constitute royalty. Sir, any kind of income or consideration received on account of sale, distribution, and exhibition of films is also royalty. Any kind of income from consideration received on account of sale, distribution, and exhibition of the films is also considered as royalty. Sir, at last. Sir, for example, if I am a TV channel called Aaj Tak, if I am a TV channel called Aaj Tak, sir, if I want to my TV channel to be linked to, for example, Tata Sky D2H box, if I want to get the TV channel linked to any of my Dish TV T2H box, if I want to give my TV channel linked to Airtel T2H box, sir, in that case, what I have to do? Sir, I have to pay certain sum. I have to pay certain sum to these cable operators so that they can downlink my channel. They can downlink my channel. So provision says downlinking of channel shall also constitute to royalty. Sir, what is meant by fees for technical services? Fees for technical services imply Trinamool Congress. If you know Mamta Didi from West Bengal, Mamta Didi from West Bengal. Sir, Trinamool Congress, sir, that is technical services, managerial services, and consultancy services. Sir, all these services are called FTS, fees for technical services. So any kind of construction services is not technical services. Any kind of assembly services are not technical services. Any kind of mining are not technical. Any kind of services which are considered as salary are not considered as technical services. That completes our clause number 7. So last thing, if any of the resident person gives any gift to non-resident, gives any he gives anything to non-resident, RNOR, or if any of the foreign company. Sir, money. If any money is being given, being given by resident to non-resident, resident to RNOR, resident to FC, so in that case, if this money exceeds 50,000 rupees, then such income shall become Indian income. That shall always become Indian income, sir. No doubts, no strings attached, nothing, sir. That shall always become Indian income. Sir, anybody having any doubt till this point? Sir, anybody having any doubt till this point? Sir, do let me know. Whoever are sitting live, you have a sogand, you have an obligation to write down clear. Otherwise, sir, I will have to wait for you all to write down. Okay. See, if you are watching recorded, just stop the video and comment down and like the video. Or in case if you are watching a day before exam, just liking down would be enough. Comfortable with the language, comfortable with the wordings, comfortable with the articulations of the words. Everybody, please comment down if you have any issue so that I can resolve it timely. Srinivas, Manisha, clear, sir, clear. See, again and again, I am asking you, begging you all, sir, do like this video, and also once it is done, do share it with your friends so that they can also get benefit of this video. See, it takes real guts to work out on this language, to speak for 7 hours continuously. So do share it with your friends. Okay. Sir, till now what we have studied, just briefing you out, sir. We started off with identifying who non-resident is. For that matter, we understood the residential status. After understanding the residential status, sir, we came on to which income of the non-resident shall become taxable in India. Which income of non-resident shall become taxable in India. Sir, after understanding which income of the non-resident taxable in India, sir, we are now able to compute the total income of the non-resident. We are now able to calculate the total income of the non-resident. But sir, there are certain incomes that should be exempt now. There are certain incomes that should be exempt now. Not all the incomes government can tax. Accepting with me, agreeing with me. There are certain things that should be exempt now. So, sir, what are the exemptions? For that matter, exemptions are to be studied. First of all, if any of the non-resident earns any kind of income, any kind of interest income on account of NRE account. If any of the non-resident has a NRE account in India, so NRE implies non-resident external account in India. Whatever interest that this non-resident is earning shall become exempt. Whatever interest income that this non-resident NRE account, through this NRE account, this non-resident is earning, it shall become exempt. Sir, conditions attached are, sir, this non-resident should be as per FEMA. Non-resident person should be as per non-resident as per FEMA. Also, such non-resident NRE account should be opened with prior approval of RBI. Sir, we got this point. Whatever exemptions I am telling you, you just need to remember that only. Otherwise, no other exemptions you need to remember. Sir, if any of the unit located in IFSC pays any kind of lease, pays any kind of royalty on lease, if pays any kind of interest on account of aircraft, or account of ship. If unit of IFSC pays any kind of release rental, pays any kind of interest for aircraft, ship, sir, such payment is exempt in the hands of non-resident. Whatever the lease payment, lease rental is being paid to the non-resident. Whatever the aircraft, whatever the ship that is being taken by the IFSC unit, sir, whatever the lease rental or interest is being paid by the IFSC unit, that is exempt in the hands of the non-resident. Sir, we are clear on that front. Sir, very important, very, very, very super duper important exemption, sir. What this implies? Sir? Sir, if we have IFSC unit has borrowed certain money on or after 1st September 2019. IFSC unit has borrowed any money on or after 1st September 2019. Whatever interest is being paid against that money, sir, that interest shall become exempt, sir. This is very important. So, sir, as of now, even IFSC can borrow without any interest taxability. Whatever interest that is being paid by this IFSC unit shall become exempt in the hands of non-resident. That will become exempt in the hands of non-resident. Very important exemptions to be covered. Very important exemptions, sir. You might get a trickier question from this topic, this exemption. So therefore, you must remember this exemption very thoroughly. See, any kind of foreign diplomats coming to India, see what happens. Many of the foreign diplomats come to India. See, for example, we have embassies in India. We have embassies of Sweden. We have embassies of United States. We have embassies of United Kingdom. Many of the foreign diplomats come and stay in that embassy, sir, because they stay in that embassy, sir. Whatever income they receive, sir, they become the resident of India. Whatever income they receive shall become Indian income. Provision says, sir, whatever income they receive shall become exempt income. It shall become exempt income, sir, but only if whatever our diplomats are there in your country, whatever our diplomats are there in your country, such income shall be exempt in your country. In that case, sir, we will exempt such diplomats income in India. If you are exempting our diplomat salary in your country, we will exempt your diplomat's salary in our country. That is what it takes. But sir, we attach another condition. Provision says such diplomats shall not do any business profession in India. Such diplomats shall not do any business profession in India. Sir, we got your point. Many a times what happens is, sir, for example, we have foreign enterprise. For example, we have a company in Japan who wants to teach their employees as to how UPI runs in India. So that company sent certain employees to India to understand the UPI business in India. That company sent the employees just to understand the UPI business in India. Provision says, sir, whatever the income that they are receiving in India, whatever income that they are receiving in India shall not become Indian income, shall not become Indian income. Sir, provided, sir, they do not consider any business income. They do not consider any business in India. They do not do any profession in India. They do not do any kind of employment in India. Along with that, sir, they stay in India for less than 90 days. In this case, if they receive whatever the salary, whatever the income that they receive, sir, shall not be considered as Indian income. Or even if it is considered Indian income, we will consider it as exempt. We will exempt such income. Sir, any kind of a royalty paid, or sir, fees for technical services paid for security services of India, if for the purpose of security of India, if any of the royalty is paid, if any of the FTS is paid, provision says it shall be exempt in the hands of the non-resident. Whatever the sir royalty, whatever royalty is paid, whatever the technical services are paid for any kind of security services in India, sir, that is always exempt. At last, sir, we have, if any of the royalty or FTS is being paid by National Technical Research Organization, whatever royalty FTS they pay to any of the non-resident, sir, it shall become exempt. It shall become exempt. Sir, we are clear on that front. Sir, everybody clear till now? Everybody clear till now? Sir, shall we move on to tax rates? Sir, whatever we have studied till now, making you revise that. We started off with understanding who non-resident is. For that, we understood the residential status. Later on, we came on to scope of total income, which would define what incomes would be taxable in the hands of the non-resident. Later on, we came on to exempt income, sir, what all incomes will be exempt in the hands of non-resident. And at last, sir, now we are understanding the tax rates. Till now, we are able to identify what are the incomes taxable in the hands of non-resident. Sir, now we have to understand what is the tax rate that would apply in the hands of non-resident. What is the tax rate that would apply in the hands of the non-resident? That is what we have to study from now. Okay, sir, we got your point. We got your point, sir. We got your point. We got your point, sir. Sir, understanding tax rates is a difficult task. How it is difficult task? I would tell you why. First of all, sir, we really need to understand, sir, why is non-resident given any kind of special benefit? Right answer is, sir, first of all, special benefit is given in case of presumptive taxation. A non-resident has been given a gift of presumptive taxation. Sir, I have written this tax rates in my book. Okay, I have written this tax rates in my book. Sir, every time whenever I read tax rates, I try to simplify it more. I simplify it more further. Simplify it further. For that matter, I have rewritten these tax rates in my own hands. So this is the simpler format of the tax rates. I have shared this on my Telegram channel. If you are referring any of your book, you can refer it along with me. If you are referring my book, if you are referring any of my notes, so this format, this tax rates have been circulated by me in the Telegram channel. I will try to use it less, but sir, in this table, in this sheet, I have refined the tax rates to the fullest. Starting off with the first benefit that non-resident gets is, sir, presumptive taxation. Later on, we'll study tax rates. First of all, let us understand presumptive taxation. Sir, we have basically 6 kinds of presumptive taxation that are applicable for the non-resident. 6 kinds of presumptive taxation. Sir, we studied presumptive taxation in PGBP. It was 44AD, 8%, 6% to be declared. We studied presumptive taxation in case of 44ADA, sir, 50% to be declared. We studied presumptive taxation in 44AE, sir, in that case, sir, 1000 or 7500 to be declared. Sir, here we have 6 more presumptive taxations. Out of them, first is, sir, 44B. Sir, if we have any kind of non-resident shipping company, a ship comes to India, goes from India, comes to India, goes from India, comes to India, goes from India. A ship regularly comes to India, goes to India. So that ship has to declare, his income equal to 7.5% of the specified sum. That ship has to declare 7.5% of the specified sum. Now, sir, what specified sum imply? That is important. Whatever the goods that ship is carrying, whatever the freight for that ship is received in India, whatever the freight that ship is that ship is carrying, whatever the goods that ship is carrying, if the freight of such goods is received in India, so that shall be considered as first part of specified sum. And whatever the goods that it is carrying from India to anywhere in the world, received anywhere in the world, freight received anywhere in the world, second part shall be considered as specified sum. So freight received in India, first of all. Then second thing, whatever the goods that have been taken outside India, wherever the freight is being received, that shall also considered as specified sum. So again, I'm repeating. Just repeat after me. Freight for goods carried outside India to India but received in India, that shall be specified sum. Whatever the goods taken outside India, freight received anywhere else in the world, so that shall also be considered as specified sum. So these two things are called specified sum. These two incomes are called specified sum. So add these two and charge 7.5%. That shall give you PGBP. Sir, a promise, a hardcore promise I want from all of you. Sir, never consider it as a tax rate. It is not a tax rate, sir. It is not a tax rate. It is just a way of calculating total income. It is just a PGBP calculation. It is just a total income calculation method. So it is not a method to calculate the taxes. This foreign company would still be leviable for taxes at the rate 35%. If it is an individual, it will still be leviable to taxes at the rate of a slab. Sir, this is just a total income calculation. This is just a PGB calculation. It is not tax rate. Sir, we got this point. Sir, can this non-resident foreign company declare lower? Right answer is no. It does not have any option to declare lower than 7.5%. It has to declare. Second company that we have for presumptive taxation is, sir, 44BB, any aircraft company. Sir, for example, any of the foreign company that has aircraft. For example, sir, we have Qantas in Australia. We have, which one is in Dubai? Emirates, yes. Emirates is in Dubai. It comes to India. Sir, we have many other flights which come, like we have Lufthansa. These non-resident foreign companies come to India, go from India, come to India, go from India. So whatever the freight that has been received in India, that is to be considered. And whatever the freight that has been received from the person resident of India and gone anywhere, freight received anywhere, so that shall also be considered. All the two things to be considered. Take 5% of that, and that shall become the specified sum. Specified sum multiplied by 5% will be your presumptive income. You have to offer taxes at the rate 35% or slab on this presumptive income. Sir, can you declare less than 5%? Right answer is no. So, can I declare by getting my books of accounts audited? Right answer is no. You don't have an option to declare lower at all in these two cases. So, are we clear on that front? Yes, sir, we are clear on that front. So, third presumptive taxation available to us is, sir, 44BB, which says, sir, if any of the non-resident foreign company, non-resident person or foreign company rents out any plant and machinery in India which is used for prospective extraction for natural or mineral oil. Rents out any plant and machinery in India which is used for prospective extraction of mineral oil. So provision says whatever the rent that has been either received from India or whatever the rent that has been accrued in India, so of that rent, so 10% is to be offered as PGBP by this non-resident and foreign company. Similarly, sir, if there is a foreign company which undertakes any turnkey project, so turnkey project implies, sir, a big power projects, in which right away from starting till the end of conclusion of the work is being done by this foreign company only. So turnkey project implies construction or business of erection, plant and machinery, testing, commissioning thereof. Everything is to be done, so by this foreign company. So that shall be approved by the government. So if this foreign company undertakes any turnkey project, whatever the income is received in it, received from India or accrued from India, so of that specified, some 10% is to be declared. What I'm saying is 44BB, renting on account of prospective extraction of mineral oil. And sir, 44BBB implies foreign company doing any turnkey project. In both the businesses, sir, whatever the specified sum is, sir, you have to offer 10% of this specified sum. Sir, but here is a catch. Sir. If you want to declare lower than 44BB and 44BBB, sir, you have an option to declare lower. For that matter, you have to maintain your books of accounts, and sir, you have to get your books of accounts audited. Then in that case, you can declare lower profits also. Sir, remember. Sir, but there is another catch. Sir, in case you want to declare lower profit and you get your books of accounts audited, sir, you might have losses. You might incur losses and you get yourself accounts audited, and sir, you might want to declare losses. Sir, you are allowed to declare losses if you get your books of accounts audited. But sir, remember, this losses can never be set off against the presumptive income. In any of the further year, you get audited, sir, you have profit, you can set off this losses from that profits and profits. But sir, in next year, if you opt for P44BB, 44BBB, sir, if you are opting for presumptive taxation, sir, you cannot set off these losses from those presumptive incomes. Sir, are we clear on this front? Sir, absolutely clear. If you are getting these insights for the first time, do let me know in the comment section. Also, do like the video along with. Sir, we have another question, another topic, 44B, BC, sir. Very, 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 very important topic. I personally think that this might be asked in one of the MCQ. This is going to be asked in MCQ for sure. I have this strong conviction that this is the topic that you might see in exams. Sir, if there is any kind of cruise shipping company, if there is any non-resident cruise shipping company, sir, that operates in India, sir, that cruise shipping company is liable for presumptive taxation. Sir, now what is cruise shipping company? Earlier, it was not defined in your syllabus. Earlier, it was not defined in the syllabus, but later on, sir, for September 25, there came an amendment. So, provision says if there is any cruise shipping company, a ship which has capacity of carrying more than 200 passengers, 200 or more passengers, it can carry. Second thing, that ship covers at least two of the ports of India. Sir, for example, Mumbai port, for example, it is carrying to Mundra port, it is carrying to Vishakhapatnam port, it is for carrying to any port. So any of the two ports, minimum two ports, it should cover. Third thing, that ship should operate for leisure. That ship is not meant for carrying cargo. That ship should not be meant for any other purpose. It should be meant for leisure. You just have to go and enjoy there. Provision says whatever this cruise shipping companies is earning from India, so either income accrued in India or income received in India. Whatever this cruise shipping company is earning from India, sir, you have to offer 20% as total income. 20% of the PGBP you have to declare, sir. 20% of the receipts or accrued accruals from India you have to offer. Sir, can you declare lower than that? Right answer is no, you cannot declare lower than 20%. Sir, you cannot declare lower percent because ultimately, sir, it is an extension of 44B only. So now you cannot declare 40 or you cannot declare lower profit than that. So anybody having any doubt in this case? Sir, no issue. Sir, for example, we have section 172, a normal shipping company. A ship that only comes to India only once and never comes back to India. A ship, a ship that comes to India once in a lifetime and never comes back again. So there might be some ships. Provision says such those ships shall be assessed to tax in previous year itself. Government is not going to wait for even assessment year. They are going to be taxed in previous year only. Also, sir, whatever the freight that they accrue in India or they receive in India, provision says such freight shall be leviable for 7.5% of the income. Sir, that foreign ships, that occasional shipping companies, sir, have to offer at least 7.5% of their receipts, 7.5% of their freight to 7.5% of their freights as income in India. Sir, remember, sir, no deduction of any expenditure would be allowed. No deduction of any expenditure would be allowed, sir. Apart from that, sir, that occasional ship has to file ROI before departure. Sir, that occasional ship that comes to India under 172, sir, will not be allowed to depart from India unless it files ROI. But sir, here is a catch. If such master of the ship does the arrangement for the payments of the taxes, plus it is impossible for that master to file the ROI before departure. It is impossible. So in that case, sir, assessing officer can give a relaxation to that ship. It can even file ROI after 30 days of departure. What I'm saying is, normally it has to file the ROI before the departure in this 172 case, in this section 172. But assessing officer can relax this immediate ROI filing to 30 days, but only if sir master of ship has done certain arrangements for the payments of taxes. Plus, it is impossible in the assessing officer eyes to file ROI. In these, if both the conditions are satisfied, in that case, sir, ship is given 30 days relaxation to file ROI. In whatever case ship files the ROI, sir, within end of the financial year, add 9 months to it, so assessing officer has to do the assessment of such ship. So that completes our presumptive taxation. Sir. Now I have to switch to, sir, taxation of a tax rates for a non-resident. I hope you must have already studied it somewhere. If not, sir, I will try to teach it in my own manner. I would request you, just try listening what I'm saying. Try listening what I'm saying. If you want to write down things, it would be great if you write down. If you don't want to write down, sir, I have shared this. I have shared this PDF with everybody. I have shared this PDF with everybody. Okay, sir. What? How non-resident taxation takes place? First of all, I want to make certain things very clear, sir. The way a resident is being taxed is the similar way in which non-resident is being taxed. There is no difference as such. There is no difference per se. Whatever the slab rate that we have studied, up to 3 lakh no tax, 3 lakh to 7 lakh 5%, 7 lakh to 10 lakh 10%, 10 lakh to 12%, 12 lakh 15%, 12 lakh to 15 lakhs are 20%, exceeding 15 lakh it is 30%. So that is same applicable to non-resident also. Whatever the tax rate we have studied under section 112A, so that is on listed securities, that is over and above 1.25 lakh, 10% for 10% prior to 23rd July. After 23rd July, sir, it is 12.5% over 1.25 lakh. So that is same applicable for non-resident also. Sir, for example, if non-resident sells any kind of immovable property, so 20% budget prior to budget, after budget it is 12.5%. Sir, if non-resident sells any listed securities and earns short-term capital gain, so 15%, 20%, so same as it is, sir, as it is would apply. Sir, whatever the tax rates we have studied, sir, what if non-resident earns any casual income? He earns any income on account of lottery. Arey Baba, whatever the income is applicable, tax rate applicable for resident will be applicable to non-resident also. In under most of the provisions, whatever the tax rates that you have studied under sections, under the respective sections that are applicable for non-resident also. For example, if non-resident earns any online gaming income, sir, he shall be taxed to 30%. If any of the income, any of the undisclosed income is being found in the hands of non-resident, sir, he shall be taxed to 60%. If search takes place in any of the premises of the non-resident, he shall be taxed as per block assessment. Sir, whatever the tax rates you have studied, that tax rate shall continue to apply. In this chapter, now we are going to discuss certain different tax rates. Certain different tax rates. Sir, for example, business income of non-residents, sir, it is taxed at 35% only now. Sir, here we are going to study different tax rates. For that matter, sir, only special incomes, only certain special incomes of non-resident are being taxed. Only certain special incomes of this non-resident are being taxed. Apart from that, sir, we are not going to study anything special in this chapter. Only certain special tax rates are to be studied in this chapter. Sir, for understanding that topic, I have divided this topic into two parts. First of all, special benefit giving to certain people. There are certain people with whom government is very loving. I mean, government loves certain people to come to India. For example, we have FII. So government wants FII to be in India. So for them, special tax rate is given. Government want of Government wants of four people to be in India. So for them, special tax rate is given. Government wants more and more NRIs. Okay? Government wants more and more NRIs. They want to be stayed in India. So for that matter, now they give certain benefits to NRI. Sir, government gives any kind of benefits to non-resident sports person to promote sports in India. Government will give benefits to entertainer, and government gives benefit to specified funds. Sir, these five are the people whom special benefits are given by the government. We have to study the taxation of these five people. Other than that, there are certain incomes on which government wants concessional tax rates. Sir, we will study those incomes also. There are five incomes like whenever a non-resident earns interest, whenever a non-resident earns dividend, whenever a non-resident earns royalty, whenever a non-resident earns FTS, whenever non-resident earns any income of GDR, whenever a non-resident earns on unlisted securities. Sir, whatever the benefit that we have, we will study this. So what I want you all is, sir, it has to be person. If you see any kind of person in the exam, if you are being asked taxation of FII in exam, you just have to refer these taxation. If not, you are being asked a normal non-resident, sir, you have to check for these tax rates. This will simplify your question in the examination. Are we clear on that? Sir, absolutely clear. Any doubt to anybody till now? If not, sir, please write down in the comment section. I will wait for you and then I will continue further. Any doubt to anybody? Clear, sir. Absolutely clear. Okay. Sir, starting off with the taxation of FIIs. See, FIIs are the loved ones. Okay? Government wants to give certain benefits to FIIs. See, FIIs can only have incomes from securities. Sir, how in the God's name FII would allow and a government would allow anybody to invest in properties of India? Government FII does not hold any of the properties in India. FIIs can only hold securities. So whatever the taxation that would be given to FII would be for securities only. For securities, what benefit FIIs are being given, sir, if any kind of long-term capital gain occurs in the hands of FII under Section 112A? If any kind of long-term capital gain occurs in the hands of the FII under Section 112A, they are being taxed 10%, 12.5% over 1.25 lakh. Simple provision. Sir, before 23rd July, sir, 10% over 1.25 lakh. After 23rd July, it was 12.5% over 1.25 lakh. It is very simple now. We already know this provision. We already know this provision, sir. We are already aware of this provision. Yes, sir, we are already aware. Second thing, sir, this is important where most of the people lack. Sir, if FII earn any kind of other long-term capital gains, sir, for example, FII might earn in case of bonds, FII might earn in case of rupee-denominated bonds, FII might earn in any kind of other securities. Sir, provision says, such FII would be taxed at the rate of 10%, and 10%, sir, before budget also and after budget also, they will be taxed at the rate 10%. So this should have been 12.5%, but government has not corrected it. Government forgot to change this rate. So if you see any kind of bonds or long-term capital gain on bonds, if you see any kind of long-term capital gain on debentures, if you see any kind of capital gain, long-term capital gain on unlisted securities, sir, you have to tax it at the rate of 10% at whatever date it is being sold. It is the only exception for FI, otherwise everything remains the same. Sir, if FIIs have any kind of short-term capital gain under Section 111A, sir, prior to 23rd July, it will be taxed at the rate 15%. Sir, after that, it is 20%. Sir, prior to 23rd July, it was 15%, and later on it came to 20%. Sir, we are already aware of this tax rate. Sir, other SCCG, whatever the other short-term capital gain, for example, unlisted securities, for example, sir, any kind of bonds, debentures, short-term capital gain. So 30% also it was prior, and 30% is now. Sir, very simple point it is. At last, sir, whatever interest or dividend income this FII earns, sir, whatever interest dividend that it earns, sir, that shall be leviable for 20%. That shall be leviable to 20%. That shall be leviable to 20%. Sir, whatever interest dividend these FIIs earn, sir, taxable at the rate of 20%. Sir, we are clear with that fact. Sir, remember, there are certain points to be taken. So these are mandatory provision. FII don't have a choice to opt for these. They have to mandatorily opt for these provision. Sir, whatever interest and dividend income they are earning, sir, no deduction is being allowed on such income. Sir, if they are paying any salary to earn interest, if they are paying any interest to pay earn interest, sir, if they are paying any interest to earn dividends, sir, no deduction is allowed whatsoever on this interest and debentures income. For capital gain income, sir, sales minus cost of acquisition minus, sir, transfer expenses. The way you calculate capital gain in normal parlance, similarly capital gain you have to calculate for this non-resident also. Sir, no indexation would be given to FIIs, no indexation whatsoever, sir. Even if it is sold prior to 23rd July, sir, no indexation whatsoever to these FIIs. Sir, TDS of these FIIs would be deducted on interest and dividend income. Whatever the interest and dividend income is being paid to these FIIs, sir, TDS will be deducted on them. Sir, FIIs are mandatorily required to file ROI. Yes, sir, mandatorily required to file ROI. Sir, any chapter 6 deduction allowed to them? Right answer is no, sir. No chapter 6 deduction allowed to them. So if they have any kind of loss, which is very less likely to happen. If they have any kind of losses, sir, whatever the losses they have, sir, they can set off and carry forward as per regular provisions of Income Tax Act. Whatever the set of carry forward they have, they can carry forward as per regular provisions. Sir, done FII taxation. Oh my God, sir, done, sir, done, sir. FII taxation, we are okay, we are done. Oh wow, sir, this was very easy. We did not think of it though. It was very easy, sir. This was very easy. Oh wow, sir. Wow. Continuing forward to overseas financials organizations. Sir, who are these overseas financial organizations? Sir, if any of the non-resident wants to come to India, and sir, if they want to invest in mutual fund, they cannot simply do so. They have to get the prior approval of the SEBI. They have to do this with the association of an Indian bank. So then only they can come and only invest in mutual funds. And sir, they have to comply with Section 115 AV. Sir, whatever the long-term capital gain they earn on account of mutual funds, sir, whatever long-term capital gain, provision says if such long-term capital gain is prior to 23rd July, it is 10%. If it is after 23rd July, it is 12.5%. Sir, for overseas financial organizations, sir, no limit of 1.25 lakh is given. No benefit of 1.25 lakh is given. Sir, no benefit of 1.25 lakh is given. Whatever the income they earn from this mutual fund, sir, for example, they might earn interest, they might earn dividends, sir, whatever income they earn will be taxable at the rate of 10%. These OFOs are given tax rates of 10%. So whatever short-term capital gain they earn, sir, if short-term capital gain is referred under section 111A, then 15-20%. If short-term capital gain is otherwise, then in that case it is taxable at the rate of slab. Sir, if whatever the income they earn, sir, income, for example, interest dividend they earn, sir, TDS has to be deducted, sir, they have to file ROI, sir, no expenses against the income is allowed, sir, no indexation is allowed, sir, first proviso to section 48 is applicable, sir, done. Finish, sir, finish. Arianna, we did this, this was easy, we did this. Okay, it will take some time to get that accent. Sir, we did this. Do you have any doubt in this topic? Sir, OFO is also over. OFO is also over. Taxation of OFO was simple. Overseas financial organization is also simple. Now, sir, we have with us, sir, NRI taxation. NRI taxation. Sir, a topic that is being loved by the examination department. A topic that is being loved by the examination department. Why, sir? Why it is being loved by the examination department. Sir, we don't know why they love this topic. But I don't know why, sir, they continuously ask this topic in exams, sir. They continuously ask, either in MCQs, either in question answers, sir. They continuously ask this NRI taxation. Sir, who is NRI? First of all, any citizen of India, person of Indian origin, plus, sir, non-resident. Just give me a second. Huh? Yes. Any citizen of India or person of Indian origin plus non-resident, sir, shall become NRI. Okay, sir, shall become NRI. Sir, NRI taxation is not different from the others. It is not different from the others. Sir, only income on account of forex asset, foreign exchange assets, whatever the foreign exchange assets are. Sir, special tax rate is given on these assets. If they have any kind of long-term capital gain on this forex assets, sir, they are being charged to 10%, 15%, 10%, 12.5%. Sir, no 1.25 lakh benefit is given to them. If they earn any kind of income on this forex asset now, sir, it is being charged to 10%, 20%. It is being charged to 20%, sir. Only this benefit is given to NRI, sir. No other benefit is being given to them. Sir, if NRI has forex asset, so any long-term capital gain would be taxed to, sir, 10%, 15%, 10%, 12.5%. So income would be taxed to 20%. Sir, whatever other income these FIIs have, sir, FII might have, sorry, FII bolo. NRI might have rental income, NRI might have, sir, long-term capital gain income, so NRI might have any other business income, NRI might have any kind of house property income. Sir, whatever the income that they earn, sir, they will be taxed at normal provisions only. So only, sir, benefit is being given to the forex assets. Whatever the forex asset, foreign exchange assets they hold, they are being given benefit for that. Now, what is a forex asset? Forex asset imply, so shares of Indian company. So shares can be private limited company, shares can be public limited company. So any shares. Forex asset can be, sir, debentures of public companies. Sir, debentures of private company would not be included, sir. Debentures of public company. Sir, deposit certificates of public company, sir, no private company. Oh, sir, government on municipal securities. Any kind of government municipal security held, sir, these are forex asset. Whatever the investments have been made in these four assets, sir, would be subject to tax at the rate of 10, 12.5%. Also, sir, no benefit of 1.25 lakh is given to such NRIs. No benefit as such is given to these NRIs. So whatever the income they earn which is taxable at the rate 20%, sir, no expenses are being allowed to them. Okay, sir, we are okay. Sir, this is optional provision. Optional provision. NRI, if they want, might still be governed with the regular provisions of the Income Tax Act. Even if they have forex asset, so they might get governed themselves under regular provisions of the Income Tax Act. These taxation of forex assets is a optional provision for them, so they might choose it, they might not choose it. They can reject it. Sir, if they choose, if they opt for it, chapter 60 deduction is not available for the special tax income. Whatever the incomes that are being taxed at a special rate, sir, no chapter 60 deduction would be allowed to them. If they opt for optional provisions, or whatever capital gain is being computed, sir, no indexation would be allowed on it. Sir, first proviso would still be available to them. Okay, sir. If their total income constitute only of long-term capital gain and investment income, and TDS has already been deducted, sir, no need to file return of income. But if they have other income also, for example, NRI might have some lottery income, in that case, they have to file the return of income. At last, so NRI have an option to get the capital gain exempted. Sir, whatever the long-term capital gain arise on account of forex asset, they can claim exemption on that assets, up exemption under section 115F. They have an option to claim exemption on these assets. So how to claim exemption? So exemption can be claimed by long-term capital gain multiplied by, sir, multiplied by cost of new assets. So whatever the new cost of asset you acquire, divided by some net consideration, this is the amount of capital gain that will be exempted. Sir, you have to acquire the new assets, that has to be forex asset only, and you have to acquire within 6 months from the date of transfer. So this is the only topic that they continuously ask in this portion. Sir, if NRI becomes resident, because he comes to India, stays in India, he becomes resident, in that case, what would happen? Provision says he can still want to be covered under this. He can still opt for these provisions even if he becomes resident. So till the time he has this forex assets, so he shall still be covered. So every benefit that is being given to NRI is only for the every benefit that is being given to NRIs is only for the forex assets and nothing else. No special other benefit is being given to NRI. Sir, are we clear on this NRI benefit? Sir, this NRI taxation was the most important in this tax rate, because ICI has continuously been asking this NRI taxation in one or the other manner. Okay. Coming forward to non-resident sports person. Sir, if we have a non-resident and non-citizen, sports person. Sir, if we have non-resident, non-citizen, sir, entertainer. Sir, if we have a non-resident, non-citizen, sir, sports association. Then whatever these incomes they earn, sir, it shall be leviable to taxes at the rate of 20% plus applicable surcharge plus applicable education cess. Sir, they will be taxed only 20% on these incomes. Sir, what are those incomes? Sir, if a sports person is earning any kind of income on sports, sir, for example, Cristiano Ronaldo comes to India, play football. Sir, whatever the income he earns via playing football, that shall be taxable at the rate of 20% only. Sir, if Cristiano Ronaldo comes to India and does the ads of Coca-Cola, sir, whatever income he earns from advertisement, that shall be taxable at that 20%. And sir, whatever the newspaper article income, whatever he comes to India, he gives any kind of article in the newspaper, sir, whatever income that he earns will be taxable at the rate of 20%. Sir, whatever other income that Cristiano Ronaldo comes to India, sir, for example, he comes to India, he participates in lottery. He wins the lottery, sir, will that lottery be taxable at the 20%? Right answer is no. Sir, if Cristiano Ronaldo comes to India, he participates in Dream 11 and wins 1 crore rupees. Sir, will that online gaming be taxable? Right answer is it will be still taxable at the rate 30% only. Only these three incomes will be taxable at the rate 20%. Rest all the incomes will be taxable at the rate their respective sections. Sir, remember, sir, any kind of commentator, umpire, and referee. And any kind of commentator, umpire, and referee, these are not sports person. Sir, if what is meant by sports association, see, for example, we have BCCI in India and we have, sir, Sri Lankan Cricket Board. Sir, whenever our cricket players go there, sir, our BCCI pays certain sum to these sports associations, see, other sports associations. So whatever sum that is being paid to the other sports association, sir, whatever the sum is being paid, sir, that is leviable for 20% tax under section 115 BBA. This is section 115 BBA. Sir, for example, if you have heard Mukesh Ambani got his son married, and on his marriage, sir, Kim Kardashian came to India, sir, Rihanna came to India, Justin Bieber came to India. So whatever the income that these non-resident are earning, whatever the income these non-resident entertainers are earning on account of performances in India, so such incomes would be taxable at the rate of 20%, applicable surcharge and education cess. Sir, whatever incomes these non-resident are earning other than these incomes, sir, they will be taxable at the rate, the normal provisions of Income Tax Act. Sir, whatever the income they are earning from, whatever they are earning from sports, whatever income they are earning from this, taxable under Section 115 BBA, sir, no deduction shall be allowed. Whatever income they are earning under this tax section, sir, they will be subject to TDS under Section 194E. And sir, whatever the TDS, if TDS have been deducted under Section 194E and they don't have any other income, sir, they would not be required to file return of income. Sir, this was special taxation for sports person, entertainer, and sir, sports associations. Are we clear on this front also? So four people, four benefit, four different kinds of taxations are absolutely clear till now, sir. Absolutely clear. We have never thought of this way. We have never thought that we will be able to understand these provisions so smoothly. Okay, sir. You must have never not thought of many things else. Sir, specified fund, sir. What is this specified fund? What is this specified fund, sir? You need to understand this fund is very less likely to be asked, but sir, it is important for understanding. Sir, what is meant by specified fund? Sir, if any kind of alternate investment fund category 3. Sir, any kind of alternate investment fund category 3, it is called hedge fund also. Sir, it's established under IFSC. IFS. Alternate investment fund category 3, established under IFSC. Sir, all unit holders as non-resident unit holder, all unit holders as non-resident unit holder, all unit holders as non-resident unit holder. Okay, sir. Plus, so it is formed in the form of body corporate or LP, company or LP. So four things to be complied, sir. This fund is of alternate investment fund category 3, established in IFSC. Sir, got approval under IFSC. उसके अलावा sir, most of the people, 100% of the unit holders are non-resident unit holder incorporated in the form of body corporate or LLP. So such fund is called specified fund. Sir, these specified funds are given special benefits. Sir, what special benefits they are given? Sir, listen to this very carefully, very, very, very carefully, sir. Whenever this fund, see, remember, first of all, whoever the unit holders are unit holders are of the fund. But whoever the unit holders are of the fund. Sir, whatever the non-resident unit holders are of the fund, sir, whatever income they earn, sir, income from the specified fund, it is always exempt. Sir, for example, this fund gives any kind of interest, dividend to this non-resident unit holder, it is always exempt. Whatever the capital gain this unit holder earn on account of transfer of the units of the fund, sir, it is always exempt. So for unit holder, any income would be exempt. For unit holder of these funds, sir, any income would be exempt. Sir. But sir, for fund, I am telling you, sir, be serious now what I am saying. If these funds earn any kind of capital gain, short term, long term, on account of mutual fund, business trust unit, so rupee denominated bond, so other bonds, so alternate investment fund, so business trust, REIT, InvIT, so any other securities other than shares of Indian company, any other securities on shares of, other than shares of Indian companies, sir, it is exempt. Oh wow, sir. That means any capital gain earned by the fund is exempt. Right answer is yes. So short term, long term, Arey Baba, any capital gain except for shares of Indian company, whatever the capital gain that this fund earns is exempt. Whatever the capital gain this fund earns is exempt, absolutely exempt. For shares of Indian company, the way we studied in FII taxation, sir, long term capital gain 10%, 12.5% over 1.25 lakh. Other long-term capital gains are, for example, unlisted shares of Indian company 10%, 10%. Short-term capital gain, triple 1A, 15, 20%. Sir, other STCGs are 30%, 30%. Sir, we got this point. Sir, whatever the fund, this specified fund earns, so in the form of interest or dividend from Indian securities, sir, that will be taxable at the rate of 10%. So whatever this fund earns from securities outside India, that will be exempt in the hands of the funds. Oh my God. So how many benefits that it will get? So capital gain exempt. Except for shares, every capital gain exempt. Sir, interest dividend income from outside India, always exempt. Sir, income from India, so taxable at the rate of 10% only. Capital gain in Indian securities, sir, whatever the benefit that we had studied for FII taxation, same would apply. Oh, wow. Sir, whether TDS would be deducted on income, sir, whatever income that they receive, that is taxable, TDS would be deducted. Would they be allowed indexation on capital gain? Right answer is no, indexation is allowed. Sir, any expenditure on such income? Right answer is no, expenditure on any income would be allowed. Sir, any chapter 6 deduction? Are Baba, no chapter 6 deduction would be allowed. Sir, any ROI filing exemptions? Provision says any kind of ROI they have to file. And sir, whatever the losses they have, sir, they will go under regular provisions only. Oh my God, sir. Oh my God. So that means specified done. Specified fund is also done. Right answer is yes, sir. Specified fund is also done. So that means if we are being asked a question with respect to FII, we'll be able to solve. If we are being asked with respect to NRI, we will be solving. If we are asked question from OFO, sir, we will solve it. If we are asked question of sports person, sir, we'll be able to solve. If we are being asked in case of specified fund, sir, will we be able to solve? Yes, sir, we will be able to solve. Sir, but what if somebody asks, what if examiner asks us a question for a foreign company, which is not a FII, which is not a OFO, which is not a non-resident Indian, which is not a sports person, which is not a fund. So, for example, only a normal foreign company is being asked, so then what to do? So, in that case, you have to apply the regular provisions and you have to apply the following provisions. Regular provisions and following provisions. Sir, what these following provisions says, before starting, just let me know, do you have any doubt till now? Any doubts to anybody till now? Any doubt to anybody till now? Sir, sir, whenever a non-resident earns any kind of dividend income from India, whenever a non-resident earns any kind of dividend income in India, so that dividend income is always taxable at the rate of 20%. That dividend income is always taxable at the rate of 20%. Whenever a non-resident earns any kind of dividend income from India, it is always taxable at the rate 20%. But sir, remember there is a catch. Sir, if dividend is being paid by a unit located in IFSC, sir, if unit of IFSC is being located, sir, such dividend is taxable at the rate of 10% only. If dividend is being paid by the unit located in IFSC, it is taxable at the rate of 10%. Sir, if dividend is being paid by the unit of a business trust unit to a non-resident, and sir, SPV of this business trust to pay tax under 115 BEE, then in that case, sir, it is taxable at the rate 10%. By default, you can assume that whatever the business trust pays, whatever the dividend that business trust pays to a non-resident, it is taxable at the rate 10%. At last, sir, whenever a dividend is being earned on GDR, if GDR dividend is being earned, sir, it is taxable at the rate 10%. This is referred under section 115A(c). Any doubt to anybody? So dividend taxation also done. Dividend taxation also done, sir. Wow, wow. Sir, when to assume received, when to assume gained, sir, when to assume income. Sir, I will tell it later on. Sir, just tell me any doubt in dividend taxation. Oh, wow, sir, this was easy. Dividend taxation was easy, sir. It wasn't difficult at all. Arey Baba, nothing is difficult. I said now. With me sitting beside, sir, you don't have anything to worry about. Okay. Sir, after dividend, let's conquer royalty and technical services. Sir, for example, if any of the non-resident enterprises earns any kind of royalty or fees for technical services from India, you have to check first of all is whether such non-resident has permanent establishment in India. Whether such non-resident has permanent establishment in India. If such non-resident has permanent establishment in India, then sir, you have to prepare the profit and loss statement of such non-resident. So whatever royalty he earns, take it to the credit of P&L, or whatever expenditure that this person earns, that debited to P&L, and sir, whatever the net profit he earns, that will be taxed at the rate of 35%. Like some normal business they do, sir, you just have to tax royalty FTS as per regular provisions of income tax. Sir, for example, this non-resident does not have any permanent establishment in India, Sir, provides the royalty, provides the fees, provides the technical services and earns technical services. But sir, this royalty is not government approved. This royalty is not government approved. Provision says again prepare the P&L, earn, credit the income, debit the expenditure. Whatever the net profit comes will be taxable at the rate 35%. Sir, if there it is not government approved, so just simply tax it at 35%. But sir, if such non-resident does not have any permanent establishment in India, no permanent establishment in India, along with that, sir, also government approved royalty. Oh wow, sir, government approved royalty. Sir, government approved technical services. Then in that case, what to do? Sir, tax royalty on gross basis. Whatever royalty you are paying, sir, tax it at 20%, sir, no deduction allowed whatsoever. No deduction on this royalty allowed whatsoever, sir. Whatever royalty they are earning, sir, tax it at the rate of 20%, sir. No deduction allowed. So sometimes what happens is, sir, whenever we want to tax royalty at the rate 20%, but sir, India and that country prescribes a lower rate. Prescribes a lower rate. Provision says you have to honor that lower rate. You have to honor that lower rate. Remember, sir, what happens? Many a times what happens is, sir, as per Income Tax Act, tax rate is 20%. Whenever we have to tax such income as per Income Tax Act, sir, whatever the tax rate has been prescribed under Income Tax Act, you have to add, sir, surcharge applicable to him. You have to add education cess applicable to him. Then only you have to tax it. Whatever the income taxable is in the hands of the non-resident, sir, you have to add surcharge, you have to add applicable education cess, then only you have to deduct such income in the form of taxes. Then only you can deduct it. So this is the first thing. But sir, if for example, if tax rate has been defined in DTAA, in that case, sir, you don't have to add surcharge, you don't have to education cess, you just have to take the 10%. This implies, sir, whenever income is taxable as per DTAA, no surcharge, no education cess is being charged in the hands of the non-resident person. Sir, we are clear on that front? Absolutely, sir, clear on that front. Sir, if royalty and FTS is not being given, sir, whether it is government approved or not, sir, what to do in that case? Sir, you can assume it approved once. Just write down the note given in the bottom. Sir, you just have to approve. You just have to assume it approved. Sir, you can even simultaneously approve, or you can simultaneously take not approved. Sir, in one question it assumes approved. In one of the past question it has assumed approved. But sir, I had talked with board of study student people. They say that whatever you assume, it will be given in the exams. Normally, from now onwards, it will be given in the exams. But sir, even if it is not given, sir, you just have to solve the question and give your assumption accordingly. Sir, sir, are we clear on that front, sir? We are done with royalty FTS also. Ori Baba, sir, royalty FTS also done. Yes, sir, royalty FTS also done. Oh my God. Let's do it a bit more quickly. Sir, if any of the non-resident earns any kind of casual income, for example, they earn any kind of income on account of lottery, horse racing, sir, it is taxable at 30%. No deduction of any expenditure would be given to them. Oh my God, sir, very easy. It is also done. Sir, if any of the non-resident earns any kind of gains on unlisted securities, listen. If any of the non-resident earns any gain on unlisted securities, sir, remember this is given under Section 112. Section 112, it is given that before 23rd July, sir, they will be taxed. They will be taxed at the rate 10%. They will be taxed at the rate 12. They will be taxed at the rate 10%. Sir, no indexation benefit given. And after 23rd July, they will be taxed at the rate 12.5%. No indexation benefit given, and sir, no 1.25 lakh benefit given to them. This is not given as per sir, other provisions of international taxation. It is simply given in 112. We had studied this in capital gain topic also. Whenever a non-listed or foreign company earns in unlisted securities of India, sir, they are being taxed at the rate of 10%, and they are being taxed at the rate of 12.5% before 23rd July and after 23rd July respectively. This is the simple, obvious tax rate that is being given. Sir, nothing special given in this chapter. This is already given in capital gain topic on. Oh wow, sir. That means this also done. Only sir GDR is left and only sir interest is left. Then we are done with the chapter. Yes, we are done with the chapter. Oh wow, sir. You did not think of it. Oh wow. So GDR taxation. See, Section 115 AC prescribes about taxation of GDR, and it also prescribes about bonds which are foreign currency convertible bonds, foreign currency exchangeable bonds. See, normal bond taxation is as good as loan. Whatever the loan that has been given to India, sir, it is taxation of bond would be as simple as like a loan. But sir, if you are given foreign currency convertible bonds, foreign currency exchangeable bonds referred under Section 115 AC, or if you are given GDR, then sir, you have to use the following method. Sir, if you have any kind of long-term capital gain on bonds or GDR, you will be taxed at the rate 10%. If you are having any long-term capital gain on GDR, sir, after 23rd July, sir, you will be taxed at the rate of 12.5%, and sir, no benefit of 1,25,000 would be given to you. No benefit of 1,25,000 would be given to you at all. In any case, you will not be given any such benefit. Sir, if you are having any short-term capital gains, so that shall be taxable at the rate of slab in either of the cases. Sir, if you are having any income from the GDR, so that will be taxable at the rate 10%. This we had already studied while understanding the dividend from GDR. No indexation would be allowed, no Chapter 6A benefit, no expenditure against any income. Sir, GDR, whenever you have GDR outside India, sir, you will have two capital gains at there. You will have two kinds of capital gain. First, capital gain would be applicable from the acquisition of GDR till the date of request for conversion is made. Second capital gain would be request for conversion till actual sale. So two capital gain would arise in case of GDR. Sir, we have this point. Sir, whenever we have a non-resident who sells any kind of GDR, who sells any kinds of bonds, who sells any kind of rupee denominated bond, who sells any kind of municipal securities to any non-resident, sir, capital gain in India would be exempt. Capital gain would be exempt in India. Sir, if any non-resident sells any kind of bonds, GDR, rupee denominated bond, and government securities to any of the person located in IFSC, sir, it would be exempt. Sir, if any of the non-resident sells such things to resident of India, if any of the non-resident sells such thing to the resident of India, or if such non-resident sir redeems such things, then only taxability under these sections would arrive. Sir, remember, non-resident selling bonds, RDBs, GDRs, or any kind of municipal securities, that is exempt. Capital gain on account of them will be exempt. So this was taxation of GDR. Moving forward to taxation of interest, the last and the most beautiful topic of the session. So taxation of interest under section 115A, what it says. Sir, if you receive any kind of interest from business trust, sir, 5%. If you receive any kind of interest from business trusts, are taxable simply at the rate of 5%. Sir, if you receive any kind of interest from infrastructure debt fund, sir, taxable at the rate of 5%. These are simple points. Sir, if non-resident receives any kind of interest on account of loan, bonds, debentures, rupee denominated bond, sir, any kind of loan related things, sir, that loan will be taxable at that interest will be taxable at the rate 20%. That interest would be taxable at the rate 20%, sir. You have to make sure that interest is taxable at the rate 20%. Sir, there is a catch. Sir, such loan shall come to India in the form of foreign currency. Many of the times in exams you are being asked, sir, if there is a foreign person who gives technical services to India and in return, sir, Indian company issues debentures against it and offers interest. Sir, any interest issued against any debentures issued against the technical services is a kind of loan, but sir, it is not the loan in foreign currency. Only the loan which has foreign currency inflow in India, interest on such loan shall be taxable at 20%. Otherwise, sir, it shall continue to be taxed at 35% in the hands of foreign company. So remember, whenever foreign company earns any kind of dividend, whenever foreign person, for non-resident foreign company earns any kind of interest, and sir, interest is being paid on account of loan being issued on account of technical services. No foreign currency inflow has taken place in India. Provision says it shall be taxable at the rate 35% only. No 20% benefit would be given. So there is a old provision, very old provision, sir, very old provision. Provision says if you have taken loan, if you have taken long-term loan agreement, if you have bought long-term bonds, if you have bought RDBs prior to 23rd June, prior to 23rd June 2023, prior to 23rd June 2023, such long-term loans, such long-term RDB, such long-term bonds will be taxable at the rate of 5%. After that, sir, 20%, 20%, 20%, 20%, 20%, 20%. Also, sir, if such long-term bonds, RDBs, are listed on recognized stock exchange, earlier they were not being charged 5, rather they were charged 4%. Later on, sir, they are being charged at the rate of 9%. This is the taxation of interest. This is the taxation of interest, and that holistically covers every topic of your tax rate. That holistically covers your interest portion. That holistically covers your GDR portion. That completes your entire topic. Sir, not that we are done with the topic. Sir, we are left with only 2 or 3 adjustments that I need to tell to you before completing this entire chapter. Sir, for example, if we have any kind of non-resident company, who has branch in India, who might have some branches in India, provision says if such company has branch in India, if such foreign company has a branch in India, then what would happen? Provision says that foreign company would be unnecessarily accruing the expenses. That foreign company would be unnecessarily allocating the expenses to Indian company to reduce the profit of India. So for that matter, sir, whatever the expenses that are being allocated by the foreign company in India, so that will not be allowed blindly. Only a limited portion of the interest would be allowed. Only limited portion of the expenditure would be allowed. And sir, what that limited portion imply? Sir, for that matter, we have to find out. Sir, 5% of the adjusted total income or actual head office expenses, whichever is lower, would be allowed to us. 5% of the adjusted total income or actual head office expenses, whichever is lower, will be allowed to us. Sir, we got this point. Sir, what do you mean by adjusted total income? Provision says, sir, find out the total income of the PE. Total income as per PGBP provision, sir. For the finding of the total income, sir, you might have to do certain adjustments, sir, VRS adjustments. You might have to do certain adjustment like applicant adjustments. You might have to do certain, sir, TDS expenditures, sir, cash payment expenditure, whatever the cash payment you have made disallowed. Sir, whatever the payments you make, sir, you have to find out the total income of the PE and you have to find out the total income as per PGBP provisions. Hello, Shakti. After finding out the total income of the PGBP, total income of the PE, sir, we have to do 5 adjustments. Sir, 5 adjustments imply, sir, any head of expenses debited to P&L, sir, add back. Any unabsorbed expenditure, sir, unabsorbed depreciation, add back. Any capital expenditure on family planning, sir, add back. Any brought forward loss, unabsorbed depreciation, sir, add back. Any deduction under Chapter 6, say, add back. Sir, 5 things. Head office expenses, add back. Any kind of Chapter 6 deduction, add back. Any unabsorbed depreciation, add back. Any loss debited, any kind of loss, sir, add back. And at last, any family planning expenditure is to be added back. This would give us adjusted total income. Of this adjusted total income, sir, 5% shall be allowed. Shakti, just after this, we'll discuss this. Sir, for example, sir, this after doing all the adjustments, sir, ATI turns out to be negative. Sir, in that case, you have to take the ATI of last 3 years, average of last 3 years, not this year, but preceding 3 previous years. You have to take ATI. Then only, sir, your ATI will work out well. Sir, we got this point. This is how we have to calculate. We'll do a question. We'll understand this provision more in depth. Sir, 2 more concepts to be told. Sir, for example, sometimes what happens is there is a foreign company. There is a foreign company which is a non-resident company. Foreign company, it is non-resident company. Sir, because of its POEM coming to India, sir, this foreign company can become resident. Yes. This foreign company is a non-resident company, but because of POEM, sir, it become a resident. Sir, what happens is now, for example, we have Rahul with us. Rahul wants to pay professional fees of ₹1 lakh. He wants to deduct TDS under 2 sections. Sir, whether 194J would be applicable or section 195 would be applicable. See, if this foreign company is a resident person, then in that case, sir, 194J should apply. But since this is a foreign company, sir, 195 should apply. If foreign company becomes resident, so it might be possible that multiple sections of TDS would apply simultaneously. Provision says whenever a foreign company becomes resident of India, so in that case, sir, whatever the provisions that pertain to foreign company would apply, sir, resident person would not apply, foreign company provisions would apply. That means TDS would be deductible under section 195. Many times what happens is, sir, for example, we have a foreign company. Foreign company was non-resident and it was having sales of ₹100 crore. It was having profits of ₹40 crore. Okay. So this foreign company became resident and sales taxable in India became 200 crore and profit got reduced to 30 crore. Why, sir? Why profit got reduced? Sir, it might be claiming more depreciation from the assets outside India. It might be claiming more losses from other entities because of it, sir. Earlier it was resident. So earlier it was non-resident, sir. It was paying taxes on 40 crore. It was non-resident and paying taxes on 40. Now it became resident and now it is just paying taxes on 30 crore. Do you think that government is going to allow that? Right answer is no. Government is not going to allow this. Sir, you have to pay minimum of the taxes. Minimum taxes you have to pay. Whatever the minimum taxes that have been kept for a non-resident company. If you were non-resident, whatever the minimum taxes you were supposed to pay, you have to pay those taxes even if you become resident. Sir, Remember. Sir, tax rate shall apply 35% only. Sir, even if you were non-resident, now you became resident, sir, that would only change the scope of total income. Earlier, your Indian income was only taxable. Now your entire world income would be taxable. Sir, that would only change. The tax rate would continue to apply at the rate of 35%. Sir, there is another provisions of, for example, an Indian branch, for there is a foreign company who has an Indian branch and that Indian branch is being converted. Is there any Indian branch? If there is a foreign company who has an Indian branch, the Indian branch is being converted into subsidiary. So there happens to be a transfer provision says whatever the transfer takes place, so that is an exempt transfer provided that certain conditions are to be satisfied. Certain conditions are to be satisfied. So these conditions you might read. I think very less chances are being asked. Very less chances of this might be asked. One condition to be fulfilled: this foreign company, whoever has the branch in India, converts into subsidiary, shall continue to hold at least 51% of the shares till the 5 years from the end of the year of transfer. Shall continue to hold the 5 years, otherwise everything is similar what we had studied amalgamation topic. So also we have another very small topic, very small topic, that is, sir, eligible fund manager. For example, we have very big funds. We have big funds like outside India, like BlackRock. Sir, BlackRock might have many fund managers. Sir, he might be having fund manager in Africa. He might be having fund manager in United Kingdom. So this investment fund might be having multiple fund managers at multiple places. So similarly, that fund manager might be having fund manager in India also. Sir, can government of India say that this fund manager is an agent to this fund? Can government of India say that this this fund manager is an agent to this fund, and whatever the income that is on account of this agent, this fund manager would be taxable in India? Do you think that it is logical? If fund manager is in India, do you think that entire fund will become taxable? Whatever the income that fund is earning is becomes taxable? Right answer is ideally it should become taxable. But sir, there are certain conditions. If that fund is eligible fund, that fund manager is an eligible fund manager, then this fund manager would not constitute any business connection. Sir, you don't need to read these points. You don't need to reach this point. You just need to understand that if fund is eligible fund and fund manager is eligible fund manager, then in that case, sir, whatever income that is being earned on account of this fund manager will not become Indian income. That is the only point you need to refer. Otherwise, sir, this point is long. This point is not very much sensible. Sir, that completes our non-resident taxation. That really completes our non-resident taxation. Sir, I want you all to come on to super 100 questions and solve questions along with me. There are certain questions that we must refer before referring to other chapter. Sir, let's come to that chapter. In the Super 100 PDF, come on to question number 96. Come on to question number 96. Sir, we have 4 or 5 questions to be solved. Then only we can move on to next chapter. Sir, listen. Mr. Joseph is a non-resident and person of Indian origin. Oh my God, sir. Oh my God. Non-resident and person of Indian origin. Sir, can I simply say he is an NRI? He is a NRI, sir. He is a NRI. Oh yes, sir. He is a NRI. Age 49 furnishes you the following information. He sells listed equity shares. Sir, listed equity shares. So shares of Indian company. It is a forex asset. It is a forex asset. Long-term capital gain prior 23rd July. Sir, 10%. After 23rd July, 12.5%. Okay, sir. So that will meet. Sir, it long-term capital asset sold on 31st May. Sale price 6 lakh. Cost of acquisition 1.1 lakh. And sir, expenditure 50,000. Oh my God, sir. This is a kind of for a forex asset capital gain. Full value of consideration would be 6 lakh. Transfer expenses would be 50,000. And sir, cost of acquisition would be 1.1 lakh. So this would give capital gain equal to sir 4.4 lakh. This 4.4 lakh would be taxable at the rate of 10%. So no 1.25 lakh benefit would be given. See, if NRI is opting for optional provisions, no 1.25 lakh benefit would be given to it. But sir, if NRI specially opts out of the provision, opts out of the regular provision, sir, in that case, he shall be given benefit. So we have to check whether he is opting for optional provisions or he is not opting for optional provisions. Okay, let me see. You are required to compute the total income of Mr. Joseph and gross amount of tax payable in accordance with the special provisions. Oh, Joseph has opted out of default tax regime. Sir, he is opted out of default tax regime. Okay. He has no other income. Okay, TDS deducted wherever applicable, sir. Okay, sir. Simple point it is. He has opted for, he has not opted for, he has not opted out of, first of all, special provisions of NRI. He is being governed under special provisions of NRI. Plus, he is paying taxes under regular regime, that is up to 2.5 lakh, no tax, 2.5 lakh to 5 lakh, 5%, 5 lakh to 10 lakh, 20%. That is what tax rate he is paying. Okay. Sir, interest on government securities net of TDS, sir, 81,000. Oh, sir, interest on securities, sir, 81,000. Since it is net of TDS, sir, we have to gross it up. And sir, how much after grossing up would turn out to be? Sir, or remember, interest on securities in case of non-resident is not deductible at the 10%. Sir, it is deductible at the 20% plus 4%. That means, sir, we have to gross it up by 100 minus 20.8%, which implies, sir, 79.2% is the division rate that has to be taken for grossing it up. Sir, do not divide it by 90%, otherwise you will get wrong answer. Whatever the interest on government securities is being paid by the government to the non-residents, it is deductible at the rate of 20%. Okay, sir. Okay. Interest on deposit with public companies, sir. Public company interest has to be taken grossly. Sir, what the interest amount in case of this government? What amount of interest that is taxable in accounts of this government securities, sir? 10272272. Okay, sir. So interest on deposit with the public limited companies, sir, 3,25,000 will be taken wholly. Sir, whatever expenditure you have incurred, sir, will not be allowed. Interest on deposit with private limited companies, sir, private limited companies are not forex asset. Sir, whatever the interest you earn, that will be taxable at the rate of slab. Sir, fresh investment. So fresh investment listed companies, so 220. That means this capital gain would be exempt to certain limit. So this capital gain exemption would apply. Exemption under section 115F would apply. Whatever the capital gain is multiplied by cost of new asset divided by net consideration. Capital gain is, sir, 4.4. Listen to this point. Huh? Net consideration is 5.5. New asset is 2.2. Capital gain exempt would be 4.4 divided by 5.5 into 2.2. 1.76 is the amount of net consideration to be reduced. Oh, sir. So 2.64 would be capital gain taxable, and that would be taxable at the rate of 10%. That is how things would go. And so after that, we have to add surcharge if it all is applicable. 264, interest 122, 273, 325, 555. If you ask me tax rate, capital gain will be taxed at 10%. Investment income 102, 273 plus 325 would be taxable at the rate 20%, and other income will be taxable at the rate of slab. Add education cess, you will get the tax. Come on to next question. Question number 95. Question number 95, what it says. Are Baba, even after at this point, if you have not liked the video now, you will. Even after this much, you have not liked the video. You don't want me to succeed now? You really don't want me to succeed now? Got it. Then later, sir, we have liked the video. We have liked the video. Sir, question number 95. Net results of the business carried on a branch of a US-based foreign company in India for the year ended was, sir, loss was 28 lakh rupees. See, foreign company had a branch in India. That branch had a loss of 28 lakh rupees. Sir, loss of 28 lakh does not imply that branch is having PGBP of this 28 lakh. This is not the total income of the branch, sir. We want total income for the purpose of head office expenses. After charging, see, 28 lakh is after charging depreciation for the current year, sir. Okay. Unabsorbed depreciation. Okay. So short-term cap loss. Are Baba, who you tell me, whenever we calculate total income, from when did we start reducing the capital losses? From when did we start reducing capital losses from this total income, sir? Never. Capital losses are never reduced from total income. Short-term capital losses are never reduced from total income unless we have short-term capital gain, long-term capital gain. We never reduce this capital gain. So this is not allowed. This has to be added, sir. This has to be added. To calculate the PGBP, to calculate the total income of this branch, sir, we have to add this now. Okay, sir. Expenditure for incurring VRS expenditure, sir. VRS is 12 lakh. Sir, VRS entire 12 lakh has been debited. But while calculating the PGBP, only 1/5 should be allowed now. Only 1/5 should be allowed now. Sir, rest 9.6 lakh should be disallowed. So for calculating the PGBP, sir, 9.8 lakh should be disallowed. So speculative losses. Arey Baba, from when did we start reducing speculative losses while calculating PGBP? Unless we don't have speculative income, we never reduce speculative losses. So, bhaiya, if this has been added, this has been reduced, add it back. It will not be allowed. So deduction, it is allowed. It is allowed. So head office expenses, sir, it is allowed. Sir, this will give us total income 28 lakh plus 15 plus 9.6 plus 17. 13.6 would be our total income. 13.6 lakh would be our total income. We have to carry out 5 adjustments. Those 5 adjustments that I have listed down, sir, unabsorbed depreciation, sir, losses, whatever that you have, sir, you have any kind of head office expenses, any kind of chapter 6 deduction, any kind of family expenditure, family promotion expenditure. So unabsorbed depreciation, whatever you have, sir, add back 18 lakh. Sir, whatever capital losses that you have, sir, add back. So add back. So any kind of speculative losses you have, sir, add back. Any kind of deductions that you have deducted, sir, add back. Any kind of head office expenses that you have, sir, add back. Did I do any mistake here? Arey yaar, this I did some mistake here. This is not 15 lakh. This is 1.5 lakh rupees only. 28 lakh minus 1.5 plus 9.6 plus 17 would give us loss of just 0.1 lakh. 0.1 lakh is the gain. Then in that we have to add 18 plus 1.5 plus 17 plus 29 plus 165. If you check the answer, see, 18 lakh is to be added. Then 18 lakh is to be added. We have added 18 lakh. Yes, sir, 18 lakh we have added. Unabsorbed depreciation is added. So 1.5 lakh is added and 9.6 lakh is added. 1.5 lakh, 9.6 is added. 1729 is added. 1729 is added. 17, I by mistake I added twice, so that is not to be added. Okay. 169, 165 is added. If we do the totaling, we would get 212, 126. Answer remains the same. Answer remains the same. Sir, we are given ATI of 3 years. Sir, not to be considered. No, sir, if ATI is positive, if adjusted total income is positive, whatever the adjusted total income we have, sir, what did we arrive? 212, 1000, 212, 1234. This is the ATI we arrived at. Sir, since ATI is positive in itself, sir, why are we going to take the average of the 3 years? Sir, if ATI is already positive, why do we have to take the average? We don't have to use this information at all. We have arrived to ATI. Take 5% of it. We will be allowed deduction. 5% of it would be given to us deduction. It was a simple question. But only thing that people misunderstand while solving is, sir, they forget to calculate the total income. They forget to calculate the total income. That is where most of the answers go wrong. Sir, okay, we got your point. So then we have a question. Then we have another question, sir. Sir, Trex Limited is a company incorporated in country D. The following incomes relate to India. Compute the total income and tax liability of Trax for the assessment year, assuming that POEM is outside India. POEM is outside India, sir. Okay. So Trax is the company located outside India. Okay, sir. It is a non-resident company, so only Indian income would be taxable in India. Only income that is Indian income would be taxable in India. Interest of 285 earned on debentures of rupees 30, debentures of 30 lakh issued on 1st August 2024 in consideration of technical know-how in the Indian company for the purpose of business carried out in India. This foreign company provided technical services, and against that, sir, it is receiving dividend. Against that, it is receiving debentures. So the debentures would be taxable at the rate 20% because it is a kind of payment of fees for technical services only. And this interest would not be taxable at 20% because, sir, interest is being paid against the FTS. Therefore, sir, no foreign currency inflow has taken place. So, sir, this dividend would be taxable at 30%. Sir, I'm highlighting this point just for you all. Dividend of 650 earned on GDR, sir. Whenever you earn any kind of dividend, sir, that is taxable at the rate of 10%. Whatever the dividend you earn, sir, it's taxable at the rate of 10%. Sir, dividend of 15 lakh 50,000 earned on Indian securities, sir. Dividend on Indian securities is taxable at the rate of 20%. Sir, ठीक है. Royalty, by the way, royalty earned, by the way, amounting rupees 12 lakh 56,000, 12 lakh 56,470. This is the royalty received. This is the amount of royalty received in net of TDS. So, bhaiya, we have to gross it up now. 79.2% is to be grossed up. 15,125,6,470 divided by 79.2%. Royalty received would be 15,86,452, and we would apply 20% tax to it. We would apply 20% tax to it. Okay, sir. Then we have business income of 850, sir. Whatever the business income is received, sir, it is taxable at the rate of 35%. We are already aware. Sir, we have long-term capital gain. This foreign company is having long-term capital gain on unlisted securities. Okay, sir. With indexation, benefit is 132. Without indexation, long-term capital gain is 232. Sir, do we get any indexation if any non-resident foreign company earns any kind of capital gain income from India? And sir, that capital gain is on unlisted securities. Sir, don't you think that is being taxed at the rate of 10% or 12.5%? Right answer is yes, sir. That is being taxed at the rate 10 or 12.5%. In that case, sir, this would be taxed at the rate of 10%, sir, since it is being sold prior to 23rd July. So capital gain at the rate of 10% would apply on this. Sir, whatever the tax rates that I have mentioned, just try to solve the question by multiplying the tax rates. Let's see, and add 4% education cess to it. You will get the answer. Just let me try solving it. 285 multiplied by 35% and plus 30 lakh into 20% and plus 650 into 10% and plus. So 1,586,452 into 20% and plus 1,550 into 20% and plus. So 850 into 35% and plus 232 into 10% and plus double MRC into 1.04. So according to me, taxes should turn out to be 1781250. 1781250. That is how you have to calculate taxes in this foreign company. See, there every provision that you have studied now, which is a bit complicated, has been tested in this provision. Similar question, sir. Vioni is a foreign company. See, simply I'm just turning it to the solution, turning it to the original question. Sir, question number 93. Vioni Inc. is a company incorporated in Japan, is engaged in development of infrastructure and providing consultancy in the same field. Okay. It is Japanese based, sir, Vioni. During the year, shareholders had met 2 times to discuss the modification in the rights. Sir, whenever shareholders meet, sir, shareholders meeting is irrelevant for the purpose of poem determination. Sir, this company is deemed to be non-resident. Okay, sir. Sir, dividend declared by Miyani, a Japanese-based company, 540. Sir, this is a Japanese-based company, Miyani, and it is giving dividend to Vioni. Sir, a non-resident company is declaring dividend to non-resident company. Sir, Miyani holds 70% of the total assets in India. Oh, this Miyani is a company. Which is deriving its value from assets located in India. This foreign company is deriving assets from located in India, and this foreign company is declaring any dividend. Sir, this dividend is not taxable in India. Okay, sir. Fees for technical services on account of government. Okay, sir. Whatever fees for technical services is, sir, that will be taxable at the rate of 20%. Okay, sir. Government utilized for the project carrying out in Nepal. Sir, government, whenever paying any kind of fees for technical services, using service anywhere in the India, sir, that is always taxable. Sir, interest received on account of IFSC unit, sir, not taxable. Sir, Vioni sold capital gain, sir, that shall be taxable. Sir, that shall be taxable. No issue whatsoever. That capital gain shall be taxable under section 112A. Sir, simple question it is. You are required to compute the total income, no taxes. Sir, you will be able to solve it beautifully. You will see whatever answer that I say now have been given in the solution. What else question you can solve? Sir, this is a good question. Sir, this is the question based on indirect transfer. Sir, for example, there is an Indian company XYZ. Engaged in the business of manufacturing and packaging of the manufacturing facility in India. XYZ company has a wholly owned subsidiary Flix incorporated in country M. So XYZ is the wholly owned subsidiary. So for example, Flix, there is a company in country M which holds 100% shares of XYZ. Flix holds 100% shares of XYZ. So take care. Angelo and James, citizen and resident of country M. Angelo and James, these are citizen of country M. So they hold 50-50% in Flix. Okay, sir. What this says, sir. Angelo and James have invested their money rupees 100 crore. Angelo has invested 100 crore. James has invested 100 crore. Okay. Okay. They both had invested 100 crore in April. Angelo and James sold their offer shares to Ishan. Sir, he sold to Ishan at 350 crore. James sold these shares to Ishan at 350 crore. Okay. So this sale was made on 1st June 2024. Sir, ultimately this foreign company is being sold. Foreign company is being sold. We are aware that whenever a foreign company is being sold, we have to check whether such foreign company derives substantial value from asset located in India. If such foreign company derives asset value from assets located in India, then in that case, such foreign company shall be deemed to be located in India and capital gain would be taxable in India. No, that is to be checked. Okay, sir, we'll check that. Accounting year, sir, balance sheet, sir. So this company follows the accounting year. This Flix follows the accounting year. First of all, sir, balance sheet date is 31st December 2023. And transfer date is 1st June. So, sir, whatever the date comes thereafter is irrelevant. Sir, what we need to check? Sir, first step. We have to check, we have to identify the valuation date. On which date we have to do the valuation. For identifying the valuation date, sir, we have to check the date of balance sheet and we have to check the date of transfer. We have to check the book value of the assets of the Flix. Sir, book value of 1,000, book value is 1,000 crore on case of balance sheet date. And book value turns 1,300 crore on the date of transfer. So increase is exceeding 15%. Increase is exceeding 15%. Therefore, sir, balance sheet date becomes irrelevant and transfer date becomes relevant. Whatever the valuation is to be done in case of transfer date. Sir, got it. Sir, once valuation date is identified, we have to check whether, sir, FMV of Indian assets without liabilities divided by FMV of total assets without reducing liabilities, sir, whether it exceeds 51% or not, whether it exceeds 50% or not. So in that case, plus Indian assets exceeds 10 crore. In that case, sir, such foreign company would be deemed to be located in India. Sir, FME of Indian assets would imply, sir, FME of XYZ company. So it is given in the question. Without reducing liability, it is 600 crore. Total assets FMB is 1100 crore. So all in all, sir, 600 divided by 1100 is the value of Indian assets, which imply out of 1100 crore of total assets, 600 are Indian assets, which imply, can we say that 54.54% of the total assets are located in India? So whatever capital gain this Angelo earns, sir, 250 crore. Whatever capital gain this James earns, 250 crore. So out of this capital gain, sir, 54.54 crore would be taxable in India. And that is what your answer must have mentioned. This is only mentioned in your answer. So you can skip out this question. So this is a question given for ABOI test check. Just try to solve it along with me. Last question for the day, and after that we'll switch to next topic, sir. Singtel is a company incorporated in Singapore. Sir, Singtel is a company of Singapore. Singapore-based company it is. So 55% are being held by Godavari. So Godavari is an Indian company. It holds 55%. Sir, whenever a parent company is situated in India and subsidiary is situated anywhere outside, just because parent company is in India would not make this subsidiary company resident of India. This would not make the subsidiary resident of India. We have to check for ABOI test, sir. We will check. Sir, first of all, coming from the bottom, sir, payroll expenditure. India payroll expenditure is 8 crore. Total payroll, Singaporean payroll expenditure is 12 crore. So total payroll expenditure is 20 crore. Out of that 20, sir, 8 is only located in India. That means that 40% is only payroll expenditure in India. So less than 50% of the payroll is in India. Payroll expenditure, sir, satisfying. Payroll expenditure satisfying, sir. We have to check for ABOI test. So number of employees, sir, Indian employees are 70 and Singapore employees are 90. So total employees would be, sir, 160. And out of this 160, sir, 70 would be Indian. 17 would be Indian. Sir, this implies, sir, employees condition would also meet. Oh, wow, sir. Oh, wow. We are enjoying this. Literally, I had never thought. Sir, asset condition, sir, Indian assets, fixed assets are 120. Indian intangible assets are 50. Indian other assets are 40. All in all, Indian assets are, sir, 210. Singapore fixed assets are 80, Singapore intangible assets are 200, Singapore other assets are 220, which would imply 400 is total Singaporean assets. Total assets would turn out to be, sir, 610. Out of that, 210 would be Indian. Therefore, sir, less than 50% of the assets are located in India. So three conditions continuously met. Sir, now we have to check for passive income. Sir, income from trading operations is 250. Income from trading operations in India is, sorry, in Singapore is 50. So of this trading operations, we have, sir, sales from purchase, sales and purchases from unrelated party, sales to related, where sales are to associated but purchases from associated. So purchase and sales both are to associated price. So this would be passive income. Okay. Interest dividend would be passive income, sir. This would be passive income. So, sir, we said out of the total income, out of the total income, 50% should be passive income is allowed. 50 up to 50% of the passive income is allowed. If it exceeds more than 50%, then ABI test is failed. So, sir, total income would be equal to this 25, 15, 20 plus 15. Total income would be total of all the four circles that I have made in blue. Whatever the trading operations are, whatever the other incomes are, sir, total income would be 110. Out of this total income, sir, passive income would be sales and purchases from associate plus all the interest dividend income. All this total would be passive income. 5 plus 10 plus 20 plus 15. So passive income would be 15, 50. So this implies passive income is up to 50% only now. Therefore, passive income criteria is also fulfilled. Therefore, so this company would be bound to have meeting the ABI test. Whatever the assets are located is bound to be located outside India. Whatever the poem is outside India. Also, sir, we have board of meeting which says out of the board meetings, sir, 5 are held outside India. Therefore, majority of the board meeting also held outside India. Therefore, this company is bound to have poem outside India. Sir, are we clear on this front? Sir, done with this question. Done with NR taxation. Sir, personally, I think it took more time for me to complete and it took more than expected time. But sir, it is worth it. Whatever we had studied, now we studied with conceptually. Even if you have not studied well previously, you will be able to understand it. So, any doubt up to this point? Any doubt up to this point? Break. It's 12:40. Break till 1 p.m. Okay. See you guys after the break. We'll resume after the break. Meanwhile, you cannot use your mobile phone. A humble request to you all. Second thing, sir, if you have any other friend who wants to join this section, ask him to join immediately because after break we'll start with transfer pricing. So that major portion of your syllabus could be done in this 6 or 7 hour session only. See you guys after the break. So, guys, welcome back from break. Hmm. Are you all back from break? Are you all back from break? Sir, absolutely. We did not go to anywhere. Okay, sir. I got your point. See, before going to break, we completed off with NR taxation and also we did the question answers, respective question answers also. Sir, after NR taxation, sir, next topic to be discussed here is transfer pricing. Before starting off transfer pricing, again a humble request, share it with your friends who also need to understand the things in English. So can you please share the concept notes? Karthik, right now I'm not allowed. Let me talk to team today. If they allow me, I will share these notes with you all. Whoever wants it can use it. Sir, you can share them. I can share it. Okay. If let me ask team first. If they allow, I will share. Okay, perfect. Sir. Sir, what did we cover before break? Sir, we covered break. We covered non-resident taxation before break. Right now, we have to start with transfer pricing. If you have any friend who wants to cover it live, do ask him. First, we cover it in more elongated manner, in more descriptive manners. Sir, transfer pricing, what it says. Sir, any kind of international transaction you do, any kind of international transaction you do, any kind of domestic, specified domestic transaction you can do. Sir, if you are doing such transaction with your associated enterprise, then such transaction should be done at arm's length price. What these provisions say is very simple things. These provisions say, sir, if you are doing any kind of international transaction or if you are doing any kind of specified domestic transaction, such transaction done with associated enterprise should be done at arm's length price. Now, first of all, is what important definition is what is meant by associated enterprises. When two enterprises are said to be associated enterprises, sir, we need to understand that first of all. For example, if any of the enterprise one holds at least a 26% or more in other enterprise, it is said. I know Karthik, I will talk to team once. If they permit me, I will be sharing them. I have no issue in sharing, but I am bound by organization's policy, so I have to follow that. I will ask the team if they permit me. For sure, I will be sharing it today only. Okay. Sir, if one person holds at least 26% in the 26% in the other entity, it shall become associate. Sir, for example, Mr. A holds 33% in B, A and B are associated, B and A are associated. Sir, if A holds 33% in B and B holds 90% in C, can I simply say directly, indirectly, sir, A holds at least 26% in C? Right answer is yes, sir. In that manner, sir, I can say A and C are also associated. Sir, we got this point. Second thing, sir, for example, we have Mr. Uday Kotak. We have Mr. Uday Kotak. Sir, Uday Kotak holds 30% in Kotak Mahindra Bank, and sir, Mr. Uday Kotak holds 40% in Kotak Securities. If one person holds at least sir, 26% in two organizations, provision says all the two organizations shall become associated enterprises. Sir, we are clear at that point. Third point, if one person if one person holds 26% or more in other organization and the other person holds 26% or more in or other organization and such one person and two person are family members, then in that case, sir, organization one and entity two will become associated enterprises. Okay, sir, we got your point. We got your point, sir. Third thing, sir, fourth thing. Sir, if one organization is being controlled by HUF, sir, HUF controls the entity one and member one, member two, member three of HUF, so jointly or individually holds 26% or more in entity two, then entity one and entity two shall be associated enterprises. Either member one can hold the entire 26% shares or jointly they hold 26%. In that case, they shall become associate. Yes, sir, they shall become associate. Sir, if any of the person has power to appoint, sir, more than half of the board, more than half of the board of director of the entity one, or he has power to appoint greater than or equal to one executive director. See, either half of the board he can appoint, sir, more than half of the board, sir, more than half of the board, even half of the board is not eligible. Sir, more than half of the board shall be appointed, sir. In that case, that shall become associate. Or sir, if he has power to appoint one or more executive director. Sir, in board of director, we have greater than sign. In executive director, we have greater than equal to sign. Both the conditions, may say either of the condition has to be satisfied. Any person has power to appoint, or if any entity has power to appoint, then they shall become associate with each other. Sir, sometimes what is being asked, sir, sometimes, for example, person one can appoint, sir, two executive director in entity one, and person one holds 26% or more in entity two. Sir, can they be called associate? Right answer is no, sir. This is not the condition prescribed anywhere. Sir, you have to fulfill the conditions that are being given. Two of your associates that need not necessarily be associates in itself. Two of your associates need not to be necessarily associates in itself, sir. We need to understand this fact. So we got this point. Sir, for example, fifth point, for example, we have two people called Rahul and Rachel. Rahul, sir, you must remember these names throughout the chapter. Rahul is always resident for our example, and Rachel is always non-resident for our example. Sir, whenever loan is being given by the non-resident, whenever any person gives you loan and loan given by such person exceeds 51% of total book value of your assets, total value of your assets, sir, if it exceeds, then in that case, sir, such person shall be considered as an enterprise. For example, sir, if I have total assets of rupees 100 crore, and out of that 100 crore, such 60 crore loan is being given by Rachel only. I have 100 crore worth asset, and out of that 100 crore, 60 crore loan is being given by Rachel only. Provision says Rachel will become your associate. Rachel will become your associate, sir. If more than 50% of the book value of the asset are being given of the loan, if the loan worth of 51% or more of the total assets is being given by one person, in that case, sir, such other person would become your associate. Sir, for example, if I do some chota panti, if I do some intelligence work and I revalue these assets to fair market value, and sir, revalue it to 130 crore, in that case, a loan given by this person would be less than 50%. Provision says, munna, na, you have to take the book value of the total asset. You cannot take the fair market value or revalued value of the assets. You have to take the book value of the assets. Sir, we got your point. Sir, what you have to check? Sir, loan given by one person shall not exceed 51% of the book value of the total assets held by one person. If it exceeds, then these two shall become associated enterprises. Sir, we got this point. Sir, whatever the loan I have, for example, Rahul has whatever the loan, say 100 crore. Sir, if anybody gives guarantee, to this loan exceeding 10 crore, provision says such person shall be deemed to have, your associated enterprise. You both will become associate. If somebody gives guarantee worth 10% or more of your entire loan, such other person shall become your associated enterprise. Such other person shall become your associated enterprise. Sir, are we clear on that front? Yes, sir, we are absolutely clear on that front. Sir, for example, Rachel knows how to make tea, and she makes such a tasteful teas that whenever I drink it, I somehow get mesmerized. So I took the patent. And started a tea brand in India. Provision says if your business is wholly or mainly dependent upon patent, copyright, know-how of a non-resident, provision says such non-resident shall become your associate. You shall become non-resident of such associate. Sir, we got that point. Third point, what it says? Sir, it says, if out of the total purchase cost, see, for example, this is Rahul, whatever the total raw materials that I'm using, sir, for example, 100 crore raw material I'm using, and out of this total raw materials that I'm using, sir, 90% are being supplied by Rachel only. And sir, the other person has power to negotiate the other conditions also. See, if 90% of the raw materials are being supplied by single person only, and he has the power to negotiate the other conditions, don't you think that person should become our associate? Right answer, yes, sir, such person shall become our associate only. Sir, you must remember, if any of the non-resident who supplies 90% of your raw materials, and sir, he has power to negotiate the other conditions, that shall become your associate only. So other than that, if you are selling to anybody, if you are selling any goods to anybody, if you have power to determine the prices and if you have power to determine the other conditions, then that other person shall become associate. Sir, we are very much clear on that point. Sir, at last, the last condition says, sir, for example, if any of the person one has interest in the form of partnership profit sharing ratio or AOP profit sharing ratio, so exceeding 10% in any other entity. For shareholding, we have to check at least 26% of the shares held. But sir, in case of partnership firm, profit sharing ratio is to be checked for 10% only. If any of the non-resident has exceeding 10% profit sharing ratio in Indian partnership firm, such non-resident shall become our associate. If we have 10% or more profit sharing ratio in other partnership firm outside India, sir, that entity shall become our associate. Sir, for partnership firm profit sharing ratio, you have to check the limit of 10%. If we hold at least 10%, in that case, such person will become our associate. So at last we have so any other relation as any other mutual relation as may be prescribed. Sir. Can you all repeat with me, sir? Can you all repeat with me, sir? Can you all repeat with me, sir? Why not? Why not, sir? We will repeat with you. Whatever book you are following, dear, whatever book you are following, that book has the same Act. Sir, section 92A, associate interest, A for associate, A for associate, A for associate. Sir, if one person holds 26% or more in other enterprise, he shall become associate. Sir, if one person holds 26% in more, one person holds 26% in the other, then these two enterprise would become associate. So, for example, person one holds 26% in the other enterprise, person two holds 26% in the other enterprise, person one and person two are family members, sir, these two become associates. Sir, for example, HUF holds 26% in one enterprise, and sir, member of HUF individually or jointly hold 26% in the other enterprise, sir, they shall become associate. If a person or an enterprise has power to appoint, sir, more than half of the board of director or have power to appoint, sir, one or more executive directors, and then these two shall become associate. So then we have, sir, if out of the total book value of the assets, more than 51% of the loan have been given. Out of the total 100% of the book value of asset, 50% of the 51% of the loan have been given by some of the other persons. In that case, other person shall become our associate. So if out of the total loan taken, 10% of loan has been guaranteed by somebody, that other person, the guarantor, shall become our associate. So if we are purchasing, if out of total raw materials, 90% of the raw material are being supplied by single person, in that case, that person shall become associate. If while doing the sales, if we have power to negotiate the sales price and we have power to negotiate the other conditions also, that person will become an associate. And if we have any kind of interest in partnership or any kind of AOP exceeding 10%, such other enterprise shall become an associate. So all these conditions, so there can be multiple reasons for becoming associate. Even one condition can make you associate, even other condition, multiple conditions can make you associate. We got the point, sir. We got the point. Once associate enterprise is found, sir, you have to check whether it is an international transaction or not. Sir, whether it is an international transaction or not. Sir, international transaction imply, sir, either of the parties are non-resident. Sir, the word written here is at least, but sir, you just have to focus on either of the parties. Sir, if either of the parties is non-resident, sir, at least one of the parties has to be non-resident. If Rahul is Indian, Rachel has to be non-resident. If Rachel is Indian, then Rahul has to be non-resident. Sir, either of the party has to be outside India, has to be non-resident. In that case, sir, provisions of transfer pricing would apply. Sir, transfer pricing applied to any kind of expenditure, like, sir, for example, we have income, we have expenditure, we have allocation of costs, you have interest. So nature can be the same of purchase, in the nature of purchase, sales, expenditure, leasing, borrowing, so any transaction can apply. So the word here mentioned is at least. Remember, sometimes what happens is, sir, both the parties can be non-resident. Both the parties can be non-resident, but sir, if they are not doing at arm's length price, sir, there might be certain difficulties in taxing the transaction. Sir, for example, understand this point. Understand this point, sir. For example, this is Sir Hutchison SR. This is the parent company Hutchison SR CGP. This is Sir HTIL, and this is Vodafone. Now, sir, this HTIL is selling. HTIL is selling the CGP Mauritius to Vodafone. Now, sir, what if they both are associate enterprises and they are selling it at a very low price to avoid capital gain taxes in India? Now, HTIL and Vodafone are selling CGP at a very lower price just to avoid taxes in India. So, there should apply a transfer pricing provision now. Provision says that both the entities are non-resident, and sir, income tax provisions are applicable on that entity. Provision says the transfer pricing provision shall apply even if both of them are non-resident. Sir, we got your point. Sometimes what happens is, sir, for example, we have Rahul and Rachel. Rahul and Rachel are associates. But I did not transact with Rachel. I did not transact with Rachel. I transacted with somebody called Phoebe. Sir, I transacted with somebody called Phoebe. I sold goods to Phoebe. She is not my associate. But, sir, but, what Phoebe did, Rachel already had done certain contract with Phoebe. Rachel had already done contract with the Phoebe. She has already an agreement with the Phoebe. This associated person of mine has already done the contract with the Phoebe. And so the best part is, so terms have been determined by the Rachel. Provision says, so despite of the fact that you are transacting with somebody who is not your associate, but already terms have been determined now. So it is called a deemed international transaction. Transfer pricing provision to this transaction shall also apply. Sir, are we clear on that front? Yes, sir. Once we understood who is international, who is an associate, what are the international transactions, sir? We have to look for calculation of arm's length price. How arm's length price have been calculated? Sir, we have 5 methods to calculate the arm's length price. Sir, out of these 5 methods, one method has to apply that you have to choose according to the given instance. Important factor is, sir, this is the only thing that carries the most marks in the exam if you are being asked questions of transfer pricing. And the best part is, sir, you are bound to see a question from this topic. For sure, you are bound to see a topic from this question, a question from this topic. So you will be asked to calculate arm's length price for sure. And you will be asked from out of these five topics only. So you should have a very, very, very strong grips as to how arm's length price is calculated in different matters. First of all, first method given for arm's length price calculation is comparable uncontrolled price method. What it says. For example, we have Rachel with us. Or not Rachel, but we have with us Rahul and Rachel. So let's take an example for that. We have with us Rahul. We have with us Rachel. Rahul is selling goods to Rachel for rupees 1800 rupees. Oh. Rahul is selling Rachel goods of rupees 1800 rupees. Sir, but similar goods are being sold to somebody outside at rupees 25. Rahul is selling to Rachel at rupees 1800, but you are selling it somebody to an outsider that is rupees 2500. Why you are charging 700 less from Rachel? Why you are charging 700 less from Rachel? You are reducing your sales. You are reducing your profits. Cheating. That should be done at arm's length price. Sir, whenever you are given the transaction, sir, once in a situation you are transacting with associate, and in another situation you are transacting with somebody outsider who is not your associate. So, sir, in this case, you have to use comparable uncontrolled price method. Sir, how you have to solve? Always take the price charged by independent party in similar uncontrolled transaction. Whatever price that you are charging to an outsider, just to take that. Whatever the price charged to an outsider, so take that to outsider. Take that. Sir, 2500. This is the price that is being charged to an outsider. Just to take that. Just to take that. Sir, when it was asked Rahul, when it was asked to Rahul, why are you selling 1800 to Rachel and you are selling it 2500 to outsider? He gave certain reasons. Listen now. I could not charge Rachel 1800 rupees. Why? Because when I am selling it to an outsider, now I have to incur the freight expense. I have to incur the insurance expenditure. Therefore, now I have to charge him more. But when I am selling it to Rachel, now no freight is being charged to Rachel. No expenditure is being charged. Sir, no insurance has been charged. Whatever price is being charged, sir, Rachel bears it. Therefore, I have to charge less Rachel. So transacting with somebody else, I have to bear the freight, therefore I charge more. Transacting with Rachel, she has to bear, therefore I have to charge less. Provision says if there is a difference, if difference is of 200 rupees, then reduce 200. At least charge 200, not 2300, na Rachel, from Rachel. Instead of charging 2500, try charge 2300 from Rachel. This is what you want, na? You are charging 1800 to other person, 2500 to Rachel. Sir, if you are incurring the insurance expenditure, you are incurring the freight expenditure, just reduce it. After reducing, at least you should be charging the 100 now. Rahul should be charging 100. I say, no, sir, no, I cannot charge 100 because, sir, I give third party credit of rupees 100. For example, when I am selling it to Rachel for rupees 100 and I am selling it to third party at 2500, sir, I give them credit. I give this third party a credit of 1 month. I don't give the credit to Rachel. Therefore, sir, I charge them extra. I charge them more. Vision says, what is the value of the credit? The value of credit is 100 now. Just reduce this. At least you should be charging 2200 from the Rachel now. At least you should be charging 2200 from the Rachel. Remove the credit, remove the fleet charges, remove the insurance charges. At least you should be charging 200 from the Rachel now. Sir, you should be charging 2200. You charge 1800. Sir, whatever the difference is, that will be primary adjustment that will be added to your ITR. That will be added to your income tax return. Are we clear on that front? Are we clear on that front, sir? Whatever, sir, should have been charged after. See, this is the uncontrolled price. This is uncontrolled price selling to an outsider. And this is comparable also. Earlier it was not comparable. We made it comparable. So now 2200 is comparable to 1800. We should have charged 2200 from Rachel, but we did charge only 1800. So for that matter, whatever the differences will be added to our income. This method is called comparable uncontrolled price method. Most oftenly ICI asks this question only. So let's take a question from our Super 100. Let's take a question from the Super 100. Question number 106. What it says. Sir, XE is an Indian company in which Zilla, a US-based company, holds 26% of shareholding. See, XE is an Indian company. And we have a US-based company called Zilla who holds at least a 28%. That means Zilla and XE are associated. Clear, sir. Absolutely clear. So Zilla and XE as hold are 26% are associate. Yes, sir, they are associate. So whatever the transaction should happen should be at arm's length price. Yes, sir. XE sold 1,000 t-shirts at rupees 2. XE sold 1,000 t-shirts. 1 lakh t-shirts, sorry, at rupees $2. Okay. Identical t-shirts were sold to unrelated party at the rate of 3 rupees per t-shirt. Oh, sir, to third person you are selling. To third person you are selling for $3. Why you are charging $2 from associate? Why you are charging $2 to associate? You are reducing your sales now by selling to associate. Therefore, sir, $1 lakh will be added to your income. Yes, sir, it will be added. Okay. XC has borrowed $2 lakh from a foreign lender. Okay. XC has borrowed $2 lakh from a lender. Okay. Guarantee to Zilla for this was paid. Oh, it paid guarantee to Zilla. Oh, $10,000 the guarantee paid to associate. Okay. Sir, but unrelated party guarantee would have been just 7,000. You are paying 10,000 to your associate. Similar work would have been easily done at 7,000 only. You are paying extra 3,000 rupees to associate. Why so? So that will be added to your income. 3,000 rupees will be added to your income. 3,000 rupees will be added. $3,000 would be added to your income. Oh, sir, we got it. Sir, XC paid 15,000 rupees to Zilla for getting various customers. Sir, the same could have been done at 10,000. Sir, you are paying your associate 15,000 rupees. Similar transaction could have been done at 10,000 rupees. Sir, why are you paying 5,000 extra to associate? Why are you paying 5,000 to associate? Sir, because you want to reduce your income now. So it will be added. Sir, whatever the benefit is, sir, you are giving him the benefit of rupees 108 lakh dollar. $108,000 you are be giving benefit. What is the conversion rate? So conversion rate would be so conversion rate is given 64. So whatever the conversion rate, multiplying it would turn out to be 69,12,000. So this would be the adjustment. This would be the addition in the income to be done. Sir, we got this one. Other than that, sir, what happens is whenever our income that has been decided as per arm's length price, or whatever income that has been added via primary adjustment or because of adjustment of arm's length price, sir, for example, 69.12 lakh is the income that is to be added. Whenever income is added on account of primary adjustment, sir, remember, no chapter 6 deduction is available on this increased income. No No chapter 6 deduction is available, no tendable is available. Sir, remember, but this provision is only applicable when AO adds the income. If I self-declare my income, will I be allowed deduction? Right answer is yes. Sir, if AO adds the income, sir, will I be allowed deduction? Right answer is no. If I self-declare my income and increase the income at the time of primary adjustment, sir, I will be allowed deduction on the increased income. But if AO adds the income, I will not be allowed deduction. I will not be allowed deduction. Sir, comparable uncontrolled price method done? Yes, sir. Absolutely done, sir. Absolutely, sir. Done. Sir, resale price method. Sir, resale price method. What's the logic behind resale price method? Try to understand. Sir, we purchased from different vendors. We purchased from different vendors. So some might be associates, some might be not associates, some might be unrelated parties. But sir, we are selling it to normal person. Now what happens is, whatever the purchase price that we had paid from two associates would be more, or non-associates would be less. For that matter, whenever we are selling it to the third person, profit on the goods that have been bought from associate would be less, and profit on account of goods that have been purchased from non-associates would be higher, because sir, we have purchase prices less here now. From non-associates, from unrelated party, we are purchasing at a low cost, but from associate we are purchasing at high cost. So whenever we are selling the goods acquired from associate enterprise, sir, our profit would be less in this case. But when we are buying from non-associates, our profit would be more. Therefore, sir, the difference would arise. And how, sir, that difference is to be tackled? So that has to be adjusted, and some method applied is resale price method. What it says, understand. Try to understand. Sir, whenever you sell such goods to unrelated party, take that value. Whenever you sell such goods to unrelated party, take that value. Reduce the normal gross profit margin on the similar. Normal gross profit margin. So this is the price that should have been. This is the price that should have been. This is the price that should have been. And this is the price should have been versus whatever the price is, sir, that will be compared. So let us understand two examples for this. Sir, for example, we have Hindustan Unilever of India purchases goods from Unilever Britain at rupees 2 crore. At rupees 2 crore and sells such goods to Rahul at rupees 2.5 crore. Okay. Unilever sells goods to Hindustan Unilever India, and Hindustan Unilever sells such goods to Rahul. Okay. Sir, since the goods are being sold at 2.5 crore, remember, sir, normally Hindustan Unilever, whenever sells such goods, sir, it earns 40%. But sir, it did not earn 40% on sales to Rahul, because sir, purchase was expensive. Therefore it did not earn 40%. So sir, what it says, provision says you sold for 2.5 crore now, reduce 40%, 1 crore. Sir, your purchase price should have been 1.5 crore. Whatever sales that you are making to Rahul, your purchase price on this sales should have been 1.2 crore. You are buying things at a higher price because you are buying it from associate. So in this case, sir, instead of tracking the purchase price, sir, we are tracking the sales price, and on the basis of that sales price, we are trying to come at purchase price, normal purchase price, and this normal purchase price is compared with actual purchase price. Sir, whatever the difference is, sir, that has to be added. So difference was asked. Why difference arised? Difference was being asked asked to the Hindustan Unilever. Why difference? It said. Remember. There could be reasons for differences. No, there could be reasons for differences. What Hindustan Unilever said, sir, it is charging 2% brand value. We paid Unilever more because it was charging brand value. If you would have purchased from outsider, they did not charge brand value. But since we are selling goods of Unilever, now he is charging brand value. Government says remove the value of brand. Remove the value of brand. Remove the value of brand. Sir, even if they would have been charging for brand, add value to now. Add value to 1.5 lakh or remove from 2 crore. Whatever price you are charging, whatever brand they are charging, remove this price from 2 crore. Sir, what brand value they are charging? Sir, 2% of sales value. Out of this 2.5 crore, 2% they are charging. That means 5 lakh they are charging. Reduce this 5 lakh. You could have purchased for 1.95 lakh. Or add it to your difference. Sir, you could have purchased, your purchase price could have been 1.55 crore. Anything could have been done, no? If you would have purchased for 1.55 lakh. We are allowing it. We are allowing this difference. You should have purchased for 1.5 crore, 5 lakh. We are allowing extra because you are paying for brand value. We are allowing extra. If you are allowing extra on the brand value that should be added, you should have purchased at 1.55 crore only. Na? Why did you pay 2 crore? Why did you pay 2 crore? That is the question. Why did you pay 2 crore? If you are paying 45 lakh extra, we are not going to bear that. We are going to add it to your income. We are going to add it to your income. Sir, are we clear on that front? Are we clear on that front? Sir, listen to this carefully. In this case, what happens is, sir, whatever the sales price we are doing to unrelated party, take that. Reduce the normal gross profit margin. Normal gross profit margin is to be reduced. So this would give us what purchase price should have been. Purchase price should have been. This purchase price can be different from actual purchase price because of certain fundamental differences, and that fundamental differences are to be logically tackled. Sir, we do not have any definite rule of tackling such transactions, such fundamental differences that have to be dealt logically. Sir, are we clear on this concept? Are we clear on this concept? Sir, we have another example to be done. We have another example. We have another question from this to be done. Come on to question number 113. Beautiful question on resale price method. Sir, this was asked in May 25 examination. Sir, requesting you all to focus here for at least 5 minutes. Sir, beautiful question it is. Sir, Indiana Limited is an Indian company engaged in manufacturing and trading of electronic projectors. Oh, this Indiana Limited is engaged in trading and manufacturing of electronic projectors. Okay. Indiana Limited has following stakes in the following entries. See, Indiana Limited has 3 entities. Okay. 30% voting power in Star GmbH Germany. Okay. So Star GmbH is a German company. It has 36%, 30 power voting power. That means Star GmbH is your associate. I am highlighting in blue. Star GmbH is your associate. Okay, sir, got it. Got it, sir, got it. It appoints 6 directors in Moon, an American company. Out of 15 directors, sir, in Moon, there are 15 directors, out of which 6 you appoint. Sir, you have to appoint majority of the directors, more than half of the director you should be appointing. So in case you are appointing less than half, then in that case it is not your associate. So Moon is not associate. Not associate. I'm marking it as red. Moon is not your associate. Moon is not associate. Sir, clear on that front. So it has given guarantee for a loan to euro 12 euro from Asteroid Limited of UK. Okay, it has given guarantee of 12 million euro. The value of total borrowing is 150. Sir, out of total borrowing, we are giving guarantee of 12 euro. 12 euro is the guarantee out of 150. Sir, it is less than 10% now. It is less than 10%. Sir, if I am giving guarantee to somebody who will be less than 10%, so it shall not become my associate. This is also not associate. Only associate that is, sir, is the Star GmbH. Sir, Moon is not associate, and sir, Asteroid is also not associate. Sir, what are the names? Moon, Asteroid. Moon is not associate, and Asteroid is also not associate. So these are not associates. Others, only Star is associate. Okay, sir. Indiana Limited has entered into the following transaction with the following entities during previous year 24-25. Indiana Limited has entered into 3 transactions. Beautiful, Monisha. Transactions with Star GmbH. Indiana bought 1,000 units of electronic goods from Star GmbH of 15,000 per unit. Indiana bought 15,000 worth monitors. And how much monitors? Sir, 1,000 monitors. Oh my God, sir, 1,000 monitors. Yes, sir, 1,000 monitors. For the purpose of resale in India, okay. It sold the monitors in India without modification. Gross profit margin on resale was 20%. It is selling at the price of 20%. Okay. At the profit margin on 20% on sales price. Okay. Got it. Star GmbH provides after sales warranty of 1 year. Cost of warranty is 3 years of 3% of sales price. Okay. Star is providing warranty. Okay. Okay. Star is giving warranty. 1 year warranty. Okay. You are purchasing from associate. And associate is giving you warranty. Okay. Transaction with Moon Limited. Sir, Indiana bought 1,000 units of similar projectors from Moon Limited 14,000. Oh my God, sir. Oh my God. You are purchasing from associate at 15,000. You are purchasing from non-associate at 14,000 rupees. Oh my God, sir. This is the blunder that you are doing. Purchasing from associate at rupees 15,000. From non-associate, you are purchasing at 14,000. Oh my God, sir. It's sold without doing modification 30%. Oh my God, sir. Goods that you purchased from associate, you are earning only 20% on that. But that goods you are selling from non-associates, you are earning 30%. That means, sir, profit margin charged on the goods purchased from associate is very less. Therefore, sir, there is an element of higher purchase price involved while purchasing from associate. You are paying higher price to associate. It is even apparent from purchase price also. Moonlim provides warranty of 9 months. Oh, see, you are paying to associate more because he is giving you warranty for 1 year, but you are paying less to non-associate because he is paying warranty for just 9 months. Associate is giving warranty for 12 months, therefore 15,000 is being charged, and the non-associate is giving you warranty for 9 months, therefore, sir, 14,000 is being charged. So there is a difference. It seems a minor difference. We'll calculate it. You are required. Achha. Asteroid also. Indian Limited provides consultancy services. Okay, they provide the same to comments are not relevant, sir. If you are giving any services to non-associates, sir, it is not relevant for our calculation. Whether Star GmbH and Moon GmbH associate or deemed associate, so Star would be associate, Moon would not be, Asteroid would not be. Compute the arm's length price in the international transaction. How arm's length price would be calculated? So arm's length price would be calculated only in case of the Star Limited. How it shall be calculated, sir? Whenever any question is given to us, always consider the sales price to the unrelated person. Always start with taking the figures of the unrelated person. Sir, sales to unrelated person. How much sales price it is, sir? How much sales price is charging? See, we are given cost price of 14,000. Sorry, we are given cost price of 15,000. Plus, we are given profit margin on sales. We are given profit margin on sales. So 20% profit is being charged on sales price. Can I simply say 20% profit on sales price would imply a 25% on cost? See, 20% on sales price would imply a 25% on cost. Sir, yes, sir. So can I simply say plus 25% on 15,000? This would be sales price of each unit multiplied by 1,000 unit. So this would give us the actual sales price that has been on which the sales has been made. 1.87512341. 1 crore 87 lakh 50,000. This is the actual sales price that has been charged. Okay, sir. What should have been the normal gross profit margin? What should have been the normal gross profit margin? Sir, our should have been normal gross profit margin is 30%. We should have charged 30%. Sir, if reducing 30% from this, sir, 18750 into 30%. Our gross profit margin reduced should be this. So our should have been purchase price is 1 crore 31 lakh 25,000. Our should have been purchase price. Our should have been purchase price is this. Our purchase price is this. Our purchase price should have been this. But sir, this is not the actual purchase price, sir, because it is our associate is giving us more warranty now. Our associate is giving more warranty, 3 months more warranty is giving. So warranty adjustment has to be made. Our associate is giving us more warranty, so we can add warranty price also to it. What is the warranty? 3% of sales value. Sales value is this. That is 18750. 1, 2, 3, 4. That too for 3 months out of 12 months. This is the warranty that we are getting extra. Now, this is the warranty that we are getting from associate extra. And therefore, we can pay extra price to associate. We can pay extra price to associate. So, how much extra price to associate we are allowed to pay? $146.25. 146.25. How much we are supposed to pay? 132, 65, 625. This is we are supposed to pay. This is we are supposed to pay. This is we are supposed to pay. And that is what is given in your arm's length price. We are actually paying, sir, we are actually paying 1 crore 50 lakh rupees. Whatever the difference is, will be your arm's length price adjustment. That is how we have to solve the questions in case of resale price method. Always, always, always accept this point that always resale price charge from the non-associate. Whatever the price you are charging, whatever the profit you are charging, whatever the sales price is, with the non-associate has to be taken first at the top. Then only your answer will come correct. Otherwise, answer might become wrong. Are we clear on that front? Resale price method. That was it. So continuing further with cost plus method, sir. What it implies? Cost plus method. Sir, I am manufacturing certain goods. And on manufactured goods, I charge certain cost margin. Certain cost margin. So from associate, I am charging sir 20%, but from non-associate, I am charging 50%. Why less on associate? Beautiful, Monisha. From associate, I am charging sir 20%, but from non-associate, I am charging 50%. Why? Why are you charging less from associate? In that case, sir, you have to find the arm's length price from the associate person. How calculation would turn out to be? How calculation would turn out to be in this case? Provision says, for example, sir, understand this with an example. Sir, we have Hindustan Unilever, which sold machine to the Britain Unilever. It manufactured the machinery and sold the machinery to Britain Unilever. Machinery sold was 75 lakh rupees and cost of production of the machinery was 50 lakh rupees. How much margin it is charging? How much margin it is charging on cost? How much margin it is charging on just calculate the margin on cost and margin on sales. Margin on cost and margin on sales. Calculate both of them. How much margin they are charging? So profit is 20 lakh rupees. 20 lakh on 50 lakh would be margin on cost. 20 divided by 50. It is 20 divided by 50. Margin on sales is, margin on cost is 40%. Margin on sales is 20 by 70. 28.57. Sir, whatever what we have to calculate both of them. Okay? Margin on cost and margin on sales. Whatever we have given, we are given in question, we have to compare. So margin on sales from non-associate is 40%. Oh my God, sir. Oh my God. If we would have sold this goods to an outsider, sir, we would have easily earned 40%, sir, not 28, sir. We would have earned 40%. Why did you charge less from associate? Why did you charge less from associate, sir? That is why calculation is to be made. Why did you charge less from associate? Sir, when it was asked from Hindustan Lever, why did you charge less from associate? Why did you charge? Hindustan Unilever gave us 3 following reasons. Why it could not charge 40% on sales price from associates? Why it could not charge 40% on sales price to associates? Sir, first reason given by Hindustan Unilever was, sir, Britain Unilever gave some technical support which was 10% of GP. Meaning, sir, this Britain Unilever gave him technical support. Sir, it is obvious now. From non-associate, we can charge 40%, but somebody who is giving us technical support, how can we charge 40% from him? Provision says reduce this. How much it is giving, sir? 10% of GP, 10% of 40% would be 4%. Reduce 4%. Sir, you should have charged 36%. You should have charged 36% on sales. Okay, sir. Hindustan Unilever says, no, dear, no. So British Unilever is our old customer. We have to give him bulk discount. He buys goods on bulk. So we have to give him bulk discount. Oh, how much bulk discount? Sir, 5% of GP is expected. Sir, 40% is the GP. Take 5% of that, sir. 4% now. 2% now. Reduce 2%. So 34% you can charge. If you are giving him bulk discount, if you cannot charge sir entire money, sir, you can reduce the discount amount. You should charge what 34% on sales now. 34% on sales you have to charge now. Okay. Sir, no, Hindustan Lever says no, this is not done. Sir, Hindustan Lever give us credit 1 month less than other value. What it says? See, I am giving him credit for less time. For others, I am giving credit. For others, I am giving credit for 5 months. For Britain Unilever, I am giving just 4 months. I am giving him less credit, therefore less percentage I can charge. I am giving him less credit, therefore less percentage I can charge. Less credit, matlab less percentage of profit. How much credit? 1% of transaction price, 1% of transaction price is GP only. So 1% less. So you should have charged 33% on sales now. You should have charged 33% on sales now. You should have charged 33% on sales now. Sir, you should have charged 33% on sales. This implies, so 33% on sales implies 33% on sales implies, so 100 minus 33, that is, sir, 50% on cost. You should have charged 50% on cost. You charge 40% on cost, you should have charged 50% on cost, add 50% to it. 50 lakh is the cost price, add 50%, add 25 lakh. So this will give us 75 lakh. You should have charged 75 lakh. How much you are charging? You are just charging 70 lakh. Whatever the difference that is, sir, that should be added to your income. Did you get this point or not? Did you get this point or not? Did you get this point or not? Sir, this blew my mind. This blew my mind. Sir, it is not difficult. You already are aware of this fact. We are marathon. We are studying marathon. We are not even doing revision. We are doing faster format of revision a day before exam. Sir, we are aware of this fact. Sir, point number B. Fourth method. See, whatever example that I take, whatever example that I did take, sir, the same example you can see in the question. Same example. Not even figures change. The same example you will see in the question. We need not to do the questions on it again. Sir, next topic, profit split method. What it implies. Sir, for what happens? Why this profit split method is applied? See, for example, we have three people with us. For example, Monisha, Karthik, and Rahul. Monisha, Karthik, and Rahul. All three are associates. All are associate. All are associate enterprises. ठीक है? Sir, we undertake a project in which sir Monisha incurred 5 lakh, Karthik incurred 6 lakh, and Rahul incurred 10 lakh or 9 lakh, I should say 9 lakh. All in all, together we incurred 20 lakh rupees. Sir, we earned a revenue of 30 lakh rupees. We earned a revenue of 30 lakh rupees. We incurred 20 lakh. We earned revenue of 30 lakh. Sir, on what ratio this profit of 10 lakh will be splitted? On what ratio profit has to be split? That is what we need to understand in this profit split method. In real life, it might be very technical as to how this profit is to be split. But sir, in examination, whatever the ratio we have to split, sir, that would be given in the question itself. Sir, it can be on the basis of the cost incurred. It can be on the basis of risk taken. In the ratio of functions performed, who is the main function performer. Sir, it can be in the basis of the manpower. Sir, whatever the ratio, sir, whatever. It can be on the ratio of capital employed. Whatever the ratio, sir, they may agree. So that will be given to us. Sir, for example, ratio agreed is 1.1 is to 1 is to 1 is to 3. Monisha earns 1/3 profit. Rahul, Karthik, sorry, 1/5, and 2/3. 1 is to 1 is to 3 is the ratio. So what is the amount of profit that should be given to Rahul? Sir, Rahul should be given 3/5 of the profit, which implies Sir Rahul should be given 6 lakhs of profit. Sir, cost 9 lakh, 6 lakh piece is the profit. Sir, Rahul should be given 15 lakh. Any less given to him would be considered as arm's length price adjustment. Simple point it is. Simple, sir. So profit split method has never been asked in exam, and it is very less likely to be asked in exam because as a CA final student, you don't require any technical knowledge to do this. Now, whatever the ratio that has been given to us, you are directly going to split that. So what is technical in that? You will be able to solve it anyway. So that is not the topic that is going to be asked in exam. Sir, we have next a topic that is transactional net margin method. What does this imply? Transactional net margin method. Sir, in this method, now for example, we have Google India. Google India services providing its to parent entity, Google USA. They both are associates, assuming both are associates. Okay. So in this method, sir, what we have to do, we don't have to purchase ourselves. We don't have to compare our cost price. We don't have to compare what price we are charging to others. Sir, we have to check now what other industry player charges from other their associates. For example, if Monisha is purchasing goods from Karthik, we have to check Monisha is purchasing goods from Karthik. What price Karthik charges? We have to check how much prices Shakti is charging from Rahul. Two players in the industry are being compared to find out the actual transaction price. Sir, we are not charging, we are not finding out our gross profit margin. We are just comparing our gross profit margin with others in the industry. Sir, that is how things are to be computed. For example, the services provided by Google India to Google USA, cost margin is 70, cost is 70 lakh rupees. Technical services is worth rupees 1 lakh. Whatever the price is being charged is 1 lakh. Cost is 70, price is 1 lakh. Sir, 30 lakh profit this Google India is earning. Whereas, sir, if Facebook India provides such services to Facebook USA, it is charging 60% on cost. It is just charging nearly 42%, but Facebook could have easily charged 60%. That means you are charging less. Whatever the margins industry people are charging, you have to add that margin to your cost. So similarly, so 70 lakh rupees plus sir 60% added to it, sir, will give us sir 112. So this should have been charged. We charged only 1 crore. So 12 lakh, whatever the amount is, sir, that will be adjusted. That will be adjusted. So in this case, sir, we are being charged what price industry player charges, what price industry players in industry charges. That is what we have to compare. Are we clear on this front? Are we clear on this front, sir? Are we clear on this front? Any doubt till now? Any doubt to anybody till now? Clear, sir. If you have come this far, okay, if you have come this far, and even if you are still not liking the video, what do I do? What do I do to make you like the video? Shall I come and dance? Shall I come and dance? Shall I start singing? My singing will make you run away from the session. Sir, we have already liked the video. We have already liked the video. Sir, coming on to the next topic. Sir, is it possible that there might happen multiple arm's length price via the same method? Sir, for example, if we have Google India providing services to Google USA, okay, if we have Google India providing services to Google USA, sir, we compared with Facebook India to Facebook USA. It is possible. It is possible. But sir, if assessing officer wanted to compare sir Wipro India with Wipro USA, if assessing officer wanted to compute Infosys India with Infosys USA, if assessing officer wanted to compute sir TCS India with TCS USA, Mindtree India with Mindtree USA, sir, assessing officer can have multiple arms length prices, no? Assessing officer can have multiple arms length price. Sir, for example, in cost plus method, I am charging 20% on associates. From other unrelated party, I am charging 50%. From the other unrelated party, I am charging 40%. From the other unrelated party, I am charging 60%. So assessing officer can have multiple arms in price, na? From the same method also. It is only on the assumption, it is only on the same assumption that we are charging whatever we are charging from unrelated party, we have to charge from unrelated party. But how to ascertain, sir, what we are charging from unrelated party? Sir, we might charge other prices, different prices from different unrelated parties. So it is possible, sir, that we might have multiple arms length price. So if we have multiple arms length price, in that case, what to do, sir? We have to check how many arms length price you can derive. Sir, if you derive more than one, but up to five. If you derive two arms length prices, if you derive three arms length prices, if you derive four arms length prices, if you derive five arms length prices, from the same method. So what to do? Just take the arithmetical average of all these arm's length prices. Just take the arithmetical average. So how to take? Just understand this with an example. So for example, via using single method, we arrived at five arm's length prices. So 1020, 990, 1070, 1100, and 1000. We arrived at five arm's length prices. We arrived at five arm's length prices. Dividing them by five, so this would give us an average arm's length price of 1036. This is the average arm's length price. Now, it is not necessary that average would turn out to be actual transaction price. Actual transaction price might be something different. So provision says we are giving you a 3% cushion. We are giving you a 3% cushion. Your average transaction price, take 3% less, take 3% more. Whatever the sir, if your actual transaction price lie within this 3% range, na, sir, we will consider your actual transaction price as arm length price. Actual price as arm length price. We will take it. See, if average is within 3% range, na, it is okay. We will take whatever the transaction price we have done. We are okay with that. We will not compute our arm's length price. But sir, if actual is different, actual is way beyond. Actual is way beyond the range. Then in that case, what to do? So in that case, whatever the average is will be considered as arm's length price. Example. Let me understand this with an example. Average of 5 arm's length price turns out to be 1036, and our transaction price is 1000. Our transaction price is 1000. Sir, take the average 3%, 1036 into 3%, 31.08. Our difference is 36 lakh rupees. Our difference should be 31.6. That means we are transacting it at way less than 3% also. We are very much beyond the cushion. We are very much transacting very less than even 3. We are having the variation more than 3%. Therefore, sir, this transaction price would be disregarded. Whatever the arm's length prices will be considered. Whatever the difference is, sir, that will be added to your income. That will be added to your income. So, sir, whenever you are doing any business, sir, if you have multiple arm's length price, sir, add to average of it, the average of that arm's length price. Consider 3% limit. If your actual transaction price is within 3% limit, then you have to take the actual transaction price. But if it is beyond 3% limit, take the average as arm's length price. Sir, whenever you are doing a wholesale trading business, then this 3% average is not allowed to you. You just have to take 1% average. If you are doing a wholesale trading business, then this 3% average is not given to you. You are just given 1% average. Okay, sir. 1% average is only given to us. If we are doing wholesale trading business, only 1% is allowed to us. Okay, sir, we are short. Sir, but what if? What if, sir, we have more than one arm's length price? What if, sir, we have more than one arm's length price? Is it possible? Right answer is yes, sir. Sorry, more than 5 arm's length price. It is possible, sir. It is possible. Sir, for one time I might be comparing from Facebook, one time I might be comparing from Wipro, third time, sir, Infosys, fourth time TCS, fifth time L&T, sixth time Mindtree, seventh time, sir, Info means I can compare with multiple entities now. So I might be having more than 5 arm's length price, sir. Then in that case, what to do, sir? We have to find out the range for that. We have to use the arithmetic median, sir. We have to do the arithmetic median, and how arithmetic median is taken out, sir, how range is set up. For that matter, we have to have all the arm's length price arranged in a single format. We have to have all the arm's length price arranged. Sir, whatever the arm's length price we arrive, whatever 5, 6, 7, 8, 9, 10, sir, whatever arm's length price we arrive, sir, arrange such arm's length price in the ascending order. In the increasing order, you have to arrange. For example, we have 10 arm's length price in a data set. So arrange them in an increasing order. You have to arrange them in an increasing order. Okay, sir, good to us. So then you have to find out the 3 values in the data set. In that 10 values, you have to find out the 3 values, sir. First is a 35th percentile value. Second is 50th percentile value. And third one is 65th percentile value. You have to find out 3 things. So 35th percentile value, 50th percentile value, and 65th percentile value. And what does this imply? I'll tell you. Sir, out of the data set, take out the out of the data set, whatever the number of values are, take 35th percentage of that. For example, out of the 10 data set, 35th percentage is 3.5. Take that position. So take that position. So 30.5th position. Do we have any 3.5th position? Right answer is no. We don't have 3.5th position. If we don't have 3.5th position, take the 4th position, and whatever the value is on 4th position, take that. Sir, for example, 4th position is 1050. That will become the 35th percentile value. Okay, sir. Got it. Similarly, sir, out of the data set of 10, take the 65th percentage. 65th percentage. Sir, of the 10, sir, 65th percentage is nothing but 6.5. Sir, you have to find out the value that is on the 6.5th position. 6.5 is not a position now. Sir, take the 60 next value. 7th value, 7th position. Seventh position is 1080. Third, you have to find out 50th percentile. Sir, what is 50th percentile? Sir, whatever the data set is, whatever the value data sets has. Sir, for example, data set has 10 values, says take 50% of that. Sir, 5. Sir, ideally you should be taking fifth position, but sir, whenever any of the position is absolute number, whenever the percentage that you find out is absolute number, sir, do not take that absolute number. Sir, add fifth position, add the data at the fifth position, add the data at the sixth position. Sir, divide it by 2, and that will give you the arm's length price. That will give you the arm's length price, or I should say 50th percentile. So data at the fifth position is 1060, sixth position is 1070. 1060 plus 1070 divided by 2 would give us 1065, and that would be the 50th percentile value. So what you have to do, whatever the number of positions are, whatever the number of values are, sir, you have to multiply 35%, 50%, and 65%. Whatever the number turns out to be, sir, if it is an integer, if it is an absolute integer, take value from that position plus subsequent value divided by 2. If that has certain decimals in it, so take just the subsequent value. So you will arrive at 35th percentile value. You will arrive at 50th percentile value. You will arrive at 65th percentile value. You will arrive at these three figures. Now, what do we have to do of these values? Sir, your transaction price, whatever the transaction at which you are, whatever the price at which we are doing the transaction, so the transaction price should lie between 35th percentile position, and such should lie between 65th percentile position. Between 35th percentile position and 65th percentile position, it should lie. If it lies beyond that, so whatever the value that 50th percentile position stands, that shall become your arm's length price. That shall become your arm's length price. Did you get this point or not? Sir, what I said, just I'm repeating. You arrived at 35th percentile position, 65th and 50th percentile. Okay. Now, what happens is your transaction price should fall between 35th percentile value and 65th percentile value. If it falls within, sir, absolutely perfect. Whatever the transaction price is will be arm's length price only. But sir, if it falls beyond the range, then in that case, what to do? Sir, whatever the 50th percentile values will become your arm's length price. Sir, did you get this or not? Absolutely, sir. Absolutely, sir. Absolutely, we got this point. Sir, remember, whenever we are following the range concept, sir, we are not given any kind of 3% question, sir, because 3% question is not relevant here, sir. We are already given a range, so why to take 3% question in that? Along with that, sir, range concept is not applicable in profit split method, sir. It is not applicable in profit split method. Sir, range concept is only applicable in CUP method, RPM method, CPM method, and PNMM method. So in these four methods, we have to take. Sir, for example, we are sometimes given data of multiple years. For example, we are given data of multiple years. What to do in that case? Provision says, if multiple year data is being given to us, then we have to take. Then, sir, we have to take a weighted average of multiple years. In CUP method, in cost plus method, take the simple average of all the data. Sir, if we have RPM method, then we have to take the weighted average. And weights are to be taken in the form of sales. Whatever the average is, sir, we have to take sales as weight. Sir, if you are following cost plus method, then take cost as weight. And if you have TNM method, then whatever the figure that has been given to you, sir, take that weight. Sir, we don't have such questions on this topic, sir, but once it has been asked, this range concept has been only asked once in MCQ, otherwise it has never been asked. Sir, what happens when assessing officer determines the arm's length price? Is it so? Assessing officer may determine the arm's length price. So any doubt till now? I forget asking. Do you have any doubt here or not? If you have any doubt, you can ask me. Sir, what happens many a times assessing officer determines the arm's length price? Many a times assessing officer determines the arm's length price. Sir, what happens if assessing officer determines the arm's length price? Provision says, sir, for example, we have with us Rahul and Rachel. This is Rahul and this is Rachel. First of all, sir, whenever Rahul sells goods to Rachel, for example, sales price was 1,000. But sir, arm's length price was, sir, actual market price was, sir, 130 crore. So whatever the difference is, 30 crore as added to income of the Rahul. Whatever the differences are added to income of the Rahul, provision says, sir, whenever an adjustment is done by assessing officer, Sir, income is increased by 30 crore in my case. Income is increased with 30 crore in my case. Sir, will Rachel get additional expenditure of 30 crore? If income is added in my name, sir, can Rachel get additional deduction of 30 crore? Right answer is no. If one enterprise's income has been increased, the other enterprise's income remains unchanged. It remains completely unchanged. If income of one enterprise increases, sir, other enterprises remain completely unchanged. Completely unchanged, sir. Completely unchanged. Sir, we got this point. Rachel's income will not change. Sir, whenever income increases, sir, will I be entitled to 10 AA on this income? Right answer is no. Whenever assessing officer increases my income, I am not entitled to 10 AA. I am not entitled to Chapter 6A deductions also. Chapter 6A Part C, nothing allowed, sir. Nothing. No income based deduction. No 10 AA is allowed to us if income is being increased under adjustment. Oh, by AO. Okay, sir. When AO will compute arm's length price, sir, AO will compute arm's length price. Sir, whenever you have failed to choose the proper method, then in that case, AO will compute the arm's length price. You were supposed to choose TNMM, but you chose cost plus method. Sir, in that case, AO will compute your arm's length price. Sir, whatever the data that you chose, sir, is inaccurate. Whatever the data that you chose is inaccurate. For example, you were supposed to compare with Facebook, but you compared with somebody else who is not even reliable. Sir, whatever the documentations that you were required to make, sir, you did not maintain that documents. And sir, last thing, sir, whatever documents that you maintained, you were asked to produce, but you did not produce. In that case, what will happen? Sir, assessing officer will calculate the arm's length price. Sir, whenever he will calculate arm's length price, it will have the following effects that I said. Do you really think that assessing officer is so intelligent, so elegant, so beautiful? Array, sir, why get you so much Bollywood? Sir, wherever assessing officer calculates the arm's length price, remember, he doesn't know actually how to compute. He doesn't know actually how to compute. Sir, he has to rely on somebody else, sir, called transfer pricing officer. And it is the duty of the transfer pricing officer. Whenever assessing officer refers the case to transfer pricing officer, a transfer pricing officer has to calculate the arm's length price. Sir, during the course of proceedings, remember, very important point, sir, very important point, sir, assessing whenever transfer pricing officer was calculating arm's length price. He saw a transaction between Rahul and Rachel. Okay. He was calculating arm's length price. Okay. He see Rahul has already transacted with Chandler. I want to cover this transaction also. Can he cover? Right answer is yes. Sir, Rahul's sister concern has done certain transaction. Rahul's subsidiary has done certain transaction. That should also be covered. Can that be considered? Yes. Sir, Rahul's Mumbai unit transaction is under consideration by TPO. Sir, Rahul's can Pune transaction also be covered by TPO? The answer is yes, sir. If any of the transaction of any of the unit of mine has been noticed by the transfer pricing officer and he wants to cover such transactions also during the proceedings, during the arm's length price calculation, can he do so? Right answer is yes, the TPO has power to do so. TPO has power to do so. TPO has power to do so. Sir, are we clear on that front? Absolutely, sir. Absolutely, sir. We have power to do so. Sir, AO has to pass the order. So he has to pass the order within the 60 days from the completion of the assessment, whatever the due date of completion of assessment is. Before 60 days, before 60 days, he has to pass. So if any of the delay has been made on account of court order, if any of the delay has been made while asking the information from DTAA, so he will get extra time. Only joint commissioner, assistant commissioner, deputy commissioner can become TPO. Sir, ITO cannot become TPO. ITO cannot become TPO. Sir, we have section 92CB safe harbor rules. Many a times, sir, what happens is department is going to accept whatever the arm's length price you declare without any issue. Government of India may lay down certain rules for calculation of arm's length price, and department is going to accept that rules. Department is not going to argue with you at all. Department is not going to argue with those rules at all. Whatever the rules they say, whatever the rules that are being laid have to be followed by the department. Sir, whatever under those rules, if assessee declares any of the arm's length price, department cannot object to that. Department cannot object that. So, do we have any rules? Do we have any rules? Right answer is yes, sir. We do have certain rules. We have rules introduced us in the form of amendments. We have certain rules that have been introduced to us in the form of amendment. And so that amendment is really very important for examination. What it says, sir. Section 92CB. Government may notify rules for September 25 attempts, sir. Safe harbor rules have been notified. We have safe harbor rules that have been notified, sir. For example, if we have a foreign company, which is into diamond mining, sir, it does Sale of raw diamonds, sir, uncut, unpolished, unassorted raw diamonds selling in special notified zones. So do you remember where we studied the special notified zones? So a foreign company if it displays the uncut, unassorted diamonds in special notified zone, it was not a business connection, no income was taxable. But sir, it is doing sales, therefore, sir, it can opt for safe harbor rules. How much safe harbor rules it can offer? Provision says whatever the income that has been received in India and whatever the income that has been receivable in India, add them, sir, multiplied by 4%, and this is the amount of PGBP that it can declare. Remember, under these safe harbor rules, government is allowed to declare PGBP of 4%. Whatever the amount received or receivable is, take 4% as PGBP. Take 4% as PGBP. Take 4% as PGBP. Sir, remember, it is not a tax rate. It is not a tax rate. It is just a PGBP income. Tax rate would be still 35%. Sir, government will not enter for calculation of arm's length price. Whatever the arm's length price is, government will not interfere. Government will not refer the case to TPO, sir. Nothing will apply. Sir, whatever the 4%, whenever 4% you declare, sir, no deduction of expenditure under section 32, 38 would be allowed against this income. Sir, WDV would continue to reduce notionally, sir, whenever we are declaring 4% income, whenever foreign company is declaring 4%, so WDV would be reduced by notional depreciation. Sir, whenever the 4% is being declared, sir, if we have if such foreign company has any kind of prior year losses, so that losses, unabsorbed depreciation cannot be set off against this 4% PGBP. Sir, assessing of the assessee has to maintain the documents. Whatever the documentation mentioned under section 92 days, assessee has to maintain, and he has to get his books of accounts audited under section 92E. That is, he has to get his books of accounts audited under 3ECEB. Sir, remember, whenever he wants to opt for the safe harbor rules, right answer is yes, it is optional. Whenever assessee wants to opt for safe harbor rules, sir, it has to claim the benefit in form 3 CEFC, sir, before ROI. If he doesn't opt for safe harbor rules, he shall be governed with the regular provisions of the Income Tax Act. See, in case AO feels that assessee has furnished incorrect information, he may declare safe harbor rules as void ab initio. Assessing officer may take entire benefits. Sir, whenever assessee opts for safe harbor rules, he will not be allowed for mutual agreement procedure. I will tell you what mutual agreement procedure is later on in the subsequent chapters. So remember how things have been taken place. A foreign company does any kind of work in special notified zones relating to uncut, unassorted, and unpolished diamonds. If it earns any kind of business income, display income, sir, it is not taxable. If it sells and earns certain income, sir, it has option to declare 4% PGBP. That is under safe harbor rules. Sir, it is important. It is really important. I personally think that MCQ or a question from this topic might be asked in exam. Somebody who is really enjoying the session, do drop down a timestamp at this point so that people referring to this again and again can understand the importance of this amendment also. Sir, we got your point. Next topic, that is advance pricing agreement. Sir, what does that imply? Advance pricing agreement, what does that imply? Sir, advance pricing agreement. Advance pricing agreement, what does that imply? Sir, listen. Sir, for example, I always enter transaction with Rachel. It has been history. It has been Adams that every year I enter transaction with Rachel. Every year I do transaction with Rachel. Rahul and Rachel transact. And every year, assessing officer had a certain type of animal, had a certain type of insect in its wrong parts. Assessing officer has a certain issue with this transaction. So, sir, can I enter any agreement? Can I enter into any agreement with CBDT? Just to fix the arm's length price. I just don't want to get into the assessment every year. So for that matter, can I go to CBDT and ask for a agreement that whatever the transaction that I am doing, sir, will be for future also? Sir, assessing officer should not object for that agreement. Right answer is yes, we can enter the agreement. That is called advance pricing agreement. Sir, assessee with the prior approval of the with the prior approval of central government, sir, assessee can enter with CBDT regarding determination of arm's length price in the manner in which how arm's length transaction will take place. Whenever any transaction between Rahul and Rachel would take place, so this would be arm's length price. This would be declared by Rahul every time, and assessing officer is not going to object. This is the kind of agreement that assessee can do. This is the kind of agreement that assessing office assessee can do. Sir, whenever advanced pricing agreement is being done by the assessee with the CBDT, in that case, sir, calculation of arm's length price would not apply, and sir, TPO rules shall also not apply. Sir, whenever I want to do agreements, I can do agreement for maximum 5 previous years. Maximum 5 previous years, sir. Maximum 5 previous years. So whenever I do APS, it is binding on the person entering. If I am entering into APS, it is binding on me. If I am entering APS, it is binding for CIT, PCIT, PCCIT, and CCIT. It is binding on them. If I am entering APS, that agreement is binding on all the transactions that I have entered. Sir, remember, whatever. What if? Sir, CBDT finds out that I had entered into APA by giving fraud documentations. By fraud information I have taken, by suppression of facts, I have taken the APA provision says CBDT will declare such agreement as void ab initio. Void ab initio implies, sir, as if this transaction had never been entered into, it shall assume that. Sir, whatever the provisions of Income Tax Act are, shall apply as if they have never been applied in past. Sir, whatever the time that has been wasted from giving the advance pricing agreement till the conclusion and till the date of declaration of it as void, sir, that shall be excluded for the purpose of assessment. That shall be excluded. That means if any assessment is going on, whatever the time that has been wasted for the assessing officer, whatever the time that has been wasted from giving APA till declaration of void ab initio, shall be given extra to assessing officer to assess. Remember, sir. Sir, is it possible? Is it possible? Sir, if I want to opt for APA for upcoming 5 years, sir, I had already incurred transaction in past years. I had already incurred transaction in past years for 4 years, 5 years. I had already incurred transaction. Can I get this agreement covered for prior years also? Can I get the agreement covered for 5 years prior, 5 years, 4 years? Can I get that covered also? Right answer is yes. Sir, concept is called rollback. So if I had taken APA for next 5 years, I can get a rollback for previous 4 years also. For 4 prior years also, I can get rollback. But there are certain conditions to get the rollback. So remember, conditions are important because conditions are the thing that are going to be asked in exam. Sir, whenever I apply for rollback, I have to apply for all the 4 years. I have to apply for all the 4 years. Then only I will be getting the rollback. Sir, we got this point. Sir, for all the 4 years, I must have filed return under section 139(1). Sir, in whatever the years I have filed return late, sir, I will not be allowed APO. I will not be allowed rollback in previous years. Okay, sir. Sir, for all the years, all the prior 4 years, sir, I must have furnished transfer pricing audit report under section form 992. Okay, sir. Sir, whatever the transaction for which I am agreeing in future, in past also I must have done similar transactions only. See, the transaction for which I am entering APA should be similar transaction for which I am asking for rollback. See, rollback transaction should not be different from which we are asking for APA. And sir, whenever we enter rollback, sir, we pay a fees of rupees 5 lakh in form 3 CEDA. In form 3 CEDA, sir, we have to pay fees of rupees 5 lakh rupees. 3 CEDA, I call it 3 CEDA, and pay 5 lakh rupee fees. Remember, sir, this is important segment, sir, non-applicability of rollback, sir, when rollback provisions are not applicable. When rollback provisions are not applicable, sir, rollback provisions are not applicable in 2 cases. What are those 2 cases, sir? What are those 2 cases? Sir, whenever determination of arm's length price is subject matter of appeal at ITT and ITT has disposed of the application, sir, understand this, what I am saying. For example, sir, Rahul said arm's length price is 100. And department says it is 130. Department says 130. We went to CIT appeals. We went to ITT appeals. ITT on looking at this case, ITT looked at this case and disposed of the application saying, what are you doing, Rahul? What are you doing? Very bad, very bad, very bad. ITT says, no, 130 should be arm's length price. Provision says if ITT has already disposed of the application, in that case, sir, a rollback will not be given. Even since ITT has already disposed of the application of the SSC, do you think that CBDT is going to enter and give 130, give 100 as arm's length price? ITT has already disposed of this 130 now. So how can CBDT give the arm's length price of a lower benefit? So it is not allowed for CBDT to enter any rollback for a year for which ITT has disposed of the application. But in an examination, what they ask is, They ask, ITT has set aside the application for referring back to AO for fresh consideration. They will not ask you this thing that ITT has disposed of the application. They will mention in the question that ITT has set aside the order and referred to AO for fresh consideration. See, remember, there are two different things. These are two different things. Disposing of the application is a different thing. ITT has rejected my application. But sir, setting aside the application for the fresh consideration implies something different. Setting aside the application, setting aside for fresh consideration is not implying disposing of. Therefore, whenever it is given that ITT has set aside the application for AO for fresh consideration, in that case, you will be given rollback for that year. You will be given rollback for the year, sir. It was mistake in this RTP 24, RTP 25, RTP September 25 attempt. Similar MCQ was asked, and where ICI did something wrong. It mentioned in the question that ICI has set apart, ITT has set apart, and it had not given rollback. I asked them to correct it, and they had corrected. They had revised the RTP. Whatever RTP that you see on the portal has been revised, and has been revised with the request of mine. I had requested ICI, and it has revised the RTP. So bottom line is, whenever the word written here is, whenever the word written is, so set aside and referred back to AO for fresh consideration, it means you will be given rollback for that year. But if it is written that application has been disposed of, you will not be given rollback for that year. Second thing, sir, whenever on the basis of rollback, sir, your declared income is decreased. Sir, for example, Rahul's declared income was 40 crore. Rahul entered into a transaction with Rachel. Entered into transaction with Rachel. Sales price was 100 crore. Transaction price was 130. Arm's length price was 130. AO said 130. He added 30 crore rupees to my income. Now I went for APA. I went for advanced pricing agreement. I went to APA. Sir, as soon as I went to APA, sir, my addition was 30. It was reduced. My addition was reduced to 20. Will I be getting APA? Right answer is yes, sir. Whenever my assessed income is reduced, sir, I am entitled for rollback for that year. I will be given rollback for that year. But sir, if my declared income is reduced, sir, for example, sir, my arm's length price is reduced to sir, if my arm's length price is reduced by 50 crore. Sir, will I be given APA for that year, rollback for that year? Right answer is no. Whenever I am declaring certain income, sir, because of rollback provisions, if declared income is reduced, for example, in APA, transaction price turns out to be 90 crores. So my declared income would reduce. Provision says whenever declared income is reduced, you are not given rollback for that year. Whenever your declared income is reduced, you are not given rollback for that year. But sir, if your assessed income is reduced, then you are given rollback for that year. Sir, very important point. Sir, that can be asked in MCQ. I personally think, what happens when you enter APA or what happens when you enter rollback? Provision says, sir, for rollback, sir, if you have filed return for any of the previous years, if you have already filed returns from any of the previous years, sir, what to do? Sir, you have to file a modified return. The date on which you enter the rollback provision, let that month end, and within 3 months from end of the month of rollback, entry, sir, you have to file a modified return. You have to file. Sir, if you have not filed return till now, provision says you have to file return as per rollback provisions. Sir, assessment wise, if your assessment is pending, assessing officer will get flat 1 year extra. But if assessment is already completed, then in that case, sir, since assessment is already completed, assessing officer, assessee has to file the modified return. Provision says as soon as assessee files the modified return, within 1 year from the end of the year in which modified return is filed, assessing officer will issue the modified order. What it implies, sir? Assessee entered rollback. Sir, as he entered rollback, he has to file a modified return. Within 3 months from end of month of order or entry. As soon as assessee files the modified return, end of the financial year plus 1 year will be the time in which assessing officer has to file the modified rate order. He has to pass the modified order. So if assessment is already completed, assessing officer has to pass a modified order within the 1 year from the end of the financial year in which assessee filed the modified return. So certain clarifications regarding to APA. Sir, you cannot seek APA for rollback for 1 year, 2 year, 3 year. Nah, sir, you have to apply for all 4 years. Sir, for whatever you are given, whatever years you are given rollback, it's okay. But sir, you have to ask for all the 4 years. Sir, for whatever years you have filed late return under section 104, you will not be given rollback. Sir, if you want rollback and you don't want APA for future, you are not allowed. Sir, you have to apply for future APA. You might be given rollback. You may or may not take rollback, sir, but you cannot seek for rollback and may not seek for APA. It is not allowed. Sir, for example, if we have any kind of merger, demerger going on, for example, we have X company and Y company, and X has APA, and Y has no APA. If they form to become X, then APA will be given to X. If X and Y form to become Z, sir, no APA to anybody. If X and Y form Y, no APA. If X and Y become XY, sir, no APA. Only if the old company exists, then only APA rollback is given. Otherwise, sir, nothing is given to the new entity. Sir, compliance procedure for APA, what it says, sir, it says if you require any of the APA, then you have to go to DGIT, Director General of Income Tax, who is responsible for international taxation, for pre-consultation, scope and issues. Sir, you have to apply for APA at least before the 1st April of the previous year, whatever the previous year for which you want APA. Whatever the previous year for which you want APA. Sir, for example, you want previous year 24-25. You have to apply it prior to 1st April, that is, sir, 1st April 2024. Prior to that, you have to apply. Sir, you have to apply prior to 1st April of the previous year. Sir, entry may be done later on. Signing of APA may be done later on. Sir, that is not relevant. Sir, you have to apply it prior to 1st April 2024. Sir, you have to pay the fees for entering APA. Sir, if your international transaction is up to 100 crore, then 10 lakh fees is to be paid. If your international transaction exceeds 100 crore, but up to 200 crore, then sir, you have to pay fees of rupees 15 lakh. If your international transaction exceeds 200 crore, then fees has to be paid of 20 lakh rupees. So in addition to that, sir, 5 lakh rupees extra fees is to be paid in Form 3 CEDA for rollback provision. So 10 lakh, 15 lakh, 20,000. If transaction is up to 100 crore, 100 crore to 200 crore, and exceeding 200 crore, sir, you have to pay the fees. Sir, once you apply, and sir, you don't want APA, if you don't want agreement, sir, what to do, sir? You can ask back now. You can ask back, sir. APA will be withdrawn. Application will be withdrawn. You are not given any refund of the fees, but application will be withdrawn. Sir, whenever you enter any APA, sir, you have to agree upon the international transaction covered. What all international transactions be covered? What is the TP methodology? Sir, which method will be calculated? Which method will be used? Sir, critical assumptions, gross profit margins, which party to be considered? Sir, rollback provision, whether you have to go for rollback or not, sir, everything has to be mentioned. Sir, whenever you enter APA, you have to file compliance report. Every year you have to file a compliance report. So 30 days within the due date of the ROI. That is, sir, up to 30th December you have to file. 30th December you have to file. Due date is 30th November. Within 30 days you have to file the compliance report. As soon as you file the compliance report, sir, within 6 months from end of month of filing, sir, you have to get your compliance audit done, and that compliance audit will be done by TPO, transfer pricing officer. This is how APA works out. Sir, TPO does your compliance audit within 6 months from the end of the month in which compliance report is received. As soon as you submit, it has been received by the TPO. Sir, within end of that month, it takes 6 months, and TPO will do your compliance audit. That is how that is how advanced pricing agreement takes place. See, transfer pricing is not the topic now where you can think of leaving out anything. There are small topics that might disturb you, that might be asked in exam and are relevant for your understanding, even though they might not be interesting, even though they might not be appealing to you at first. But remember, these are scoring topics. Once you have a grip on it, sir, there is greater chance that you will be able to solve it. And remember, it's not just about 6 marks. what pattern I have analyzed is from past few attempts, whenever three integrated case studies are being asked, third integrated case study is normally from international taxation only. And it is alternatively sometimes from NR taxation and sometimes it is from transfer pricing. So it is not just 25, 30 marks, it is 4 marks, 5 marks, more MCQ that might be asked in the paper. So you cannot think of leaving this topic at all. Okay, coming on to next topic, that is secondary adjustment. What the secondary adjustment mean and when it is done, sir, how it is done. Understand this thing. See, whenever Rahul sells goods to Rachel. Sir, say for example, sales price was 100 crore. Sir, but market value of this transaction was 130 crore. AO found out and did the adjustment. 30 crore is the adjustment that AO has made. Sir, whenever AO does certain kind of adjustments, sir, it is called primary adjustment. Whenever, sir, AO does any kind of adjustment, sir, it is the primary adjustment. But Government of India has not stopped here. Government of India has not stopped here. Government said, Oi Rahul, Oi Rahul, Oi Rahul. Government says, Oi Rahul, why Rachel has not given you 30 crore? I said, I made sales of 100 crore. No. Sales is 130 only. Why Rachel has not given you 30 crore? I said sales is 100. Government says no. We assume the sales is 130. You should receive 30 crores from Rachel. Why she has not given you? I am saying she has not given me. Provision says. Government of India says. Mohit, super question. May 25 wala you can refer. I will upload additional questions PDF. I will upload additional question video. For sure I'll upload. But you can refer May 25 wala video. Sir, what it says? What it says? Sir, why 30 crore has not been given by the Rachel? She has not given. We'll take it, we'll assume it loan. We'll assume it as advance given to Rachel. Or we'll assume that loan has been given to the Rachel. Rahul has given 30 crore worth loan to Rachel. Rahul has given 30 crore worth loan to Rachel. Oh my God, sir. Oh my God. Oh my God. Oh my God. Sir, you have given 30 crore loan to Rachel and you have to offer interest on it. Because since you have given loan to Rachel, so we want interest now. We want interest now. Sir, we want interest. Oh my God. So if you do not get the access money with Rachel repatriated back to India, let me try more. See, whenever you transact with associated enterprises, and sir, whatever primary adjustment is, whenever primary adjustment is made, whenever the excess money is kept with the associated enterprise, it is assumed that you have to repatriate back it to India. If you do not repatriate back to India, sir, it is assumed that you have to offer interest on it. Government charges interest on the excess money. And sir, from when it is charged, how much it is charged, and how to avoid, these are the three questions to be answered. Sir, from when interest is charged, sir, how much interest is to be charged, and how to avoid that interest, sir, three things are to be mentioned. It's a simple thing. We'll answer one by one. Sir, from when interest is charged? Sir, secondary adjustment takes place only on account of primary adjustment. Whenever there is primary adjustment, we have to get the excess money repatriated. Therefore, we have to do the secondary adjustment. So secondary adjustment only takes place when we are having primary adjustment. Sir, whenever provision says, I am doing suo moto primary adjustment, I myself felt that 30 I have sold goods worth rupees 130 crore and I have charged just 30 crore. I am myself declaring 30 crore. In that case, provision says you have to get money within 90 days from the due date of ROI. You have to get the money repatriated back to India within 90 days from the due date of ROI. Sir, if you did not get the money back to India within 90 days, in that case, from the next date of ROI, sir, you will be charged interest. Oh my God, sir, this is the period. Till the money you do not get repatriated, you will be charged interest. Oh my God, sir. So, if you are doing primary adjustment suo moto, then in that case, from the due date of ROI, you have to bring the money. And sir, if you did not bring the money, sir, from the next date, you will be charged interest. Sir, we got this. For example, if we do primary adjustment on account of assessing officer's order, if assessing officer has ordered primary adjustment, or if ITT has ordered, or if CIT appeals has ordered, sir, in that case, sir, we are doing primary adjustment. Provision says, sir, as soon as assessing officer's order came, sir, within 90 days you have to bring the money back. If you did not bring the money back, sir, from the next day only we will be charging the interest. Okay, sir. Okay. Sir, if because of safe harbor rules we are doing primary adjustment, provision says, sir, within the due date of ROI only, sir, the same thing will apply. Same thing will apply, sir, within the due date of ROI, sir, you have to bring within 90 days. If you did not bring, sir, from the next day you will be charged interest. From the next day of the ROI, sir, due date of the ROI, you will be charged interest. Sir, because of mutual agreement procedure, sir, mutual agreement procedure we are doing. Sir, for example, Government of India sat with Government of Australia and decided how transaction price would be. Sir, because of which I have to do transaction, we have to do primary adjustment. Provision says because of mutual agreement procedure, whenever we do any kind of primary adjustment, sir, we have to bring money we have to bring money to India within 90 days from the date of giving effect by the AO to the map. Assessing officer gives effect to that mutual agreement procedure within 90 days of such effect. You have to bring that money. If you did not bring the money, sir, you will be charged interest. You will be charged interest from the date in which AO gave effect to the map. Sir, last thing, if you change transaction price because of arm's length price adjustment, sir, if you do primary adjustment on account of APA, advanced pricing agreement, sir, then in that case you have to check whether you did enter APA before due date of ROI. So remember, these are not easier things. These are not easier things to grasp. Sir, if you enter APA before the due date of ROI, then you have to bring money within 90 days from the actual date of ROI. And if you did not bring money within 90 days from the actual date of ROI, sir, you will be charged interest from the due date of ROI. Sir, ठीक है. Sir, if you entered into APA after the due date of ROI, then in that case, sir, the date on which APA is entered, let that month end, and within month end, sir, you have to bring money within 90 days. If you did not bring money within 90 days, sir, from the next day of the month end, sir, you will be charged interest. So due date for interest is very important. Due date of interest is very important. From which date up to which date interest will be charged. If doing suo moto or because of safe harbor rules, in that case, sir, from the due date you have to bring within 90 days. If you did not bring, sir, you will be charged interest from the next date. Sir, if you do primary adjustment on account of, sir, appellate order or AO order, sir, within 90 days you have to bring money, otherwise you will be charged. If you are doing primary adjustment on account of MAP, within 90 days from the map, otherwise interest from the next day. Sir, if you are doing primary adjustment on account of APA, and APA has been entered prior to ROI, then from actual date of filing of ROI, 90 days you have to bring money. If you did not, sir, from the due date of ROI, you will be charged interest. Sir, if you enter APA after due date, then the month in which APA is entered, let that month end, and within 90 days you have to bring money. So if you did not bring money, then from the end of the month you will be charged interest. So this is technical. I request you to take a screenshot of this PDF and solve it accordingly, sir. Otherwise, if this comes, you might not be able to solve it. Okay, sir. Important point. Sir, what is the rate of interest that will be charged to us? Sir, we understood the period from which interest will be charged. Now we want to know, sir, what is the rate of interest to be charged? Remember, sir, if transaction is denominated in rupees, for example, transaction between Rahul and Rachel is denominated in rupees, sir, remember, in that case, rate of interest will be, sir, rate of the previous year for which you are offering the interest. The previous year you are offering interest. For example, you are offering interest for previous year 24-25. Sir, take the 1st April of that previous year and find out the SBI lending rate. SBI lending rate as on 1st April 2024, add 3.25% to it. For whatever previous year you are offering interest, sir, take 1st April of that previous year. Add 3.25% take 1st April of that previous year. Find out the SBI lending rate of that previous year at 3.25%. That will be the rate at which you will be charged interest for the period given above. Sir, if transaction is denominated in foreign currency, then what to do? Sir, take 6 months labor rate on 30th September of the previous year. Whatever the 30th September of previous year is, sir, take 6 months labor rate plus add 3% to it. Sir, we got this point. Sir, So this is how we understood how much interest is to be charged and on what time interest is to be charged. Sir, can we avoid this interest? Can we avoid this interest? Sir, we have multiple options to avoid this interest. Sir, what options do we have? First of all, sir, if your secondary adjustment is up to, sorry, if your primary adjustment is up to 1 crore, if your primary adjustment is up to 1 crore, sir, no secondary adjustment. Oh, wow. Sir, if your primary adjustments pertains to assessment prior to assessment year, it pertains to assessment year 16, 17 or any prior previous year, sir, in that case, sir, no secondary adjustment is to be made. Third thing, sir, you can avoid this interest. You can avoid this interest first thing by getting the excess money repatriated back to India. You can ask Rachel to send the money to India. That is the first way of getting the getting avoided the secondary adjustment. Second way to avoid secondary adjustment is, sir, you can pay additional tax. An additional tax of rupees 18% plus 12% plus 4%. This is the amount of additional tax that you can pay to avoid the secondary adjustment. So this tax will be final tax. No credit of this tax will be given. No deduction of this tax would be given. Sir, whatever you pay, whatever you pay will be the final tax. And after that, you are not required to do the secondary adjustment. Important factor here is, sir, important factor here is whenever you are thinking to pay secondary additional tax, whenever you are thinking to pay additional tax, till that day you have to pay the interest. Till that day you have to pay the interest, sir. After that, you will not be charged any interest. But the day till which you are thinking to pay, you are thinking to pay the additional taxes. Till that day, you have to pay the interest. After additional tax, interest will not apply. But if you have any interest outstanding prior to additional tax, that will still be charged. Sir, take an example. For example, Hindustan Unilever sold goods rupees 100 crore. Arm's length price is 130 crore, sir, to Unilever England, sir, on 1st July 2023. Out of nowhere, primary adjustment is made suo moto on ITR filed on 15th November 2024. I myself did. I myself did. See, whenever I myself do the adjustment, whenever I myself do the adjustment suo moto, I have to bring money within 90 days from the actual due date of ROI. From the due date of ROI, within 90 days, I have to bring the money. Okay. Due date of ROI was 30th November. Okay. Sir, I did not bring any money. Provision says I have to treat 30 crore as loan and interest on 30 crore to be offered. Rate of SBI given is 11%. Sir, we have to add 3.25%. That means 14.25% interest is to be charged. So for previous year 24-25, how much interest will be charged? 30 crore multiplied by 14.25%. From 1st December 2024 to 31st March 2025, sir, number of days turns out to be 121 days out of 365 days. This is how interest will be charged. Interest amounts to rupees 1.417. This is the amount of interest that is being added to my IFRS income. Sir, next year also, for example, next year I want to pay additional tax on 30th July. On 31st July 2025, I want to pay the additional taxes. Provision says the date on which I decide to pay additional taxes, I will be charged 18% plus 12% plus 4%. I will be charged this much. Okay. Sir, I will also have to pay interest from 1st April 2024-25 to 31st July 2025. Sir, I have to pay interest for this 122 days also at the rate of SBI on 1st April 2025. And so since rate is not given, I will take 11% plus 3.25%. So this is the amount of interest that I have to pay plus additional tax I have to pay this much. Are we clear on this front? That completes our additional tax topic. Secondary adjustment topic. So small topics from transfer pricing are left. Any doubt till now? Any doubts to anybody till now? Any doubt to anybody? Sir, maintenance of documents. Any person entering international transaction has to maintain three documents. Any person doing international transaction has to furnish three documents. First of all is local file, master file, and CBC reporting. Three things are to be reported. Three things are to be furnished. When the three things are furnished, sir, I'll tell. First of all, local file. Whenever you enter any international transaction, and sir, value of international transaction exceeds 1 crore individually or in aggregate. If individually or in aggregate, sir, value of international transaction exceeds 1 crore in that case, sir, you have to enter such transaction into local file referred under section 92D. You have to mention that transaction into local file. Remember, sir, whenever assessing officer, local file, or I should say TP study report, we call it TP study report or local file. Whenever assessing officer asks for this local file, you have to furnish this file within 30 days. You have to file this within 30 days. So if you want extra time, you will be given extra time. Sir, you have to maintain this TP study report for 8 years within end of the relevant assessment year. Sir, what is CBC reporting? See, what happens is whenever there happens to be a certain entities, what certain entities, sir, for example, multinational entity exists. For example, Nestle has operations in multiple entities, multiple countries. For example, Airtel has a presence in multiple countries. For example, the TCS has operations in multiple entities. Provision says whenever any entity exists multinationally, then parent entity of such multiple group has to file CBC reporting in their respective country. Parent entity has to file CBC reporting in their respective country. Sir, what reporting they have to do? Sir, they have to report the income taxes paid in each country. They have to report the capital employed and assets employed in each country. Sir, they have to report the employment details. Sir, they have to report the profit before taxes. Everything has to be reported equally. Sir, everything has to be reported, sir, for every entity. Okay, sir. Sir, if parent entity is located in India, then in that case, sir, it has to report, sir, such CBC reporting in Form 3 CAD within 12 months from end of relevant previous year. Within 12 months, sir, Indian entity has to report the CBC reporting. Sir, CBC reporting in India is only mandatory if consolidated group revenue exceeds the 6,400 crore. If consolidated group revenue exceeds 6,400 crore, then only CBC reporting is to be made. Sir, sometimes what happens, sir? For example, Nestle. Nestle's parent company is in Switzerland. Sir, its subsidiary are at various other places. For example, its subsidiary might be in India also. Sir, normally parent entity is only required to do CBC in their own country, and whenever India wants information, India can ask information from that country. But sir, in some cases, sir, Indian government can compel this Indian entity to do the CBC reporting. And sir, what are those cases? First of all, whenever, sir, parent entity is a resident of a country from where we ask information, but they don't have CBC obligation. In their tax laws. So in that case, Indian entity has to report the CBC reporting. Indian entity has to do CBC reporting. Second instance, sir, for example, if parent entity is from that country where it does not have information sharing agreement with India, if parent entity belong to that country with which India does not have any information sharing agreement, CBC reporting is to be done by the Indian entity. At last, sir, if there is systemic failure, for example, there is, sir, parent entity in Switzerland. Sir, it reports CBC there. It has information sharing agreement with India. But sir, when Indian government went to ask for information, sir, it denied information. It literally denied the information. And sir, in that case, sir, it is called systemic failure when they went for information and parent entity denied the information. In that case, so it is the constituent entity, it is the local entity of India that has to report the CBC reporting. Sir, we got it. Sir, we absolutely got it. Sir, when reporting is to be done, provision says in case of systemic failure, it has to be done within 6 months from the end of the month in which it is intimated. As soon as systemic failure is intimated to the Indian entity, within 6 months, it has to do the reporting. Okay, sir. So if Indian entity fails to do CBC reporting, then what penalty is being charged? Sir, penalty is charged 5,000 rupees per day for 1 month delay. If delay is beyond 1 month, then penalty will be charged at the rate of 15,000 rupees per day after a month. And sir, even if notice comes to you, and even if you did not file CBC reporting, even after notice, sir, then 50,000 rupees per day will be charged. So if you false submit anything in CBC reporting, so 5 lakh fees will be charged. And sir, if there is reasonable cause of failure, no fees, no penalty will be charged. Sir, we got this point. Master file. Sir, what this master file imply? What this file imply? Sir, master file contains the list of all the entities in the national group. See, local file incorporates all the transactions that this entity enters. CBC reporting includes the details of these practical details, these numbers about all the entities. But master file only incorporates the theoretical details. For example, what all entities are there in the group, what is their address, what is their legal status, what is their ownership status, what is the brief details of the important transactions, their ownership. This is what master file incorporates. Master file shall be submitted up to the due date of ROI. In India, master file is to be submitted up to the due date of ROI. Okay. Sir, when master file is required to be submitted, see, if international transaction exceeds 50 crore or purchase or sale of intangible assets, exceeds 10 crore, either of the case, plus, sir, turnover of the group exceeds 500 crore. What I said, just listen. Master file is to be maintained in two cases. Sir, if international transaction exceeds 50 crore, or sir, purchase and sale of intangible exceeds 10 crore, either of the case, clubbed with group revenue of 5,500 crore, sir, we have to maintain master file. What I did say, just listen to this point again. Sir, if international transaction exceeds 50 crore, intangible transaction exceeds 10 crore, either of the things can happen, plus group revenue exceeds 500 crores, and master file is to be maintained. So it has to be furnished in Form 3 CR. It has to be maintained for 8 years, and if not maintained, penalty of 5 lakh will be charged. Sir, I want you all to note down certain things. So this is the documentation of transfer pricing. I want you all to write down. See, what is to be recorded in local file, what is to be recorded in CBC, what is to be recorded in master file. When is to be recorded, so transaction exceeds 1 crore. When consolidated group revenue exceeds 6,400 crore, CBC is to be done. Sir, when master file is reported, when filing is done, sir, what is the period of maintenance? 8 years. Sir, for CBC, we do not have any period of maintenance. Sir, what if the failure is done? Sir, for master file, we have 271 AA, 2% of transaction value. For CBC, we have 5,000, 15,000, and 5,000, 50,000, 50,000. And so for master file, we have 5 lakh rupees. So this is to be taken screenshot if you want. Otherwise, so this is what we had studied. This is a summary of what we had studied in all the 3 documentations. If you take the screenshot, but yeah, if you did not take the screenshot, you have the option of coming back and taking the screenshot later on. Specified domestic transaction, only 2 or 3 topics need to be studied. Then our chapter will be over 2 or 3 topics, small topics. Okay. Sir, for example, if there are 2 associate enterprises in India itself, 2 associate, and one of them is taking 10 double deduction, or one of them is taking chapter 6A part C deduction, or one of them is paying taxes under section 115 BAB or BAE at the rate 15%. Provision says, if any of the 2 associate enterprise, one of the entity is taking 10 AA, taking chapter 6A part C or 15 BAB, in that case, any transaction done should be done at arm's length price also. These are called specified domestic transaction. 2 enterprises doing transaction should be doing it at arm's length price only. Sir, remember, sir, transfer pricing provision shall apply only if the transaction exceeds 20 crore in a previous year. See, if transaction exceeds 20 crore, then only transfer pricing provision will apply. Otherwise, transaction provision does not apply. See, these are specified domestic transaction. On these, government cannot track. Okay, and not even much tax benefit is allowed, sir. Therefore, only if transaction exceeds 20 crore, then only transfer pricing provisions will apply. Sir, on these domestic transactions are associate enterprises provision, calculation, sir, reference to TPO, documentation, and sir, at last, sir, the audit. Sir, all these documents would, all these provisions would simply apply. So every person who enters in the international transaction has to get its books of accounts audited by a chartered accountant in Form 3 CEB. Sir, 1 month prior to actual date of ROI. So that is up to 31st October, it has to get its books of accounts audited. Also remember, on failure to get books of accounts audited, you are being charged 1 lakh rupees of penalty. Sir, we got this. Bonus stripping transaction, I personally don't think shall be asked. Sir, what it says, I'm just briefing out. See, if you buy securities just before bonus, if you buy any securities just before bonus and you sell those securities just after receiving the bonus, if you sell the original securities, what happens is, sir, as soon as you get the bonus, now price of the securities just break down. For example, if I had securities of 1,000 rupees and I receive bonus on it, sir, the price of securities fall down. And I sell the original securities. So I might incur certain losses. Provision says whenever you incur any kind of losses, that losses shall be ignored. That losses shall become cost of acquisition for the upcoming securities. You are not given any benefit on any losses if you sell original securities at the time of bonus. So it says if you buy any securities 3 months prior to the bonus and you sell within 9 months, then in that case, whatever the loss you have will be considered as cost of acquisition for the remaining securities. So Section 94A. Transaction with notified jurisdiction area, NJA. See, Government of India can declare any person, any entity outside India as notified jurisdictional area. What will happen? Sir, whenever you are transacting with any person located in NJA, sir, you will be considered as associate with it. That transaction will always be considered as international transaction. Whatever the transaction you are doing should be done at arm's length price. Sir, every provision of transfer pricing will apply to it. Sir, but one provision will not apply. If you are transacting with anybody in NJA, every provision of transfer pricing would apply except for one. Sir, what one provision will not apply? Provision says that 3% range that you get, the 3% cushion that you get on an average, sir, that will not apply. That will not apply. No cushion would apply. Okay, sir. Whenever you are making any payment to person located in NJA, remember, sir, such payment shall be subject to TDS at the rate 30%. Okay. Sir, whenever you are receiving any payment from NJA, notified jurisdiction area, in that case, sir, you have to offer an explanation to such income. Otherwise, sir, such will be treated as your income. It will be treated as your income. Sir, sometimes what happens is we deduct a TDS at the rate 30%. So such person located in NJA can come to India, file his return of income, pay taxes in India, and sir, get the refund also. See, person located in NJA is subject to TDS at the rate 30%. So TDS at the rate 30% would not imply that tax rate becomes 30%. So only in TDS rate is 30%. Sir, we got that point. Last section, sir. Section 94B, implementation of interest deduction, thin capitalization, what it says. Whenever any Indian company or permanent establishment of a foreign company pay any kind of interest to associate enterprises. Interest can be, sir, on a debt, short-term, long-term, operating, financing, any kind of debt. Whenever Indian company pays any kind of interest to its non-resident associates, sir, only limited interest would be allowed. So interest to the extent of 30% of EBITDA. 30% of the EBITDA would be allowed to this entity. Interest to the extent of 30% of the EBITDA would be allowed to this entity. Okay, sir. Rest will be disallowed. What is meant by EBITDA? Sir, earning before interest, taxes, depreciation, and amortization. So, for example, this Indian entity is paying finance cost, is paying commission, is paying brokerage, is paying things with different names altogether. It is paying things with different names altogether. Provision says everything shall be considered as interest only. If you are paying 50 lakh as bonus, 50 lakh as commission, 50 lakh as brokerage, 50 lakh as interest, 50 lakh as finance cost, we'll assume everything to be interest and club it, and we have to check for limit for 30% of EBITDA. Sometimes what happens is, for example, this is Rahul and this is Rachel. So Rahul pays interest to Rachel and Rachel is associate. So limit of 30% would apply. But sir, for example, if Rahul is paying to somebody else called Chandler, who is not associate, so limit normally does not apply. But sir, But sir, if Rachel has given any guarantee to this Chandler, Rachel has given guarantee to this Chandler, or so Rachel has deposited certain sum, deposited the corresponding sum. For example, loan has been given by the Chandler of 10 crore. Rachel has deposited 8 crore to Chandler. Provision says it is assumed that Rachel has given the loan now. So whatever the interest that is being paid to Chandler, so it is assumed that the 94B provisions would apply to this also. So if you are paying interest to somebody else, if you are paying interest to somebody else who is not even your associate, you are paying interest to somebody else who is not even your associate, provision says transfer pricing provision shall apply to that transactions also. Transfer pricing provision shall apply to that transaction also. Sir, you must remember that. But provided, sir, your associate must have given guarantee or your associate must have deposited the corresponding amount. Whenever you pay interest up to 1 crore rupees in a previous year to non-resident associates, sir, provisions of this will not apply. Provision of this will not apply. Also, sir, whenever you are a bank, you are an insurance company, you are NBFC, or you are a finance company located in IFSC, you pay any interest now, you are allowed. You are allowed to pay any interest to the non-resident associate. Provision says excess interest disallowed shall be carried for the next year. For example, what it says. For example, in previous year 23-24, I paid interest, for example, 8 crore and allowed interest was, sir, 5 crore. So 3 crore would be disallowed and so this will be carried forward for 8 years. Next year, what happens is, sir, previous year 24-25, sir, I paid 5 crore, allowed is 7 crore. Provision says I am paying, I am allowed 2 crore extra now. Even though I paid 5 lakh, but I am allowed 3 crore extra now. So whatever the disallowed was, sir, will be allowed to the extent of 2 crore in the next year, sir. It will be allowed to us in the subsequent years. So that is how things are done. Sir, we are done with transfer pricing topic. Sir, we are only left with a question that is to be done. Just let me check if there is a question that we can do. See, there is a question in RTP September 25 which clearly states there are two businesses of an entity. Foreign company comes to India. Foreign company comes to India in special notified zones. It earns two kinds of income. First of all is display of diamond, 10 crore, and it earns selling of raw diamonds, rupees 100 crore revenue. Sir, can it opt for safe harbor rules? Right answer is, sir, display income is already exempt. Sir, selling income is subject to safe harbor rules. Sir, you have to offer at least 4%, then only you will be safe from transfer pricing provision. Otherwise, transfer pricing provision would apply. You have to offer at least 8%. So simple question, you can do it of your own. Transfer price 92E is easy. These are self questions. Yeah, these are very simple questions. You will be able to solve it. Okay, sir, you will be able to solve these questions. So guys, 4% tax. 4% is the PGBP. Yes, perfect. Sir, now I would request you to take a break. It is 3:03. Take break till 3:30. Okay. Have lunch. After lunch, we have 5 chapters to cover: DTAA, advanced ruling, equalization levy, base erosion, profit shifting, model tax conventions, tax treaties. I guess 6 chapters are left. Sir, we have to do it solidly. And believe me, you will enjoy understanding every topic. You will enjoy understanding every topic. We will see you guys after the break. Inform as many students as much possible so that more students can come and more students can take benefit of this session. Do share it with your friends. And meanwhile, if you have not liked the video, do like it now. See you guys after the break. Welcome back from break. Are you all back from break? Yes, sir. We are back from break. Just give me a second. Huh? So, guys, before going to break, we completed off with transfer pricing topic. We also completed NR taxation. It took us 5 hours to complete both the topics, but it is definitely worth it. So, continuing further, sir, another important chapter to be discussed. Sir, I would start with that. I would start with advanced ruling first. I would start with advanced ruling. Why, sir? Because it is a topic that is regularly being asked in exam. Sir, what this all about? Sir, whenever you have doubt in income tax, from where you can ask? So you can ask me. Of course, you can ask me anytime. Sir, but what if I have doubt in income tax? Then what to do? Sir, what if I know the provision? I know the treatment of the provision, but I am not sure that government is going to treat the same thing or not. Sir, what to do? I can go to a board constituted under Income Tax Act called Board of Advanced Ruling. Sir, Board of Advanced Rulings is constituted to give judgment. Ruling implies judgment, and in advance, sir, we have to understand the implication of a transaction. We want to understand the implication of any transaction. For that matter, we can seek advanced ruling. We can seek advanced ruling. Sir, asking for judgment in advance. Sir, SSC can make application to Board of Advanced Ruling for the transaction that has already been undertaken or that is proposed to be undertaking. The sir, judgment can be relating to a question of fact or it can be question of law, anything. Sir, what shall constitute Board of Advanced Ruling? Sir, Board of Advanced Ruling shall have two members at least, each having each of CCIT or above rank. Sir, whenever you are not satisfied with judgment of advanced ruling, sir, you can appeal to High Court. Sir, remember this question is asked multiple number of times. Sir, whenever you are not satisfied with the judgment of advanced ruling, sir, you can appeal to High Court, not at any lower authority. Sir, when and who can apply to advanced ruling? Sir, there are five kinds of people who can apply to advanced ruling. First of all, any non-resident, he is proposing any transaction, he is proposed to undertake any transaction, or he has already undertaken a transaction. Sir, he can apply in Form 34C. Okay, sir. Any resident on behalf of non-resident can apply. Any resident on behalf of non-resident can apply. Sir, for any transaction that has already been undertaken or that the transaction that is proposed to be undertaken by the non-resident, he can apply. Okay, sir. Any resident person can apply for advanced ruling. Any resident person would apply for advanced ruling for determining his tax liability. For determining his tax liability for the transaction that is already undertaken or transaction to be undertaken only if the transaction exceeds 100 crore. A resident is normally not allowed to go advanced ruling unless transaction is 100 crore or more. Remember, if you or I have doubts, sir, I can only go to advanced ruling if my transaction value exceeds 100 crore. Then only I can go to advanced ruling. Otherwise, I cannot. Okay, sir, we got it. Any kind of public sector undertaking, see, public sector undertaking like Hindustan Aeronautics, State Bank of India, sir, they can go for advanced ruling. They can go for advanced ruling provision says, but sir, they can only go for advanced ruling for the computation of total income pending before any of the authority. If case is pending at CIT appeals, if case is pending at ITAT, if case is pending at any revisionary authority, sir, they can go to advanced ruling for computation of total income. So any other person may go to advanced ruling for understanding whether his transaction might not be declared by impermissible avoidance agreement. For example, I am going to undertake a transaction, and according to government, that transaction might become impermissible avoidance agreement. So provision says I can go and ask advance ruling whether this transaction would constitute impermissible avoidance agreement or not. Sir, Whenever I file the application, sir, I can withdraw that application within 30 days from the application, sir. No issue whatsoever. Whenever you go to advanced ruling, sir, you pay prescribed fees, sir. What is the prescribed fees, sir? Listen. Whenever a public sector company or any person who wants to know that whether he is going for impermissible avoidance agreement or not, if these two people want to go to advanced ruling, they have to pay a fees of rupees 10,000 rupees. They have to pay a fees of rupees 10,000. Any other SSC, any other SSC who want to go for advanced ruling, sir, they can go to advanced ruling. Remember, sir, if transaction is up to 100 crore, they have to pay 2 lakh rupees fees. If they are entering into a transaction greater than 100 crore, up to 300 crore, they have to pay a fees of rupees 5 lakh rupees. If they are entering into transaction exceeding 300 crore, then fees of 10 lakh rupees is to be paid. So 2 lakh fees multiplied by 5 lakh fees will give us 10 lakh fees. This will give us the fees breakup. Up to 100 crore, sir, 2 lakh fees. 100 to 300, in that case, it will be 5 lakh, and greater than 300, it will be, sir, 10 lakh rupees. 2 into 5 would give us 10. Whenever you file any application for advanced ruling, you have to digitally sign it. You have to digitally sign it, then only such application shall be valid. Remember, as soon as you file your application to Board of Advanced Ruling, what it will do? It will call for information with respect to CIT, PCIT. See, whatever, for example, I, Rahul, go to advanced ruling and seek any kind of ruling. What this board will do, sir, it will direct the lower CIT, PCIT and information from collect information about mine from CIT, PCIT. CIT, PCIT will furnish information. Remember, CIT, PCIT will furnish the relevant information, whatever that have been asked by the board. Sir, Board of Advanced Ruling will pronounce its judgment within 6 months from the receipt of application. As soon as application is submitted, Board of Advanced Ruling will pronounce the judgment within 6 months. Okay. Whatever the judgment has been passed, copy of the ruling shall be given to CIT, PCIT. Okay, sir, no issue. Sir, there are instances where Board of Advanced Ruling is going to reject your application. For sure, they are going to reject your application. Sir, what are those instances? First of all, if you are a public sector company and your case is already pending at High Court or Supreme Court, then in that case, sir, you are not given advance ruling. You are given no advance ruling at all. If your case is already pending at High Court or Supreme Court, sir, why should they give you advance ruling? They will not be giving any advance ruling. If your case is pending at CIT appeals or ITAT, sir, you can still get advance ruling. But sir, if your case is pending at High Court, Supreme Court, no advance ruling would be given. Second thing, in case of any other SSC, for example, me, Rahul, a non-resident, sir, if case is pending at any appeal authority, sir, for example, we have with us CIT appeals, we have Joint Commissioner appeals, we have ITAT, sir, if any SSC's case is pending at any authority, sir, advance ruling will give no judgment. It will reject his application. Remember, any SSC, anywhere pending, anywhere appellate authority appeals is pending, sir, advance ruling will not give judgment. But sir, for public sector company, the limit is High Court and Supreme Court. Up to ITAT, a public sector company, okay, advance ruling will be given to it. Sir, it is very important. Listen this. Sir, if individual SSC, any SSC's cases pending at CIT appeals, Joint Commissioner appeals, ITAT, High Court, Supreme Court, advance ruling will not be given to him. Advance ruling will not be given to him. But in case of PSU, sir, if its case is pending up to ITAT, will be given. High Court, Supreme Court will not be given, sir. Also, last point, sir, if any of the person has entered into a transaction, sir, that results in impermissible avoidance agreement. Any person who has entered into a transaction that results in impermissible avoidance agreement, so that person shall not be given any advance ruling. Such person shall not be given advance ruling. But here is a catch. Here is a small catch. Sir, what type of catch? See, if somebody has taken advance ruling just to understand that whether his transaction is impermissible avoidance agreement or not, in that case, he shall be given. A normal person requiring calculation of tax liability will not be given any advance ruling if their transaction results in impermissible avoidance agreement. But if a person he himself has gone for advance ruling only to know whether he is entering into impermissible avoidance agreement or not, he shall be given. Okay. Transaction design or impermissible avoidance agreement, advance ruling will not be given. But sir, a person who is asking for impermissible avoidance agreement, he shall be given advance ruling. That is what this line says. Sir, once application by the public sector company is made, sir, IT authority or ITAT will stop It will stop its proceedings and it will wait for IT80 to pass the order. It will wait for IT80 to pass the order. Once IT80's order is being passed, once IT80 order is being passed, sorry, once advance ruling is received, then they shall continue. So advance ruling shall be void whenever any advance ruling is being seeked by giving fraud information, false information, sir, misrepresentation of fact, then sir, such advance ruling shall become void ab initio. Remember, sir, provisions would apply under Income Tax Act as if there were no advance ruling given to you. Sir, powers of advance ruling, sir, 4 powers advance ruling has. Board of advance ruling has 4 powers, sir. Sir, it has power for discovery and inspection. It has power to examine such person on oath. Third power it has. Sir, it has power to compel production of books of accounts. And fourth power, it can issue summons. Sir, for example, I want advance ruling according to this transaction. For example, XY transaction I have entered. Sir, can Board of Advance Ruling ask information beyond this? Right answer is yes. Sir, am I supposed to deviate from the topic? Right answer is no, sir. Whatever that I have asked, I will be given judgment on that only. But for that judgment, if Board of Advance Ruling requires any other document, any other information, I have to furnish. I have to mandatorily furnish it. Okay, sir, we got it. Sir, if I am not satisfied with the judgment of the advance ruling, what can I do, sir? I have to appeal to High Court within 60 days. 30 days additional time limit is given if in case I delay. See, remember, appeal to High Court is to be done in 120 days. If you remember, appeal topics, appeal to High Court is done in 120 days. But sir, if advance ruling, against advance ruling, if you are going to High Court, then in that case, 30 days only you are given with. Plus additional 30 days. 60 days you are given for High Court, but 30 days additionally. Sir, for example, if I go to advance ruling to understand the tax liability, during the proceedings, I thought 15 lakh I have already paid. I have already paid 15 lakh rupees for 10 lakh rupees as fees. Why shouldn't I ask more questions? If it is calculating tax liability, why shouldn't I ask the TDS liability also? If board is already calculating the tax liability, why shouldn't I ask the TDS liability also? Point is valid. Provision says whenever I put additional questions, such additional questions will not be answered by advance ruling. Whatever the questions that we had asked in original advance ruling, that only will be answered. So no additional questions will be entertained by the board unless it is necessary for board to answer those questions, without which, sir, original judgment cannot be given. Board is not going to ask any additional questions. Sir, during the advance ruling, during the proceedings, sir, if any of the advance ruling thinks that whatever things that you have submitted, it wants more evidences, you have to submit additional evidences. Sometimes what happens is, for example, there is Mr. A and there is Mr. B. Mr. A is resident, Mr. A is resident and Mr. B is non-resident. They had taken advance ruling in respect of transaction 1. Now there is person X and there is person Y. They want to undertake the similar transaction. Similar transaction, not same, but similar transaction they want to undertake. They want to use this advance ruling. Can they use it? Right answer is, sir, they are allowed to use it, but only with prior application. This Mr. X has to apply to Board of Advance Ruling that it wants to use this prior advance ruling. Board of Advance Ruling will assess the case. Board of Advance Ruling will assess the case, how similar this transaction is. Board of Director will finally pass an order whether Mr. X and Y are eligible to use the ruling or not. Otherwise, sir, they are not allowed to use the ruling. Okay, sir? Clear with the point? Yes, sir, absolutely clear with the point. Come on to question answer, sir. We have certain questions from the advance ruling that are to be solved. Mr. Ricky, a resident individual aggrieved by the order of advance ruling is binding by the application. He has no other appeal. See, Mr. Ricky has an option to go to a High Court within 60 days and 30 days additional time limit is given. If you are aggrieved by the order of these advance ruling, you can go to IT80. Sorry, you can go to High Court. RA3 is a public sector company wants to seek advance ruling from the Board of Advance Ruling in respect of matter for the computation of the question. However, case is already pending at IT80. It cannot seek advance ruling. Sir, it is incorrect. Sir, if public sector company's case is already pending at IT80, it can still seek advance ruling for the matters relating to computation of total income. Sir, Indian company makes an application to advance ruling in relation to tax liability of Messrs. Spencer Inc., a non-resident arising out of the transaction undertaken. Value of transaction is 250 crores. See, if value of transaction is 250 crores, sir, what fees you have to pay, sir? 5 lakh fees is required to be paid. Okay, sir. What would be the amount of fees accompanied with the application, sir? What would be the fees, sir? 5 lakh fees is only paid. So what is the remedy available to ABC if it is agreed by the Board of Advanced Ruling, and how much time it should be exercised? 60 days. You can go to High Court plus 30 days additional time you are given. Sir, 5 lakh is the fees. Third question, sir, ABC Limited as an Indian company has entered into agreement for providing technical know-how with PQR Inc. ABC has entered into agreement with PQR. Okay. A company registered in country A. Okay. ABC entered into PQR. PQR has a sister concern XYZ LLC. Transaction 1. Okay. PQR has sister concern XYZ LLC in country A only, which has obtained advanced ruling on the identical know-how with a Indian company MNC. See, MNC and XYZ LLC already has advanced ruling. They already have advanced ruling. They already have advanced ruling, sir. They already have advanced ruling. Sir, this ABC and PQR now want to use this advanced ruling. Can they use it? See, the agreement is expected to be of 500 crore and expect the tax liability to be 150 crore. ABC wants to use this advanced ruling for the assessment proceeding. So it applied to Board of Advanced Ruling for the same ruling to ABC Limited. See, ABC applied the same ruling to be applied in our transaction, being identical, to verify the correctness of the transaction. The Board of Advanced Ruling compelled the production of books of accounts. Board asked, it went to Board of Advanced Ruling, and Board of Advanced Ruling asked for books of accounts. Can ABC make an application for advanced ruling with the Board of Advanced Ruling as per the Act? Yes, sir, it can make an application. Also examine whether board can ask the production of books of accounts. Right answer is yes, sir, it can ask. What it says, sir, it has, since transaction exceeds 100 crore, it can seek Board of Advanced Ruling. Sir, it has to make the application. Board has all the powers of the civil court, sir, all the 4 powers mentioned, and yes, board can ask. Sir, what question this was? So these are the only questions that are being asked, and sir, very simple questions, very simple, very simple questions. Come on to topic double taxation avoidance agreement. Sir, whatever the manner you follow for double taxation avoidance agreement, I just want you to listen the next half an hour and you will understand DTAA differently altogether. You will understand DTAA differently altogether. Sir, how double taxation avoidance agreement goes? For example, I am Rahul. I am staying in India, earning in USA. Staying in India, earning in USA. What happens is, sir, USA says you are earning in USA, as per source rule, you have to pay taxes in USA. As per source rule, you have to pay taxes in USA. But sir, Government of India charges tax based on residence rules. So therefore, there are 2 types of tax laws going on, 2 types of ways of collecting taxes. A company, the country in which I am earning will be charging taxes on such income based on source rule. The country in which I am resident will be charging it as per residence rule. Sir, my income, my single income only is being taxed in 2 countries. My single income is being taxed in 2 countries. Sir, this is a kind of double taxation that must be avoided. This is a kind of double taxation. This is called jurisdictional double taxation. Jurisdictional double taxation. It is called jurisdictional double taxation. So to avoid that now, Government of India enters into double taxation avoidance agreement with many countries. Government of India enters into double taxation avoidance agreement with other countries. It enters into other countries like sir, USA. It enters into DTAA with sir, any other country, every other country it enters. All in all, we have 196 countries, of which sir 130 countries we have DTAA. We have 130 countries with which we have double taxation avoidance agreement. And in this double taxation avoidance agreement, now there is major clause which helps us to eliminate the double taxation. For example, normally what happens is, sir, I have earned this income in USA. So what Government of India will do? Sir, Government of India will either exempt that income in India. Government of India has DTAA with that country, for example. Government will either exempt the income in India, or what government can do? Government can do tax credit method. Sir, what it says, government can consider such income in my income. Government can consider such income as income earned in India, charge taxes on that, and give a credit on such taxes paid in that country. Sir, how credit will be calculated? I will tell you later on. So if there is DTAA between the 2 countries, If there is DTAA between the two countries, then what government can do? Government can follow two methods. Sir, either it can use exemption method or either it can use sir credit method. Sir, two methods are available. Sir, how credit is being given, how exemption is being given, I will discuss later. So next part that is important. Sir, for example, if India does not have DTAA with that country, for example, North Korea, example, India does not have any DTAA with North Korea. Let us suppose India does not have any DTAA. Sir, in that case, what will happen? Sir, North Korea will charge tax, India will charge tax. Sir, how? Sir, same income tax twice just because India does not have DTAA. So in that case, India allows relief under Section 91. Section 91 relief is being given in India. Sir, what I can reasonably conclude is whenever you earn income in one country and you are resident of India, such income is either not taxable in India or you get a relief. If India has DTAA with that country, you will get relief as per Section 19. If India does not have DTAA with that country, you will get relief under Section 91. For sure, you will be getting a relief. Either that income would be exempt or sir, either you will get relief on Section 90 or Section 91. Got it? This is what matters the most. Sir, you will get a relief. You will get a relief. Sir, got it. We got it. Sir, we got it. Sir, calculation of relief involves सबसे important aspect. It is the most important aspect and how things go. Let me tell you. Let me take you through an example. Let me take you through an example. What is the difference? How relief is being calculated if India has DTAA, if India does not have DTAA? How critical angles to this transaction take place? Sir, there is an example that I have drawn. Just try to understand the examples one by one. Try to understand these examples one by one. For example, I'm just highlighting things and narrating the story with you all. We have Miss Shalini with us. See, we have Miss Shalini with us. Okay. Shalini has income from North Korea and Shalini has income in India. She is resident of India. She is resident of India. Okay. She is resident of India. She has income from two countries, sir. Some income from North Korea and some income in India. How much income she earns in North Korea? Let me tell you. She earns rent. Whenever you earn anything in North Korea, sir, no standard deduction is allowed. No standard deduction is allowed. She has income of royalty there, 4 lakh rupees. She has paid expenditure on royalty. In North Korea, now whatever the expenditure on royalty you bear, it is not allowed there. Okay. Sir, for example, she has business laws there. Sir, provision says North Korean government does not allow the business laws also set off. She has agriculture income. Sir, it is exempt there. Okay. So there she has North Korea. There she has short-term capital gain in North Korea. She has short-term capital gain in North Korea. She has capital gain of 1 lakh rupees. Okay. This is the incomes. This is the incomes. This is expenditure. This is the incomes in foreign country. She has incomes in India also. Incomes in India also. She has business income in India. I'm just highlighting it in this color. She has business income in 4 lakh rupees in India. She has interest income of 2 lakh rupees in India. She has income of dividend in India, 1 lakh rupees. Okay. Sir, whenever you calculate relief, for calculating the relief, you need to have total income. Sir, whatever relief you are calculating, section 19, section 90, section 91, sir, you got to have total income. You got to calculate total income, sir, as per both the reliefs. In both the reliefs, sir, total income will remain the same. Total taxes payable will remain the same. Sir, only the relief will change. Total income in India would remain same. How total income in India would be calculated? Sir, always remember everybody, total income in India will be calculated with the Indian tax laws provisions. Sir, for example, she has business income. She has business income. For example, she has business income, 4 lakh rupees, 4 lakh will be taken. She has interest income in India, that will be taken. Sir, she has dividend income in India, that will be taken. Whatever the income that she has in foreign currency, for example, rental income, whatever it is, sir, if it comes to India, sir, if this rental income is taxable in India, we are allowed 30% standard deduction. In India, we are allowed 30% standard deduction. So in India, how much rental income would become taxable? Rental income would be taxable at 30% less. That means 350 would be taxability in India. Sir, we are going to tax everything as per Indian tax law. Sir, we have taken this. Sir, whenever royalty becomes taxable in India, sir, we are allowed deduction on royalty. So, for example, in this case, if in India taxes such royalty, India gives deduction of this 50,000. Sir, in that country, sir, business deduction is not given to us. Any kind of deduction on business loss is not given to us. But sir, in India, we are allowing business loss. Now, whatever business loss you have, if you become a resident of India, you are allowed business loss. So, sir, in India, business loss we will also consider. Okay, sir, we got it. Sir, agriculture income is exempt there, but in India, agriculture income is taxable. Agriculture income on land outside India is taxable in India. Only agriculture income from land in India is exempt. Agriculture income from land in India is only exempt. Sir, whatever agriculture income you earn outside India is taxable in India. Okay. In that case, sir, agriculture income would be taxable in India. Whatever the provisions also as per income tax act is, sir, you have to take, and whatever the short-term capital gain is, the short-term capital gain shall also be taken. So ultimately, what you will do, sir, you will find out the total income. Your business income will turn out to be 650. Your capital gain income would turn out to be 1 lakh. Your IFO's income would turn out to be 660. This will give your total income to be 17 lakhs. So that 17 lakh will be calculated based on your income tax provisions. Whatever your income tax provision says, your total income will be calculated in that manner as per your income tax provisions. A simple point it is. Okay. Tax calculations are how tax calculation would turn out to be. So tax calculation as per 115 BSE, just 17 lakh minus 15 lakh into 30% plus 1,40,000 into 1.04, so 208 lakh taxes would turn out to be. So up to this, you have to follow in every answer. If this point is correct in your answer, you will get 2 marks out of 6 marks. You will get 2 marks out of 6 marks if this point is correct. So till here, I don't think anybody might be having any issue. Whatever income was there in North Korea, if at all is taxable in India, we have taxed such income. Sir, whatever the income is in India, sir, we have also considered that income and we have collected taxes on that. So let us suppose India does not have DTAA with that country. India does not have DTAA with North Korea. Sir, how relief is given? Just understand this with an example. Sir, if India does not have relief with that North Korea, sir, relief is given based on Section 91. Sir, we have to calculate the doubly tax income, foreign tax rate, and average rate of taxes in India. Three things we have to consider. Foreign tax rate, average rate of taxes in India, and doubly tax income. Sir, we have to take 3 things. Sir, what is the average rate of tax in India? We have calculated. Total taxes in India is 208. 17 lakh is the total income. So average rate of taxes in India would turn out to be 12.235%. This is the average rate of taxes in India. Sir, what is the foreign tax rate? Sir, what is the rate at which we have paid taxes in North Korea? Sir, we have to find out the percentage. Sir, we have to calculate the total income in this case. Sir, if North Korea in rent we have 5 lakh rupees, then entire 5 lakh is taxable there. No deduction is allowed. We will take 5 lakh. Royalty, since deduction are not allowed, entire 4 lakh is taken. Business loss not allowed, sir. We cannot reduce it. Agriculture income is exempt, so it will not be taxable. Short-term capital gain 1 lakh. All in all, sir, 10 lakh is the income in North Korea. Tax rates given to us, sir, 11 lakh 12,500 would be income in North Korea. So average rate of taxes in North Korea would be 11.25. So that is how we will calculate the foreign tax rate. Foreign tax rate will be calculated. Taxes paid in that country divided by the total income. That will be the average rate of tax. Third step we have to calculate is doubly tax income. Doubly tax income would imply, sir, the income that is taxable in both the countries. For example, income is taxable in India also, income is taxable in North Korea also. Sir, out of these incomes, which incomes are taxable in both the countries? Listen. Rental income is taxable as 5 lakh rupees in North Korea, and such income when came to India, we allowed 30% deduction. So for that matter, sir, doubly tax income would turn out to be 3.5 lakh only now. Doubly tax income would be 3.5 lakh only, because if it is taxed 5 lakh there and we are just taxing it at 3.5 lakh rupees, doubly tax income would imply only 3.5. Yes, sir, doubly tax income would be 3.5 lakh only. Sir, royalty income 4 lakh being taxed there because no deduction is allowed, but in India we allow deduction, so we have 3.5 lakh only. Okay, sir. Sir, business loss, whenever you are given business loss, always reduce this business loss. Always, while calculating W tax income, always reduce this business loss. Make it a thumb rule, always reduce business loss. So always reduce 1 lakh. So agriculture income, just listen to this point. Agriculture income will be W tax income. Right answer is no, sir. Agriculture income will not be W tax income because it is exempt there, na. If agriculture income is exempt there, and we are not charging taxes, we are charging taxes in India, do you think that there is any portion which is being double taxed? Right answer is no, no. We are just charging taxes in India. Income is not exempt there, so it is not W tax income. So no benefit on agriculture income is taken. North Koreans, so short term capital gain, sir, W tax income would be 1 lakh. So our W tax income would turn out to be, sir, all in all, W tax income would turn out to be 7 lakh. 7 lakh would be W tax income. Sir, how relief is given under section 91? You have to take the lower of average rate of tax or foreign tax rate. Lower of you have to take. Lower of average rate of tax or foreign tax rate. You have to multiply it with the W tax income. Whatever the lower of average rate of tax or foreign tax rate is, multiplied with the W tax income. So whatever figure you get, sir, that will be the relief given to you. So lower would turn out to be, sir, 11.25% multiplied by 7 lakh. This will give the W tax income. Our relief would be 78,750. That is how our answer is written, 78,750. So what I did is that as per section 91, how you have to calculate, three things to be taken. First of all, sir, calculate the total income as it is as per provisions of Income Tax Act. Calculate the tax liability as per the provisions of Income Tax Act. The way it has been told, you have to do it. Sir, but after calculating the tax payable, sir, we have three things to be taken. First of all is W tax income, second is foreign tax rate, third one is average rate of tax. Average rate of tax you will be able to calculate properly. If you have calculated taxes properly, then taxes by total income will give us average rate of tax. It is simple, no issue. Foreign tax rate you have to calculate, sir. You have to calculate the total income given in the question in that country. Total taxes paid therein. Sir, you will get a percentage that will be foreign tax rate. In most of the questions, it is directly given. It is directly given foreign tax rate. W tax income is the critical area. The portion of the income that is taxed twice is the W tax income. For example, agriculture income was exempt there, but here taxable. So W tax income will be nothing. Any income that is taxed there but exempt here, sir, W tax income will be nothing. Getting W tax income would be nothing. Are we clear on that front, sir? Whatever that, for example, house property is taxable 5 lakh there. Here it is 3.5. W tax income would be 3.5 lakh only. Sir, I hope you are getting the income which is taxed in both the countries will be considered here. Sir, as you get W tax income, you have to multiply it. You have to multiply this W tax income with foreign tax rate or average rate tax in India. That is how section 91 relief would turn out to be. But sir, section 90 relief, how you have to calculate it? Just imagine Shalini was earning income from North Korea and North Korea has GTAA with India. Assuming, sir, North Korea has GTAA with India, how things will go? Sir, total income would be considered as it is. Total income would be considered as it is. Tax calculation would be considered as it is. Sir, as it is, it will be taken. Average rate of tax will be calculated as it is. Sir, average rate of tax, average rate will be calculated as it is. Sir, section 90 relief is given with lower of 2. Whatever the taxes you paid there, whatever the taxes you have paid there, sir, first thing you that is to be taken. Sir, what taxes we have paid, sir? 1,12,500 is the taxes paid there, sir. Absolute amount of taxes you have to take. Whatever the absolute amount of taxes is, sir, you have to take that. Second thing that you have to take is, sir, taxes on such income in India. If such income is brought to India, so such income is 7 lakh rupees only. 7 lakh of such income is only considered. And in India, we pay average rate of tax at the rate of 12.35%. So in India, we are paying taxes of rupees 85,645 rupees. Whichever is lower would turn out to be 85,645. And as per section 90, relief would be 85,645. Same transaction, same income, sir. Only difference of relief is on account of DTAA and non-DTAA. Reason being, sir, while calculating 91 wala relief, sir, we take W tax income multiplied by average rate of tax or foreign tax rate, whichever is lower. But while calculating relief under section 90, sir, we take lower of, sir, taxes paid in that country versus taxes paid on such foreign income in India. Taxes paid on such foreign income in India. We take that figure. I hope you got the point. So that is how you will calculate relief. Sir, with this concept, now you will be able to solve 90% of your questions. You will be able to solve 90% of your questions, sir. But there is a concept that I must tell you. There is a concept that I must tell you, sir. Sometimes, sometimes you are given earnings in foreign currency. Sometimes you are given earnings in foreign currency. Sir, many a times it is given that capital gain earned is $10,000. Many a times you are given dividend earned of rupees 5,000 rupees in dollar. You are given PGBP earned 10,000 rupees dollar, $10,000. Sir, whenever such foreign currency is being given, sir, you have to apply conversion rules. You have to apply conversion rules, sir. Without conversion rules, sir, you cannot proceed forward. Provision says how conversion is being made. Understand this with this classic example. Not example, but a classic thumb rule. Whenever you have business income, except for shipping business, whenever you have a business income, whenever you have business income, sir, whenever you have house property income, or whenever you have IFOS income, sir, except for interest and dividend, sir, except for interest and dividend, whatever IFOS income you have, for example, lottery income, sir, PGBP, house property, and IFOS, except interest and dividend, sir, they are converted with the exchange rate as on 31st March 2025. That is previous year ends exchange rate. The rate existing on the previous year end, that is the exchange rate taken on previous year end. Sir, if we have any other income, if we have any other income, sir, for example, we have capital gain, we have salary, we have interest dividend. Sir, we might have paid taxes also. We wanted to convert those taxes. What to do in that case? Provision says whatever the things are, sir, those are converted with the month of receipt or accrual. The month in which it is received or the month in which it is accrued, sir, take date of preceding month's last date. For example, if dividend is received on 10th March, sir, take 28th Feb's rate. If salary is received on 1st May, sir, take 30th April's date. Sir, whatever the date that is being given to us in which it is received, sir, take preceding month's last date for the conversion. For example, taxes are paid on 28th May. Take 30th April's date. Sir, if capital gain is asset is being transferred, if asset is being transferred on sir 15th Jan, sir, take 31st December. Sir, for all the other things, except for these things, all the other things that you may see, sir, you have to use the preceding month's last date rate. Are we clear on this front? Are we clear on this front? Are we clear on this front, sir? Sir, we are doing marathon for a day before exam. We are not doing a full-fledged class. I think as per rule 115, you are absolutely clear with the conversion rules. You are absolutely conversion with the exchange rules. Let me take you through. Let me take you through the book. What exactly it says. Sir, you have to use buying rate of SBI on these dates. Okay? For example, you might be given with multiple bank rates. You have to take the SBI rate. So that too, buying rate is the optimum buying rate you have to use for the conversion of foreign currency into rupee. For salary, last date of the preceding month in which salary is due. Each securities, sir, last day of the preceding month's capital gain, last date of the preceding month's dividend, last date of the preceding month's PGBP, last day of the previous year house property, other sources, last day taxes, sir, last day of the previous month. So this is how you have to convert the currencies. I hope you are clear with this fact. So double taxation avoidance agreement, we'll study this. We'll study this. We'll study this. Okay. Mhm. Sir, whenever we don't have DTAA with India, for example, India does not have DTAA with North Korea. Credit is only given if 4 conditions are satisfied, and you have to write down these conditions in exam. See, assessee is resident of India. Assessee should be resident of India. Assessee has earned income outside India. Assessee had paid taxes there, and there exists no DTAA between India and those countries. Then only you will be given credit. You are resident of India. You have earned income in that country, you have paid taxes in that country, and there exists no DAA with that country. Therefore, you are given relief under section 91. The method that I have told you is simply given in this manner. That completes our DTAA topic. Any doubt in DTAA? Coming on to next topic, equalization limit. DTAA's major contribution is business income. Understand this. As per every DTAA, remember, as per every DTAA, if you want to tax business income. For example, India and Australia has DTAA. Australia's company is working in India. Then we can tax income of such foreign company only if such foreign company has permanent establishment in India. What I'm saying is, sir, if you want to tax the business income of the other company who is resident of any other state, if you want to tax the business income of any of the other company which is the resident of any other state, sir, you can only tax the business income only if such company has permanent establishment in India. But sir, the issue with the permanent establishment is deep and old. For example, Spotify does not have any permanent establishment in India, or LinkedIn does not have any permanent establishment in India. But sir, they used to carry money outside. They used to take money from the Indian people. They used to earn from advertisement. Sir, they used to earn many things from India, and they did not pay any taxes because of DTAA. They did not have any permanent establishment in India. As per DTAA, if you want to tax any income, if you want to tax any income of a foreign company in India, that foreign company must have permanent establishment in India. If foreign company does not have any permanent establishment, you cannot tax its foreign income. So, sir, many of the foreign company never used to have any kind of permanent establishment in India. Therefore, their income was not taxable in India. For that matter, government government in Finance Act 2016, in action in encounter to action to encounter to base action BEPS action plan 1 introduced equalization levy. What the issue was, for example, Spotify played many ads in India, took money from both for the advertisement, and did not pay any taxes in India. So what government did? Government tied the knot on the cat. Tied the knot on the cat, sir. That is government government forced both to deduct a TDS. Oh, sorry. Government forced to deduct a TDS. Oh, sorry. Government forced to deduct TDS. Government forced to deduct equalization levy. Sir, why I did overreacted? Sir, ultimately it is TDS only. This Indian entity, while making payment to any of the non-resident for the purpose of advertisements, it has to deduct the equalization levy at the rate of 6%. The way this Indian company deducts the TDS is the same way it has to deduct the equalization levy. Remember how things go. Whenever an Indian company or any permanent establishment of a foreign company pays any of the non-resident, sir, advertisement fees or any digital space services or any other advertisement related activities, if it pays anything similar to that, so this resident person has to deduct the equalization levy at the rate of 6%, at the 6% on the amount of consideration paid or payable. Whatever the consideration this Indian person is paying to the non-resident for the purpose of advertisement, it has to deduct the equalization levy at the rate of 6%. So as soon as this Indian entity deducted the equalization levy, it has to pay it to central government, so up to or on or before 6th of next month. Before 6th of next month, this Indian entity has to pay this equalization levy to the non-resident. Okay. This Indian entity has to pay equalization levy. This Indian entity has to pay equalization levy to the government up to 7th of next month. For example, EL deducted on April. So it has to be paid on 7th May. If it deducted on 7th May, it has to be paid in 7th June. So every month, next month, 7th, it has to pay. Okay, sir. So there are certain instances where equalization levy is not to be deducted. Equalization levy is not to be deducted. Sir, what are those instances? First of all, sir, for example, if this non-resident is Google, Google is having office in India also. And sir, Rahul is taking services from this Google India office. So, sir, why equalization levy would apply? Ultimately, if Google India is paying taxes, income taxes in India, why equalization levy would imply? Sir, equalization levy would not be attracted if Rahul is taking services from NR having permanent establishment in India. Second cheese. Sir, if resident person is paying equalization levy up to 1 lakh rupees in a previous year, I'm just paying up to 1 lakh rupees. Shouldn't I be exempted from equalization levy? I'm just paying 1 lakh rupees. Shouldn't I be exempt from equalization levy? I consider yes, sir, I should be exempted. I will not be charged any equalization levy in this case. I don't have to deduct any equalization levy in this case. Sir, we are clear with that fact. Sir, okay with that. Sometimes what happens is, sir, sometimes You pay for advertisement for personal purpose. Sir, for example, I want to get married and I want my biodata to be circulated in Russia. In Russian matrimony, I want my biodata to be circulated because I want a Russian wife. So for that matter, I am paying this money to advertise myself in personal capacity. And I am not paying it for business purpose now. So provision says whatever payment you are making for personal purpose, not for business purpose, sir, it is not considered leviable for equalization levy. You don't have to deduct equalization levy. Sir, interest and delayed payments are how much if you pay equalization levy delayed, sir, 1% per month and part of the month from the 7th will apply. If you did not pay equalization levy on 7th, sir, you are required to pay interest at the rate 1%. Sir, if you did not deduct equalization levy, sir, 100% of the amount would be leviable for penalty. Whatever the equalization levy was supposed to be deducted, sir, that much amount would be leviable for penalty. If you did not pay the equalization levy on the due date, so 1,000 rupees per day penalty would be applicable. 1,000 rupees per day penalty would be applicable, but not but subject to maximum equalization levy only. If there is reasonable cause of failure, sir, no penalty. No penalty in case of reasonable cause of failure. Sir, whenever you deduct equalization levy under section 165, in that case, what to be done? Sir, you have to furnish an annual statement. Annual statement in what sense? Sir, whatever equalization levy you had deducted for previous year 24-25, you have to submit the statement of that in form number 1 on or before 30th June 2025. That means as soon as previous year ends, you have 3 months, you have to submit the form 1 in which you have to submit the whatever equalization levy you have deducted, you have paid. Sir, if you did not submit on if you did not submit the form on time, you have time. You can submit the form within 2 years from the end of the financial year in which services are provided. As soon as you provide the services within the 2 years from the end of the financial year, you can submit this form, sir, no issue. As soon as you submit the form, sir, for example, if there exists any issue, if there exists any demand, sir, whatever the demand that is being there in the form, sir, that will be carried to you in demand notice in form number 2. Whatever the interest penalty, whatever the late fees that has been levied to you will be given in form number 2. If you think that demand order contains some mistakes apparent from record, you can seek for rectification. Rectification can be sought within 1 year from the end of the year in which order containing mistake was passed. So if you are not satisfied with the order, sir, if you are not satisfied with the demand order in form number 2, you can go to CIT appeals within 30 days plus 1,000 fees. If you are not satisfied with the order of the CIT, you can go to ITAT in form number 4. So 1,000 rupees fee, 60 days, or sir, 2 months from the end of the month of the order, you have to go to ITAT. Remember, sir, whenever during the proceedings, if you furnish the false information, or sir, if you deliver information which is not true, sir, you will be punished with 3 years of imprisonment plus fine, sir, with prior approval of CCIT, and it is a non-cognizable offense. Non-cognizable offense imply, so they can put you in the jail. They can simply put you in the jail without any arrest, so with arrest warrant, sir. They require arrest warrant to put you in the jail. Sir, if equalization levy is not deducted or not paid, sir, in that case, 100% of such expenditure is disallowed in the year, sir, in the year in which it was supposed to be deducted. And sir, later on, if you pay it, then in whatever year you pay it, you will get remaining 100% deduction. So, for example, this is Rahul, and this is Spotify. I made payment of rupees 3 lakh rupees, deducted equalization levy, and paid to government. Provision says as soon as I paid this money after deducting equalization levy, sir, in that case, what will happen? So this income of 3 lakh would become exempt in the hands of equalization. Income would become exempt in the hands of Spotify. Income would become exempt in the hands of non-resident as soon as equalization levy is deducted. That completes our equalization levy topic. That is not the topic which we need to stretch much. Now comes the most important chapters. Overview of tax conventions, tax treaties, and sir BEPS. Model tax conventions. Any doubt till now? See, whatever relevant in this topic is, I will be teaching that only. I will not teach anything that is not necessary. But have trust in me. Have trust in me. Sir, you should not think of leaving these topics. You are bound to see a question of 4 marks from this topic. And sir, if you miss out now, I think you will miss out 4 marks. I guess sometimes 6 marks you might miss out. Any doubts to anybody till now? Just before break, we had done only 2 chapters. After break, we did 3 chapters in just 50 minutes span. Any doubt to anybody? See, if you have come this far and you have not liked the video, I humbly request you do like it now. What it takes yours? What did it take yours for not liking the video? Do like it now. It really motivates me a lot. And if you have already watched this lecture, do take a time and do comment down your experience, how your experience has been with the lecture. Any suggestions, any improvements would be beautifully accepted. Overview of model facts conventions. What this chapter is all about. Understand this. Sir, 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 sir. Sir, in DTAA chapter, we understood that two countries would sit together and they will form DTAA. Sir, how DTAA would be? What will be the format of DTAA? See, if you remember in small classes, we used to study letter. Letter were of two types, are formal letter, informal letter. Formal letter would be such sender's address, date, address is address, subject, salutation, content, regards. That was the format. But sir, in informal letter, we had a format, sender's address, date, then salutation, and then content. We had a format to write a letter now. And that format would be standardized. So, sir, similarly for double taxation avoidance agreements also, we have a standard format to be followed. Whenever two countries form DTAAs between them, so they have a standard format as to which article will talk about which thing. What has to be agreed between the two? What is the common basis on which they can agree? Sir, who people will be covered? Sir, what things are to be covered? So everything will be discussed in this standard format. And that format is nothing but model tax conventions. Model means sir format. Tax convention imply tax treaty, tax treaty, or you can say tax agreement, you can say double taxation avoidance agreements, or whatever you want to say. Everything is meant by tax convention only. This is what model tax convention means. As of now, we have 3 kinds of model, of which the third model is not relevant. Sir, we have OECD model. OECD model implies, sir, if any of the two developed countries like France and Germany, if France and Germany together want to make a double taxation avoidance agreement, sir, they will follow the OECD model. OECD model normally emphasizes on resident rule. Whoever the resident of the country is has the right to tax such income. Any income, so residence rule has the right. Source has no right of taxing such income. Wherever you are earning, sir, you are not going to pay any taxes there. Rather, wherever you are residing, you are being taxed there. Sir, OECD model has 32 articles. Sir, UN model, sir, whenever some developed and developing form DAA, or developing and developing form DAA. Sir, for example, Japan and India form DAA, so they will follow UN model. For example, if South Africa and India follow DTAA, sir, they will follow UN model. So whatever the DTAA that you are going to read, sir, with India, sir, it will be as per UN model because India is developing country. And sir, whenever a developing country forms a DTAA, sir, it emphasizes on, sir, compromise between source and residence rule. Some of the income is being taxed by residence rule, some of the income is being taxed as per source rule. It has 31 articles. Sir, we also have US model. If anybody transacts with USA, how DTAA will be created? Sir, it is not relevant for us because it is not given in syllabus. But sir, we have US model and we have UN model and OECD model. Sir, whenever you read a DTAA, sir, it will always start with, sir, this DTAA is meant for avoidance of double taxation. Sir, it will be the treaty, sir, not relevant. Preamble is also not relevant. Sir, Article 1. Every DTAA will talk about who people are covered, to whom this DTAA is applicable. Sir, first of all, DTAA is applicable to resident of either of the countries. If there is agreement between India and Australia, if I am the resident of India, it is applicable to me. If I am the resident of Australia, sir, it is applicable to me. If I am the resident of both the countries, sir, it is applicable to me. Sir, are we clear on that? Yes, sir, absolutely clear. So there is a term called fiscally transparent entity. I don't want you all to understand even this. but there is a term given just briefing you out. For example, if India and Australia has DTAA, and in Australia we don't have any concept of partnership firm. For example, partnership firm. Whatever the partners are the partnership firm, and whatever the partnership firm is the partners only. There is no separate identity of a partnership firm. So provision says if, for example, of the partners, one of the partners stay in USA or stay outside Australia, in that case, so DTAA would only apply to the partners who are resident of Australia. This is called fiscally transparent entity. So sometimes it may happen that such incorporation status is even not recognized by that country. For example, partnership firm is not recognized in that country. So whatever the partners are non-residents are to whom on whom so DTAA would not apply. So that is what called fiscally transparent entity. So if you remember this, well done. If you do not remember this, you can ignore. Taxes covered, sir. What are the taxes covered, sir? Remember, always DTAA would cover the income taxes, capital taxes, or sir capital appreciation taxes like wealth tax, or sir any other similar taxes that might come into force later on. Sir, important article. Sir, important article. Residence. See, who shall be considered resident shall be determined under article number 4 of every DTAA. Sir, what this article says, sir, resident shall be considered as resident. A person shall be considered resident if he is resident as per their domestic tax laws. Sir, as per Indian tax laws, who's resident? Sir, if I stay for 182 days or more in India, I shall become resident. In Australia, sir, there might be law where if any person stays for 95 days, he shall become resident of India. So a person can be resident of that country if he satisfies the local laws. That is to be understood. Sir, but there is possibility now. There is possibility that a person might become resident of India as well as he might become resident of South Africa or Australia also. He might become multiple nations. He might become resident of multiple nations, sir. In that case, what to do? Provision says if he becomes resident of multiple nations, then in that case, na, so there applies a tiebreaker rule. Tiebreaker rule implies, sir, you have to check exactly whom in actually which country is going to tax them. There applies a tiebreaker rule. So for that matter, you have to check his permanent home. Where does his permanent home lie? Where does he has a permanent pakka home for a complete house? Sir, if he has house in both the countries, for example, he has house in Australia and India, both the countries, then what will happen? Provision says if he has house in both the countries, then you have to check second condition, which says in which country he has more close personal and economic relationships. If he has more personal and economic relationship close in India, then he will become Indian resident. If he has within Australia, he shall become Australian resident. But sir, if he has both personal economic relationships strong in both the countries, in that case, sir, what will happen? Sir, you have to check his habitual abode. Normally, where does he stay? Sir, he stays in India for 100 days, or he stays in India for Australia for 365 days. Normally, where does he stay? Sir, if he stays equally, then what to do? Then you have to check the nationality, sir, where he becomes national, which country he possesses the nationality. If he possesses normally India has only single nationality system. If you are national of India, no, sir, you cannot get citizenship of any other country. If you get citizenship of any other country, you have to leave the nationality of India. So for that matter, provision says, sir, if he becomes national of both the countries, sir, in that case, what happens? Sir, competent authority of both the countries would come together and discuss. This is for the first time I'm talking mutual agreement procedure. Sir, competent authorities of two countries would sit together and discuss as to who shall tax this person. That is how tiebreaker rule would end. So for other individuals, other than individual like company, like firm, like LLP, sir, poem and place of incorporation provisions would apply. Sir, what I said, just repeating. Sir, you just have to check the permanent home. If permanent home in the both the countries, you have to check the sir personal and economic relation. If they are strong in both the countries, you have to check the habitual abode. Sir, if habitual abode is similar in both the countries, if he's actually a resident of both the countries, in that case, you have to check for nationality. If he's national of both the countries, he shall become sir. Oh, so sorry. In that case, mutual agreement procedure would take place. Sir, important segment, article number 5, most frequently asked. What does this article imply? Understand this with an example. What it says. Sir, for example, sir, if foreign company has permanent establishment in India, permanent establishment implied. Sir, any fixed place of business? Any fixed place of business through which enterprise carries on the business shall constitute PE. If foreign enterprise has any fixed place of business in India, through which such foreign enterprise carries on the business. Provision says such fixed place of business is called permanent establishment. Okay, sir, we got that point. If foreign enterprise has permanent establishment in India, then only we can tax its business income. Then only we can tax its business income. So that is why permanent establishment is important, sir. But permanent establishment has been holistically defined. It is not just the fixed place of business. Sir, there are many other meanings of permanent establishment. Sir, let us understand one by one. For example, sir, there is a building site construction projection. So, for example, a foreign company does not just comes to India for some time to do any project work for installation of any site for a construction of any building. Provision says if such project is undertaken for more than 12 months, then as per OECD model, it is called permanent establishment. Any income from the project shall become Indian income. But sir, as per UN model, if such project is for 6 months only, na? If such project is for only 6 months, then in that case, sir, it shall become permanent establishment. So OECD model talks about 12 months. The UN model talks about 6 months. This is about the first time we have a difference between OECD model and UN model. OECD model says you have to at least have site for 12 months, then only it will become PE. Otherwise, sir, in UN model, if it is for 6 months, it shall become PE. Sir, we got that point. Sir, UN model provides for service PE, whereas OECD model does not. Sir, for example, there is a company called Spotify. Spotify does not have any office in India. It does not have any office in India. It does not have any office in India. But sir, some of the staff of the Spotify comes to India and provides services and earns income. Provision says, sir, as per OECD model, whenever this staff comes, this staff would not constitute PE. But sir, if it is UN model, sir, if such a staff stays in India for greater than 183 days, sir, whatever the income from this staff, this Spotify is earning, whatever the income from the staff, this Spotify is earning, sir, that shall constitute business income. That shall constitute the income. This staff shall consider as PE, and whatever the income from this staff, this Spotify is earning, that shall be taxable in India. Sir, both UN model and OECD model say that if foreign company has an agent in India, dependent agent who contracts on behalf of foreign non-resident, secures order, maintain inventory, any of the thing that if non-resident person does, sorry, if this agent does, sir, in both the models, this agent is called permanent establishment. This agent shall constitute permanent establishment. Sir, if any of the foreign companies, sir, collects insurance money from India, for example, I want to buy health insurance and I bought health insurance from a company located in Somalia. Provision says whatever the income the Somalian company has, sir, that shall be Indian income only. Sir, this company is deemed to have a foreign company. If any of the insurance collecting enterprises there, whoever collects insurance money from India, sir, that company shall be deemed to be having a permanent establishment in India. Sir, if any of the fixed place is only for collection of information, sir, no PE. Sir, for example, if any of the foreign company has BPO, KPO, sir, BPO, KPO would not imply any kind of permanent establishment. Sir, these are not permanent establishments. If any of the company has a hoarding in India, a place for advertisements, sir, it is not considered as permanent establishment. If any of the foreign company has website, it is not considered as permanent establishment. But sir, server may be permanent establishment. Sir, example, foreign company has an independent agent. Sir, independent agent would not constitute PE. Sir, only dependent agent would constitute. And sir, any subsidiary joint venture, sir, if a foreign company has subsidiary joint venture, thus this does not imply that this foreign company has permanent establishment in India. Only subsidiary would be considered as PE. Sir, this is how PE would be concluded, sir, whether foreign company has PE in India or not. Sir, once permanent establishment has been identified, remember, if such foreign company is having PE in India, if such non-resident is having PE in India, then only we can tax that business profits. Then only we can tax that business profits. If such foreign person does not have any PE in India, we cannot tax his business profits from India. He cannot tax his business profit from India. Sir, there exists a force of attraction rule. I personally think that this might be asked in exam. Asked in exam. Sir, what this force of attraction rule implies? Just understand this with an example. Sir, for example, there is a company called Tesla. Tesla has an office, a sales outlet in Satna. I mean, such sales outlet in India. Okay. Tesla has sales outlet in India. We have with us Monisha. Monisha wanted to buy. Monisha wanted to buy a Tesla car. Okay. She went to sales outlet and decided to buy a car. So as soon as she placed the order, a Tesla from USA was exported and imported in India, and payment was taken away by USA Tesla. Sales was not recorded. This sales was not recorded by this branch. Rather, sales was recorded by the US Tesla. Oh my God, sir! Oh my God! Oh my God, sir! Oh my God, sir! What did it actually means, sir? Sometimes it happens that sir sales is being done by the local branch, but sir affected by the foreign company. In this case, sir, as per force of attraction rule, whatever the sales that has been done by this foreign person shall be considered as sales of this Indian person only. Sir, sales is being considered in the domestic player only. Sales shall not be considered as to be done on regard of this non-resident. Sir, sales shall be done in the name of non-resident only. Sir, a resident shall be deemed to have constituting this sale. A resident shall be deemed to have constituting this sale. Are you clear on that point? Are we clear on that point, sir? A resident is deemed to have constituting that sale. So this is applicable in case of OECD. This is applicable in case of UN model. Profit earned in the source state from direct sales by the HO. Sir, for example, there is a branch, but direct sales has been made. Clear, sir. Okay. Direct sales has been made instead of P. Then it shall be profit of permanent establishment only, sir. It is followed in UN model, not by OECD model. Okay, sir. Got it. We got this point. So interest income, sir, interest income is normally taxable in the hands of resident state. But sir, in case of OECD model, sir, in case of OECD model cannot tax interest in the source state more than 10%. Sir, UN model can tax interest up to the specified percentage. Sir, we don't need to learn this. We need to learn the meaning of interest. What is the meaning of interest? See, what is the meaning of interest? It is good feeling. Sir, whatever the money that I give to somebody, whatever the debt I give to somebody, any income on such debt shall be interest. If I give you any money, whatever income I'm earning on that money is interest. Whatever debt I give you, sir, whatever the income on debt that has been given to me is interest. Sir, debt can be secured, debt can be unsecured, debt can be with mortgage, debt can be without mortgage, debt can be participating in profit, debt cannot be participating in profit. Whatever it says, sir, it is considered as interest. Oh my God, sir. Oh my God. Oh my God, sir. Oh my God. Oh wow, sir. Income from debt claims of every kind, whether or not secured mortgage or whether or not participating in profits or not. Okay, sir. Got it. Article 1212 talks about the royalty FTS. Royalty FTS, you need not to learn it. You just need to understand. Whenever the word royalty is given, sir, it is taxable in UN model. Sir, as per source or resident, sir, there has to be compromise between source and resident. Source cannot tax more than agreed percentage. OECD model, only resident can tax. FTS, as per UN model, sir, source plus resident compromise. Source cannot tax more than a specified person. OECD model, nothing talks about FTS. Sir, only resident can tax. Sir, you don't need to learn this. Sir, now what it says. Meaning of royalty is important. Meaning of FTS is also important. Understand this. Sir, again, FTS implies TMC, Trinamool Congress, Technical Managerial Consultancy Services. Technical Managerial Consultancy Services is the FTS. Sir, but royalty meaning is different here. Listen. So section 9, we understood royalty. 5 things were considered as royalty. First of all, if you remember, 5 things were considered as royalty. First of all, if you remember, sir, any kind of intangible assets use, any kind of transfer of intangible assets, any kind of commercial equipments, any kind of imparting knowledge, any kind of ancillary services were royalty. Section 9 it was. But here, sir, we have different meaning in one UN model, in OECD model. Sir, intangibles, right to use is being considered royalty by OECD also and UN model also. But sir, UN model also includes 2 more things under royalty. Sir, if any rentals is being paid, rentals for, sir, industrial, commercial or scientific equipment, sir, very deep point it is. Any kind of rental on commercial, scientific, Industrial equipment is also royalty. Under UN model, any kind of rent on industrial, commercials, and scientific equipment is also royalty. Plus, sir, rentals for film tapes used for television broadcasting. If you are paying any rentals for film tapes that are used for television broadcasting, so that shall be also considered as royalty. So these two things are considered as royalty in addition to intangible assets use. But sir, OECD model does not include this thing. That means if machine is being given for rental, for example, I give machine in on rental, whatever income that I am earning is royalty as per UN model, but it is not royalty as per OECD model. Remember, any kind of income, any kind of rental income from industrial, commercial, scientific equipment, so that is not royalty as per OECD model, but it is royalty as per UN model. Okay, sir. Only difference you need to understand. Otherwise, sir, meaning is not relevant. Sir, cap gain you can ignore, independent P you can ignore, sir, other income you can ignore. Sir, elimination of double taxation, what you need to understand, sir, whenever you earn any kind of income, if country has DDAA, India is going to either exempt this income or either India is going to give credit for that income. If India does not have right to tax such income, sir, India is either going to give exemption on this income. India will completely exempt such income. Or sir, India will give tax, India will use tax credit system, which implies that India will include the people of India would include the income in their total income, and ultimately, sir, credit will be given as per section 90. Section 20, Article 24, what it says. Article 24, what it says, sir, provision says, sir, there should be no discrimination between resident and non-resident. Ha 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 ha. Sir, what a joke. No discrimination between resident and non-resident. Okay. Article number 25, sir, mutual agreement procedure. Sir, this is the point where I have to stretch a bit. Listen to this point carefully. Sir, there might be many disputes. There might be many disputes. There might be issues relating to who residential status is. There might be issues relating to determination of arm's length price. If you remember, we studied this mutual agreement procedure in transfer pricing also. So there might arise many disputes. So to settle those disputes, there has to be two competent authorities sitting together. Sir, whenever they sit together, sir, they come at a common conclusion. Sir, this is called mutual agreement procedure. This is called mutual agreement procedure. To make things simpler, to simplify things, to better administer the taxes. These are the benefits of having mutual agreement procedure. That is the basic thing. What thing to be understood here is, sir, what if after mutual agreement procedure we do not agree? What if after mutual agreement procedure we do not agree? Sir, there is a catch. Listen, for example, India and Australia sat together, and we did not agree. I mean, we agree on a certain points, but India wants to go against it. India did not agree. India was forced to meet agree. Sir, can India go to somewhere, any international court? The answer is yes, sir. India and Australia both have power to go for arbitration. Both have power to go to arbitration, and so that arbitration will be a third person, a third mediator. For example, India and Australia had a fight. They asked USA to become the arbitrator. They asked USA to become arbitrator. Now there is a catch. They can go to arbitrator, but there is a catch. Listen. Sir, as per UN model, countries have to go within 36 months. As per OECD model, sir, countries have to go to arbitration within 24 months. Okay, sir. Okay. So when 36 months, within 36 months, arbitration can be taken. So in OECD model, 24 months arbitration can be taken. Listen. Sir, in UN model, any of the party, India or Australia, can go to arbitration. But sir, OECD model, only the party who is aggrieved has to go to arbitration. Sir, in OECD model, sir, whatever the order of arbitration is, sir, you have to follow. But sir, in UN model, you can depart from the order of the arbitration. You have to inform that you are not following the arbitration within 6 months. You can depart from arbitration also. This is the difference between mutual agreement procedure between OECD model and UN model. Sir, exchange of information, to have better exchange of information. For example, Indian people have, Vijay Mallya is residing in London. Now, Indian government wants information of Vijay Mallya. Can it take? Right answer is yes, sir, it can take. It is only possible because India and England has TDAA and it has Article 26 in it, which talks about exchange of information. Sir, exchange of information between the two states so that there is avoidance of tax evasion and there is better exchange mechanism. Sir, this exchange of information should be applicable. This is applicable for better tax compliances and administration purposes. Remember, sir, whenever India asks any information from London or Britain, so Britain has no obligation to supply information which is not obtainable. Sir, if India wants how many women did die yesterday, example, if India wants to know how many women did die yesterday in London, if London cannot provide. United Kingdom cannot provide such information. Provision says if any of the information which is not obtainable, it is not supposed to give. Second thing, if any of the information which pertains to trade secret, they are not supposed to give. For example, if I want to know from USA what is the secret of McDonald aloo tikki burger, what is the secret? What is the secret ingredient of Coca-Cola? Sir, it is not going to give any information which is relating to trade secret. And at last, sir, any information which is against the public policy, they are not going to release. For example, Indian people want to know what happened in US election. We want the video footage of that. Are they going to give? Right answer is no, sir. Any information which is not obtainable against the business trade, against the public policy, or discloses any trade or business assets, in that case such information shall not be disclosed. Also, sir, there has to be a clause in which this information should not be shared to third person. So there has to be no non-disclosure of information to the third party, sir. What are the important clauses, sir? Clause number 26 is important. Clause number 25 is important. Other than that, sir, meaning of royalty is important. Meaning of interest is important, sir. Force of attraction rule is important. Permanent establishment rule is important. The tiebreaker rule is important. But that's it. And sir, OECD versus UN model is important. Sir, nearly 4 or 5 points are important of this 15 minutes video. If you see it again and again, you will be able to remember everything very properly. Are we clear on this front? Any doubt to anybody? Let's do the question answers now. Let's see question answers if we have any. Difference between UN model, OECD model, sir. UN model, OECD model, what the difference is, sir? We have only two differences. UN model is being followed by developing nations. OECD model is being followed by developed nations. UN model is also followed by developed and developing nations. Sir, OECD model follows on a residence rule. UN model follows, sir, compromise between source and residence. Sir, tiebreaker rule, sir, you have to check the permanent home, then sir, personal relation, then we have to check habitual abode, then we have to check nationality, then we have to check the mutual agreement procedure. So interest, any income on debt claims of any kind. Sir, fees for technical services, sir, it is managerial technical consultant services. Sir, this is important question. You can put a star mark on. What is meant by automated digital services, sir? It implies any kind of online advertisement services, online user services, sir, or search engines, social media platform, digital services, online gaming, or standardized online teaching methods. So these are online services. So royalties meaning that, as I have already told you, so right to use any kind of intangible assets. Along with that, OECD model or UN model also includes these two things as royalty. Exchange of information, sir, exchange of information and their benefits. So what are globe rules? I want you all to hold for it. I will tell you it. I will tell you about it later on. Any doubt in this topic? It was easy topic. Model tax convention is very easy. It's not difficult as such. Whatever I have told you is only relevant. Apart from that, you can skip out things. Clear, sir. Oh, we came across multiple chapters. In double taxation avoidance agreement, we understood what is DTAA, what is the purpose of it. In model tax conventions, we understood how DTAA is relevant, so how it is formed. In this chapter, we are going to understand, sir, why DTAA is important, and sir, how to read it. See, what happens is, whenever DTAA is formed, sometimes it is written 550 years back, so sir, things have to be changed. Sometimes meanings are written 50 years back, so it has to be interpreted currently. So how interpretation of taxation agreements is being made is to be done, sir, is to be studied in this topic. Whatever the changes, whatever the uh, interpretations, applications, tools for interpretations we have. Sir, when a treaty would apply, when a treaty would not apply, what are the cases where treaty might change? Sir, what everything related to treaty that is relevant for us to understand. So these are interpretation tools. This is what constitutes this chapter. So first of all, first part of this chapter is what constitute international laws. For example, if India is transacting with Australia, what laws would apply on these two? What laws would apply between India and Australia? First of all, first law would apply, that is double taxation avoidance agreement. If India and Australia has a double taxation avoidance agreement, that would apply between transaction of India and Australia. Second thing, sir, second thing would apply would be customary international laws and general principle of laws. For example, if it is general practice to charge custom taxes, so therefore general principle would apply between India and Australia transaction. If customs are being attracted everywhere, it is common parlance to attract custom. So such things would be considered, such laws will be applying on this transaction. Third thing, whenever transaction takes place between two countries, so Vienna Convention of Law of Treaty will also apply. So what does this imply? Vienna Convention Law of Treaty implies that many of the countries in I guess I don't even remember the year, sir, sat together in Vienna and decided how treaty would look like. Whenever we find a treaty, sir, who will follow the treaty? Who is not going to follow treaty? What are the things to be taken care in case of treaty? So it is laws for treaty. Whenever treaty will be formed considering the following situations. Whenever treaty will be read, it will be read with considering such certain situations. So this talks about law of treaty, law of treaty, law of treaty, law relating to treaty. So that is nothing but Vienna Convention, law of treaty. Sir, are we clear on that front? Absolutely, sir. Absolutely clear. The law of treaty we are going to discuss here. Okay. Sir, we have two kinds of DTAA. Two kinds of DTAA. Sir, first of all is limited DTAA, which covers only certain aspects. Like we had 28 we had 32 almost clauses, 32 articles under the OECD model. We had 31 articles under UN model. But sir, if India follows any limited DTAA, it may only cover certain clauses only. For example, India and Pakistan DTAA, only certain clauses are covered. But sir, there are certain comprehensive DTAA which cover almost all the incomes. So we can have comprehensive DTAA also. Sir, why there is need for treaty? Why there was need for treaty? The first need was to increase the syllabus of the CA final. That was the need for the treaty. Treaty only came just to increase the syllabus of the CA final. That is the only need. Sir, jokes apart. Why there was need for treaty? Sir, we understood in DTAA that if treaty were not there, sir, we were forcefully charged double taxation. We were forcefully charged double taxation, and in some cases, sir, there was double taxation, there was double non-taxation. If treaty were not there, sir, there would have been double taxation. And sometimes there would have been allocation of taxing right issues. Who is going to tax which income? Ultimately, treaty tells now who is going to charge such taxes on such income. So first of all, basic work of treaty is to allocate the taxing rights. Who is going to tax the such income, and because of which it achieves double taxation or elimination of double taxation. Sir, purpose of treaty is clear, sir. There should be no discrimination between resident and non-resident. Sir, purpose of treaty is very clear, sir. There has to be dispute resolution panel. And sir, purpose of treaty is very clear, sir, to provide assistance in collection of taxes. Who is going to collect the taxes and how he is going to collect taxes. Sir, purpose of treaty is very clear, sir. Equity and fairness, sir. Same rate for same different classes. Purpose of treaty is very clear: promotion of economic and economic relation and trade investments. So purpose of treaty is very clear: neutrality and efficiency. Purpose of treaty is very clear: neutrality in terms of export, neutrality in terms of capital import. So there are 7 purposes of treaty. I want you all to remember only 6. There are 7 purposes. I want you all to remember only 6, sir. 6 out of 7 only. Why 6? Why shouldn't not 7? If you are asking us to learn 6 only, why not 7? Arey Baba, you remember 6 only. I'll ask you many other things to learn. First of all, sir, allocation of taxing rights, and sir, dusra, elimination of double taxation. Then, sir, treaty helps in dispute resolution. Treaty helps in collection of taxes. Treaty helps in avoiding discrimination between resident and non-resident. Treaty helps in equity fairness. Treaty helps in importing export neutrality. And at last, treaty helps us to promote the economic trades and investments. So there are 7 purposes for which treaty exists. Sir, we got that point. Now we have the worst thing of all times. Worst thing of all times. Sir, how treaty is interpreted. This is what important. This is what is important, sir. How treaty is interpreted. So there are certain rules to interpret. If you remember, you see, intermediate, you had a topic. We had a topic called, sir, what topic it was? Interpretation of statute, where it was said that wherever he word is mentioned, you have to assume she also. Wherever or word is mentioned, you have to assume it or and. Sir, you can assume it liberally. You have to take the literal interpretation. So there were certain topics called na. So this is that topic only. You are given with taxation a treaty, or you are given with certain rules because of which you have to interpret the treaty. What are those rules? Try to understand. Yes, sir, we remember. Sir, first of all is golden rule. Sir, golden rule is normally asked in exam. Whatever the word given to you, meaning whatever the word is given to you, strictly adhere to the meaning of that. That is the golden rule. Whatever the word given to you in the treaty is, strictly adhere to the meaning of that word. Sir, for example, if you are given in the treaty that laptops are depreciable at the rate of 40%, the laptop imply laptop only. If you are given mobile phone are not laptop. If you are given iPads are not laptop. Strictly adhere to the meaning of the treaty. That is the golden rule. Sir, if golden rule becomes vague, then in that case, sir, you have to do the liberal construction. You have to do liberal construction, sir, as to carry out the apparent intention of the party. If golden rule fails, then go for liberal construction. Sir, for example, it might happen that somewhere it is written, sir, income taxes is to be paid or capital gain taxes is to be paid, sir. This treaty applies to income tax or capital gain tax. Sir, here intention of lawmakers is not to give you or, but rather they want to give and. If we have income tax and capital gain tax, then both are taxable. Sir, they don't want to put or, but it is just an error. Sir, you just have to construe the meaning of this or as and. So you have to take the liberal interpretation. So you don't have to follow the golden rule. Okay. Simple point. Golden rule take literal meaning. Second thing is liberal construction. Sir, if literal meaning fails, then take the liberal meaning. Okay. Sir, second meaning. Subjective interpretation, sir, it should be interpreted in the common intention of the contracting party at the time of conclusion of the treaty. Okay. Treaty should be interpreted with the common intention. Sir, for example, in 1970s, India entered into double taxation avoidance agreement with, say, Japan. Sir, at that time, majority of the taxing rights were given to India because ultimately India was a poor country back then. Therefore, majority of the taxing rights were given to India. Japan was not given any taxing rights. But sir, is it correct in today's parlance also? Right answer is it is not correct in today's parlance. Ultimately, sir, things have evolved, things have changed. India has improved a lot. So in that case, what happens is, sir, not everything you can take. You just have to understand it that purpose of the treaty was to give benefit to India back then, but right now that purpose has changed now. So meaning of the treaty has to be changed accordingly. There has to be subjective interpretation. So it should be interpreted in according to the common intention of the contracting party at the time of conclusion. You have to check the common intention. Sir. Intention might be different at the time of signing of the treaty, but right now intention might be different. Okay, because of which interpretation has to be changed. Third one is purposive interpretation. Sometimes you are given a word called teleological explanation. Write down the meaning of teleological explanation. Sir, it implies purposive interpretation. Sir, for example, it should be interpreted as to achieve the whole aim of the treaty. Purposive yani it implies that treaty should be interpreted so as to achieve the aim of the treaty. For example, if we have for example income tax, if we have capital gain tax, sir, we have or between them. Sir, purposively, if we consider the meaning of or, sir, it would make the meaning vague. Sir, the same example that I took for liberal construction. Sir, if I take the meaning of or, Sir, with that, sir, it would become void to read the meaning. Meaning of the treaty would become void, sir. Meaning of treaty would become void if we read the meaning of if we read word such word or as or. We have to interpret such or word as and. So for that matter, sir, you have to read it in with an interpretation to achieve the aim of the treaty. Sometimes some transaction would recommend that no tax would apply. Sometimes with transaction would appear that more tax would apply. So you have to retreat it as an interpretation that it would avoid double taxation, it would eliminate double non-taxation also. Then we have contemporaneous exposito. Contemporaneous exposito. Sir, it implies, sir, you have to learn this meaning. Huh? You have to learn this word, contemporaneous exposito. What this implies? Sir, sometimes what happens is, sir, meaning of the treaty shall be taken at the time of conclusion of the treaty, what it implies. Sir, for example, India and Australia treaty was signed in 1970. 1970 it was signed. For example, sir, in that treaty it was written that whenever the capital assets appreciate, whenever the capital asset appreciate, we will tax that. It was given. It was given in that treaty. Right now, India abolished such capital. Now, India just introduced a new taxation called capital gain tax. India just introduced a capital gain tax in which even at the time of losses also government is going to tax. Provision says, sir, but previously there were different laws. But right now, corresponding to that laws, we have some capital gain tax laws now. So provision says it might happen sometime that meanings might be different at the time of conclusion of the treaty, but meaning at the time of interpreting has to be considered considering what were the meaning at the time of conclusion of the treaty. Contemporaneous exposito. Try to just flaunt your English by just saying contemporaneous exposito. Try flaunting it. You will be able to learn it. So take the meaning at the time of conclusion of the treaty. Treaty as a whole, whenever you read treaty as a whole and try to find out the consistent and reasonable meaning, sir, it is always advisable to find out the reasonable meaning. So extrinsic aids to read treaty. Whenever you try to read treaty, sir, for example, if you try to read income tax, sir, what are the different methods of interpreting the income tax? Sir, you understand some kind of judgments. You understand you book for example, you want to read income tax. So there are many articles of tax guru. There are articles with tax, clear tax. You try to refer certain books. You try to understand the examples that you have seen in the offices. You try to see different other materials to understand the income tax. Now, similarly for treaty also, we have other matters like we have foreign court decisions. For example, if you want to understand the meaning, thank you, sir. You're most welcome, Yogesh. See, if we have India and Australia treaty double, if we want to interpret such treaty, there can be certain court judgments. Yes, there can be mutual agreement procedure between India and Australia, which can help us decide what the meaning is. Sir, whatever the preamble is, sir, what preamble is, if you know, every treaty has a preamble. Every constitution of India has a preamble which says India is a sovereign country and all brothers are brothers sisters. I mean, all Indians are my brothers and sisters. I'm taking it wrong. I'm sorry for that. But sir, there is a preamble of Constitution of India. There is a preamble of Constitution of India. Similarly, every treaty has a constitution now. Every treaty is a constitution in itself. Every treaty prescribes a preamble, and preamble is normally defining forces of the treaty. Preamble defines what treaty intends at. So you also have to read preamble while considering the treaty. It is an integral part of the treaty only. Sir, you can see international articles, for example, international organizations. There are many. You can read that. Sir, you can read other treaty. For example, if you want to understand taxation between India and South Africa, you can read the treaty between Germany and China. You can see that. Subsequent conducts of the party as an evidence of the intention of the conception of the treaty. For example, whenever treaty was signed, and it was written that taxes are going to be charged by the Australia. Example, India and Australia treaty was signed and taxing right on interest was given to Australia. So till now, till then, even though it is written Australia, but every time India charges. So you can take the subsequent conduct of the parties to find out the meaning of the treaty. So subsequent agreements, for example, there happened certain agreements. Agreements also you can see. So interpretive protocols. Sir, what are protocols? So resolutions and committee reports. So what are protocols? See, whenever you read a book, there is always written a reference list at the back of the list, at the back of the book. Certain meanings that are being taken, certain instances, certain behind the scenes, certain back end stories. So whatever are written at the back end of the book. That gives you a better reference to what the story is. That gives you better definitions. So protocol is nothing but, sir, it is an annexure given to a supplement. It is a supplementary treaty, supplement to the treaty, annexed at the end to put the matters beyond that are given in the treaty. Whatever the matters are given, just to give additional brief to it, a behind the scenes story is given in the form of protocol. So it has also the same binding effects. It has also the same binding effects. So that is also to be considered. So what are the extrinsic aids? What are the extrinsic aids? So there are 7 extrinsic aids. Seven, no, sir, 8 extrinsic aids. I want you all to learn at least a 6. Okay. First of all, foreign court judgments you have to refer. Second thing, sir, mutual agreement procedure. Third, sir, preamble you have to refer. Then we have protocols. Then we have other treaties. Then we have international articles. If I have taken international articles, yes. Subsequent conduct of the parties and subsequent evidences, subsequent agreements. Okay, I'm not seeing the page. Okay, I'm not seeing the page. I don't remember. First of all, sir, international court judgments, you have other international articles. Then we have preamble, we have protocol, we have subsequent agreements, we have subsequent agreement evidences, and after that, what we had after that, what we are done with 6 now. We are done with 6 other treaties. We can also refer. So this is how 6 things will work out. 6 things have to be written in exam if they are being asked. Sir, there is a clarification regarding most favored nation clause. What this is all about. Try to understand. Sir, for example, I am going with right pace now, sir. I just want half an hour of your own, half an hour. We will be done with the topic. After this, we will be done with BEPS also. Just give me half an hour. For half an hour, we will be done. We will be done with BEPS also. And sir, if we remove the break portion, we will be done with only 6.5 hours. We will be done with the topic in 6.5 hours only. So, sir, what this MFN is? I'm going with the right pace, I guess. I'm not going very fast. Sir, for example, there are 5 countries: India, China, Russia, Brazil, and South Africa. Okay. We have 5 countries with us. Okay. They all said, they all came together and said, Indian Chinese brothers to us, Indian Chinese brothers to us. If you have heard this thing, Hindi Chini bhai bhai, Hindi Russian bhai bhai, Hindi South African bhai bhai, all those two came together and called themselves brothers. And they made a pact of most favored nations, that we are most favored nations for each other. Whenever we want to give a benefit, firstly we will be giving benefit to each other, then only we will be passing on this benefit to third person. For example, whatever the interest taxability between the 5 would be, so everybody would charge interest at the rate 5 for 10% to each other. Nobody is going to charge any interest to any other person. And so this treaty was signed on 1st April 2022. They became most favored nation. Sir, later on, out of nowhere, India entered into agreement with USA to charge interest at the rate 5% on 1st 2023. Oh, India had a pact now that all our brothers and sisters, all these people are brothers and sisters. Indian, Chinese, Russian, Brazilian, and South African are brothers and sisters. India had a pact now. India had a pact now. Provision says, sir, if any of the people of the most favored nation clause violate the terms, that means if any of the transaction, if any of the member is the part of most favored nations, enters into another entity which is not the fourth most favored nation entity, restricts its taxing rights than lesser than what they had been charging with most favored nations, then such benefit of 5% has to be given to everybody by India. Oh my God, sir. Oh my God. Oh my God, sir. That means, sir, India must be a part of most favored nation, first of all. Second thing, sir, subsequent entity with whom the taxing rights are limited is entered after entering the most favored nation clause by India. Third thing, India is limiting its taxing rights with that country. And fourth thing, India has to ratify also. India has to ratify or notify it in Indian constitution, Indian laws. That it is limiting its taxing rights with USA. So if it limits, so in that case, sir, what happens? India has to charge 5% from everybody else who is a part of most favored nation. Whatever the benefit these people give to outsiders, sir, they have to first pass on this benefit to their local most favored nation partners. Also, sir, sir, if this agreement was made on 1st Feb 2021, that is a year prior to India becoming part of most favored nation clause, in that case, sir, this benefit will not be given. See, If India has already an agreement with somebody of charging 5% tax, and later on, if India enters most favored nation clause, then whatever the agreements that have entered prior to the most favored prior to entering MFN, so that will not have any impact. Any agreement entered after MFN after entry into MFN will only have impact. Sir, are we clear on that front? Are we clear on that front? Yes, sir, we are absolutely clear. To read a treaty, we have two approaches. First of all is static approach, and second one is ambulatory approach. So static approach is as good as, sir, contemporaneous expositor. Sir, what it implies? So look at the meaning of the treaty at the time of signing of the treaty. And sir, ambulatory approach, sir, whatever the meaning given is, sir, you have to look as per the time when you are applying the treaty. Now we have the worst of all. Sir. First of all, yes, sir, clear. Sir, we have VCLT, sir, Vienna Convention Law of Treaty. Sir, there is a law which would define how treaty would be. There is a law which would define how treaty would be. Sir, there is law of treaty. Law for the purpose of treaty. Law for the purpose of treaty. Treaty in itself is a law. There is a law for the purpose of treaty. Like we had interpretation of statute, a law for the laws. Therefore, we have Vienna Convention law for the purpose of treaty, which talks about 5 things. First of all, Fanta ke saath Mirinda, if you understand. Fanta saath Mirinda. Fanta with Mirinda. Fanta with Mirinda. Fanta with Mirinda with implies a pacta sunt servanda. What it implies? Sir, whenever you are interpreting a treaty, sir, it should be interpreted in a good faith. See, Fanta is orange in flavor. Okay? So Mirinda is also in orange in flavor. Okay? Whenever you take Fanta and Mirinda, it is always good. It is always good. That is what it implies. Sir, whenever treaty you are signing upon the treaty, it has to be followed in good faith. Whenever you are signing off the treaty, it must be followed in good faith. Okay. This is important, sir. You might get confused with the name. So therefore, pacta sunt servanda. Pacta sunt servanda is the technical name where it implies you have to follow the treaty in good faith. Second thing. Sometimes, sir, what happens is people use their local law. See, for example, if you have to go out with your friend, you might give certain excuses now that my mother is not permitting me. I had a stomach pain. I had to clean my house. I had promised my wife to clean my house. Sometimes what you do is, sir, you use local laws as an excuse to avoid interpreting treaty, to avoid avoid carrying out the meanings in the treaty. You use local law to depart from the treaty. Sir, provision says internal laws and observance of the treaty. A treaty may not invoke its provisions. A party may not invoke its provisions in its internal law as justification to failure to perform the treaty. Sir, you cannot give your local laws as an excuse for not performing any treaty. Sir, you should not use that. Parties should not dishonor their international commitment with each other by amending the local laws. So you cannot dishonor the treaties just because you have some local laws prevailing. Okay. Non-retroactivity of the treaty, sir, what it implies, sir, whenever you imply a treaty, whenever you change any treaty, whenever you bring any kind of new taxation, or whenever you bring any kind of relaxation, so that is prospectively applicable, that is never retrospectively applicable. So territorial scope of the treaty. Sir, whenever there exists a treaty between two nations, for example, India and Australia, sir, it is binding on both the countries. Sir, on India also, on Australia also, it is binding. And last, sir, whenever you read any kind of treaty, sir, you have to consider the rules, you have to consider the agreements, you have to consider these instruments, you have to consider the subsequent practices, you have to use the preambles, annexures, you have to read the treaty in good faith. That is the golden rule of explanation. Golden rule implies these 6 things. So general rule implies reading treaty literally. If you remember 3 things I told you. So first of all, there was golden rule. There was golden rule. Golden rule talks about, sir, you have to read the treaty in the good way, in the literal manner. Golden rule we had studied now. Golden rule implied you have to read the treaty in the good faith. Sir, pacta sunt servanda, which says you have to read treaty in the good faith. Sir, golden rule was you have to read the treaty in literal sense. Pacta Santa Servanda says you have to read treaty in good faith. Plus, Golden Rule also says that you have to read the treaty in the good faith as per the ordinary meanings and the terms of the treaty, sir. Got this point? General Rule also says this. Sir, its interpretation, it comprises preamble and annexure, agreements relating to treaty made between the parties. Okay, sir. Subsequent practices, sir. Okay. Supplementary aid, you need not to remember. Sir, if you want to authenticate treaty in India or in any other language, sir, for example, if you have treaty between India and if you have treaty between India and Australia, and India wants to authenticate treaty in Hindi, along with Telugu, along with Malayalam, along with Kannada, if it all wants to authenticate such treaty, remember, sir, no meaning should be kept in such a manner that it should depart meaning from the essence of the treaty. That is the thing that is relevant. Otherwise, you can skip out this point. Last point. Sir, termination of treaty. Sir, if there happens to be a material breach, sir, if there happens to be a supervening impossibility, if there happens to be a fundamental change in circumstances, or if there happens to be a new emergence of new form of tax laws, sir, in all the four cases, sir, operations of treaty would become suspended, treaty would terminate. There are four instances. Sir, what is the material breach? Sir, if treaty has not been, reputation of treaty not being sanctioned, sir, material breach, sir, for example, India-Pakistan treaty, there is. Sir, India launches, for example, India launches nuclear bombs. So it would be reason for material breach. If India stops the Indus water, then in that case it is material breach. So treaty would be void. So supervening impossibility to follow, sir, if India is again and again taxing, for example, Pakistan is taxing 100% of the interest. So in that case, it is supervening impossibility for India to follow that treaty. In that case, it has to be repudiated. So if there is fundamental change in circumstances, for example, India and Pakistan treaty, India got merged with Pakistan, so the treaty has to be changed. And at last, sir, there is new law that came into change that causes treaty to be lost. So there are four reasons because of which treaty can be considered as terminated. So you need to remember. For this thing, you must remember. So what are the other things you must remember? Sir, VCLT is an important topic. It is being asked in exam. Sir, most favored nation clause, interpretation, and sir, need for treaty. These are 5 questions that you must remember. I hope you are okay with these things. Sir, let's come to next topic, that is base erosion, profit shifting. Sir, second topic for the day. Second topic for the day, sir. Base erosion, profit shifting. Sir, what happens is, most of the times what happens is, high tax paying countries, entities that have operations in multi nations. For example, Nestle has operations in multiple nations. It has operations in China, it has operations in Switzerland, India, Australia, South Africa. In multiple countries, Nestle has operations. So these entities who have operations in multiple nations, try to shift their profit from high tax paying country to low tax paying country. Try to shift their profit from high tax paying country to low tax paying country. So in that case, what happens? So if any of the companies that tries to shift taxes from profits from high tax paying country to low tax paying country, in that case, sir, it is called base erosion profit shifting. Sir, shifting of profit from high tax paying country to low tax paying country to via using tax planning strategies to exploit the gaps and mismatches in the tax rules and make profit disappear from high tax paying country to low tax paying country. Simple point it is. Sir, what are the consequences of BEPS? See, for example, India charges 40% taxes or 35% taxes on the foreign companies. Sir, what foreign company does? It shifts away top profit from India. It starts shifting from Indian profit to other countries. In a foreign company in India starts away shifting the profits to other countries where there is low tax rate. So ultimately, India is left with less taxes now. There is less tax collection in India. See, government has to cope up with the less revenue and higher admin cost. Government has to cope up with the less revenue. Government earn less revenue in this case, and higher admin cost has to be borne. Okay, sir, that is the first reason. Second thing, since government receives less taxes, in that case, what happens? So there is underfunding of public enterprises. No taxes, that means no money available for funding, no money available for AIMS hospitals, no funding available for schools. So underfunding of public investments and fosters faster economic growth. So hampers faster economic growth. So third one, undermines the integrity of the tax system. Sir, for example, There is shift in the burden. So ultimately, foreign companies does not pay the taxes. So government has to increase the tax rates for individuals. So individual taxpayers have to bear more losses. And at last, a local enterprise that operates domestically has to face competition while competing with the MNCs. The local enterprises has to face. Ultimately, the foreign company is not paying taxes, so their profit would become more. They would have cheaper products, they would have more money to spend on R&D, they would have more money to spend on marketing, so they will have more taxes, or they will have more disposable income. Other Indian enterprises would be left with less money now. Therefore therefore it would be difficult for Indian domestic companies to compete. So there are four adverse consequences of BEPS, sir. First of all, higher admin cost and low tax. Second, underfunding of enterprises. Sir, third, integrity of tax system is hurt. Fourth, sir, local competition is being increased. Okay, sir, we have 15 action plans. Sir, OECD came together. OECD people of OECD came together, and they came up with 15 action plans. I should say 15 plus 2 action plans. Okay, 15 plus 2 action plans just to tackle the BEPS, just to tackle the base erosion profit shifting. They came up with 15 action plans. You need not to learn all 15. I am there for you just to make you remember whatever you are required to learn. Okay. If even till now you have not liked the video, this is last time I'm saying you like the video. Otherwise you will forget this chapter. And you will forget this chapter, sir. And even if you have liked the video, do drop a comment and do drop a comment, because it really takes effort to come up live and speak for 7 hours continuously, that to English. So it takes efforts. If you are watching this lecture recorded, or if you are watching this lecture live, whenever this video ends, do drop your video. Do drop your comment of how the session has been. Okay, so what I was talking about. See, uh, OECD countries came together. OECD countries came together. Now they wanted to address the BEPS issue, base erosion profit shifting. The issue they liked already, sir. Arey, thank you so much, Yogesh. Thank you so much. Thank you so much. Okay, what I was saying. See, OECD countries came together and they proposed 15 action plans. 15 action plans to prevent BEPS. First action plan was, sir, addressing digital economy. Sir, what happened was, see, earlier there used to happen was people used to come into India, set up the factories. People used to come to India, have the sales outlet. But with digital economy coming into picture, with YouTube coming into picture, sir, there are many people who are showing ads to India and earning money. Sir, we are not able to characterize the payment. We are paying for advertisement. We are paying for marketing. We are paying for technical services. We are not able to characterize. We are not able to locate the transactions. The services might be provided from USA, but payment is made to China. Payment is made to, sir, Panama. We are not able to characterize the payment. And sir, old permanent establishment rules are not relevant these days. Earlier, this used to happen that if entity had PE in India, business income would be taxable India. But sir, these old permanent establishment rules are not relevant these days. These are not relevant these days. Therefore, sir, OECD recommended 3 things to avoid this thing. So OECD recommended 3 things. Sir, OECD said you should modify your PE rules. You should modify your PE rules. Second thing, sir, you should make virtual fixed place of business. So, for example, if any of the entity has virtual fixed place of business in India, that should also constitute PE. Sir, for example, if any of the website is being hosted on an Indian server, that should constitute PE. And at last, sir, countries should impose, sir, withholding taxes and equalization levy. Country should impose withholding taxes and equalization levy. Sir, 3 things. Modify PE rules. Sir, repeat after me. Sir, repeat after me. Please repeat after me. Sir, modifying PE rules. Second thing, sir, fixed place of business, making it as PE. And third thing, sir, imposition of withholding taxes and equalization levy. Sir, 3 things to be considered. Okay, sir, we got it. What India did? India did 2 things. Sir, first of all, India introduced a significant economic presence concept. In the morning itself, we studied. Sir, if any of the foreign company has 2 crore worth receipts from India, or it has 3 lakh plus downloads in India, then whatever the advertisement income it is earning, whatever the income from sale of data it is earning, whatever the income from further sale on such data it is earning, sir, it is Indian income. India introduced significant economic presence. And second thing, sir, India introduced, sir, equalization levy. Whenever Indian person is paying for the advertisement, sir, it shall become taxable. So three suggestions, sir: modifying P rules. Second, virtual fixed place of business. Third, withholding taxes and equalization levy. India introduced significant economic presence and, sir, equalization levy. Second, sir, the second, hybrid mismatch arrangement. Hybrid mismatch arrangement. Sir, what happens? What is hybrid mismatch arrangement? So it is also important. Sir, sometimes it is being asked. Okay. Sir, a single transaction may be differently treated in India, may be differently treated in Australia. Let us understand how. Let us understand how. Sir, for example, in Australia, dividend is exempt. In the hands of recipient, dividend is exempt. Sir, whoever the company distributes the dividend has to pay dividend distribution tax. Only the company that is distributing the dividend has to bear the dividend distribution tax. Sir, it is exempt in the hands of the unit holder. Sir, for example, we have India. So India has distributed interest. India has distributed interest. Sir, because of this interest, sir, this interest is considered as dividend in Australia. Because ultimately, sir, if for any of the entity, and if India has 100% subsidy, okay, 100% subsidy. If Australian entity has 100% subsidy in India, India is paying interest. In India, people are taking deduction for this interest. People are taking deduction in business income for this interest. And in Australia, since it is 100% subsidiary, so it is considered as dividend, and dividend is exempt in Australia. So what happened is ultimately transaction takes place only once. In India, people have paid interest and claimed deduction in business income. But in Australia, so dividend is exempt. It is considered as dividend and it is exempt. See, what happened is, sir, there happened to be a loophole in tax treatment of the same transaction. If this transaction is interest for India, this transaction is dividend for the recipient in Australia. There is difference in the tax treatment between two countries. Therefore, sir, there happened to be a tax advantage if this Indian company distributes any interest to it. This Indian entity took deduction of Indian expense, and sir, it did not pay taxes in Australia also. So this is called hybrid mismatch arrangement. So tax treatment of single transaction might be different in two countries. For that matter, there happens to be a double non-taxation. Double non-taxation. That is why. Sir, what is meant by double taxation, sir? So how countries achieve double taxation? Sir, creation of two deduction for single borrowal and two deductions. Sir, for example, in India, it claimed interest as deduction, and in Australia, it claimed as dividend exemption. Okay, taking deduction without considering the income, sir, for example, without even considering the income, sir, people taking deduction, misusing foreign tax credit, and sir, participation in exemption regime, showing profits in low tax countries. These are the four ways in which hybrid mismatch arrangement take place. Sir, repeat after me. Try repeating after me, sir, because this is the thing that if asked, you will not be able to answer. First of all, taking dual deduction on a single borrower. Second thing, participating in exemption regimes. Sir, taking misusing tax credits, and sir, taking deduction without offering it as income, without corresponding income inclusion. These are the four methods through which hybrid mismatch arrangement is taking place. There are four methods through which hybrid mismatch arrangement takes place. Sir, we are clear on that front. We are absolutely clear on that front. Sir, what OECD recommended? OECD recommended, sir, amend the tax laws and tax treaties to neutralize. Wow, sir, beautiful answer. Beautiful answer. This is the answer we wanted. This is the answer we wanted. Sir, OECD said to amend the tax laws and, sir, neutralize the effect of HMA. Thus, amend the tax laws and, sir, neutralize the effect of hybrid mismatch arrangement. Then third, we have controlled foreign operations. Controlled foreign operations. Sir, what does this all imply? Just understand, try to understand, sir. For example, we have a country, India. We have a country called Panama, where tax rate is zero. We have a country USA. So there is a company in Panama who is not even existing. This company is a shell company. All the functions are being done by USA just to divert the income from here to here. Interest is being given in India just to take advantage of interest. So royalty is being given to India just to take the advantage. Earning royalty from India, taking benefit of 20%. So transferring it as dividend to take benefits. So this entity, this country is formed. This country is just there just to exploit the tax advantage. Sir, what it says, sir, if countries which is doing more transactions are located in tax haven and they're ultimately being controlled by the entities those are located in high tax paying countries, this is called controlled foreign operations. If country is if any of the company belongs to an entity which has high tax paying country, it is controlling the entity which is located in tax haven countries, sir. This is called controlled foreign operations, sir. To curb the practices, what it says, sir, OECD recommended that that countries should amend their tax laws and make interest income, royalty income, passive income from related party also their income. So, for example, if this Panamanian company in Panama earns any royalty income, this should be taxable in USA. That should be your laws too. For example, in India, if you have any of the subsidiary in Japan, if any of the subsidiary in Dubai, and you are unnecessarily earning profit on that company, so that should be taxable in India. That is how you should change. If you are having an entity in tax haven country, so income should be taxed in your hands. That is what you should change. That is how you should amend your tax laws. Sir, Section 94B, what happened was, sir, for example, there is company called US, there is entity called USA, okay, and there is called Panama. Sir, USA wanted to loan certain money, but instead of loaning certain money, sir, it gave money to Panama. It gave to money Panama. It created a company in Panama and invested in equity share capital of Panama. Out of this equity share capital, so 1,000 crore were given loan to India. 1,000 crore were loan given to India. Out of this 1,000 crore, so this loan was payable at the 12%. So 120 crore worth deduction was taken on the 130 crore, 120 crore was interest deduction taken. Now just imagine. These are not even associates also. Even if they are associates, sir, just imagine, out of the profit 120 crore is just given for no reason. Out of this 120 crore deduction taken for no reason, and the taxes are being not paid anywhere. Taxes are being paid to some, interest is being charged to somebody on which no taxes are being paid. Sir, there was shift in income. Ultimately, sir, there are no taxes in India, but also no taxes in Panama. No taxes in India, no taxes in Panama. Provision says, sir, it is a kind of interest deduction. What happens is big companies form shell companies in tax haven countries and give high loans in the countries where they have high tax rates. In that case, what should they do, sir? What should they do? Sir, they should make certain rules, sir, group rules, fixed rules, targeted rules. Sir, what group rule imply? What group rule implies? Fixed rule imply. Sir, only a certain percentage of your profit would be allowed as interest expenditure. Only certain percentage of your group profit would be allowed as interest expenditure. For a banks, only a percentage of interest would be allowed as interest expenditure outside India. Sir, you should make these kind of rules. Sir, fixed rule for an entity, group rule for organization, and target rules for banks. So this is what you should be doing. And in India, in response to this action plan, brought 94B. Sir, how to remember 94B? Sir, 94B, 4 4, same to same. Yes. 4 to 4, 4 4 4, same to same. Don't laugh on me, okay? Don't laugh on me. I know how to make you remember things. So 94B, action plan number 4. I hope you got the point. I hope you got the point, sir. 94B and action plan number 4. That is how you will remember. Sir, action plan number 4 was completely related to interest. We have to curb the interest payment, and for that matter, India brought 94B, that is thin capitalization interest payment to non-residents. Sir, I hope you got the point, sir. I hope you got the point. Sir, you have to remember. Okay, sir, we got it. Okay, sir, we got it. Action plan number 5. So action plan number 5, I will tell you what it implies. Sir, what it implies. Understand. Try understanding it. Sir, what happens is, whenever, sir, for example, I put a lot of sweat, I put a lot of hard work in developing a patent. I just used a certain type of opium. I used harpic. I used flour. I used a certain kind of oils. Adivasi hair oil I used. I used a certain kind of metals and clubbed together. The beauty, the fragrance altogether it made. The fragrance altogether is made is not even given by anybody. The kind of fragrance it is giving, so it is not given by anybody. No fragrance can smell the way I am making the goods. Sir, what happened? What happened? What happened to that fragrance? Sir, I developed this fragrance in India and sir got this fragrance registered in Panama Islands. I got this fragrance developed in India and got registered in Panama Islands because, sir, if fragrance royalty is received in India, it is taxed at 30% now. So I don't want it to pay tax. So I got that fragrance registered in Panama Islands. So isn't there a loss to Indian entity? Provision says yes. Yes, sir, counters harmful practices. Many of the patent intellectual property rights are not being done somewhere else and registered somewhere else. Patent, royalty, copyrights, they are undertaking somewhere and registered at some other places. What to do in that case? To counter that harmful practices, Action Plan 5 came onto picture, which says, sir, you should give benefit to the local manufacturing. Local research and development, you should be giving benefit. You should be giving benefit to local manufacturers. Sir, how benefit India gave? Sir, India brought up royalty 116, 115 BBF. Develop royalty in India. Develop royalty in India, and we'll give you just a 10% tax rate benefit. Pay tax 10% only. We will give 10% benefit only if, sir, you are having 75% or more expenditure in India. If 75% or more expenditure is done in India, we'll give you benefit. Pay 10% action only. Sir, 115 BBF action plan number 5. Sir, 5. High five, sir, 5. Getting it, sir. Action plan number 5. Royalty. Royalty. Arya, please. It is not a joke. It is not a joke. It is not a joke. I am asking you, I am begging you to learn this way, sir. This is the way you will be able to learn it. This is the way you will be able to reciprocate in exam. Otherwise, you will not remember this thing. Sir, 5, action plan 5 relating to 115 BBF. Sir, we got it. Action plan number 6, preventing treaty abuse, taking advantage of the treaty when it is not meant for others. Sir, you have to amend your treaties in such a manner. You amend treaty in such a manner that people should not make use of your treaty. So if it is not meant for your benefit, oh, if it is not meant for you, you should not be allowed to use that treaty. Okay. Sir, we got that point. Sir, treaty number 6 is okay. 7 number is okay. So 7 number, let me tell you how it was. Sir, what people try to do is, sir, artificial avoidance of PE. Artificial avoidance of PE. Sir, what people used to do was, sir, for example, if any non-resident is not having any business in India, if non-resident is not having any business in India. But sir, they were having certain agents in India who used to function in India. There were certain agents who used to function in India. So they were artificially avoiding this PE status. They were artificially avoiding. Provision says, sir, there should be more rules. There should be more examinations. There should be more defining of PE rules so that, sir, whatever the closely transactions are, aggregating all facts, so that avoidance of PE shall be avoided. Whenever there is artificial avoidance of PE, that should be corrected, that should be rectified. Make PE rules more strong, and sir, aggregate all the transactions to understand the transactions. Sir, you can ignore this point. 8, 9, 10, sir, don't need to remember, sir, just you need to understand. Sir, if there is any pricing of intangibles, for example, if Indian entity is selling any kind of intangible to USA, sir, pricing of intangible is very tedious task. Intangibles can be priced from 0 to skies. There is no limit as to how much intangibles can be priced. For that matter, sir, there is high risk area you have to acknowledge. You have to be more careful in that. 9 says, whatever the contractual allocation of risk and reward is, sir, you have to check that properly, because, sir, if more expenditure are allocated to Indian entity, less taxes would be paid in India. How, sir, joint cost is allocated? How, sir, head office expenses, how head office allows its expenditure to branch, that has to be checked. Sir, high focus areas, sir, whatever the profit allocation is, transfer pricing, or sir, branch expenses, sir, is to be checked. Sir, you can skip out this thing. Action plan number 11 is important. Out of that, we have 6 points. We just need to remember 5. What it implies, sir. Sir, you have to monitor and measure BEPS. Sir, you have to check whether BEPS is happening or not, base erosion profit shifting is happening or not, sir. How to check that? There are 5 different parameters as to whether base erosion profit shifting is happening or not. First of all, profit rate in MNEs affiliates is lower in low tax MNEs in lower tax countries is higher than those groups. Sir, what it implies? For example, if we have an entity in Nestle in India is earning 5% net profit of the sales. Nestle in USA is earning 2% net profit. Nestle in Panama is earning 70% net profit. Tax rate in India is 40%, tax rate in USA is 45%, Panama is 0. So can you see? Can you see the difference? Tax rate in the tax haven countries is very high. This implies it is BEPS is happening. Effective taxes paid by the MNE is lower than domestic tax country. For example, samajhna. For example, what it says. For example, sir, for example, India is charging 40% tax. Australia is charging 30% tax. Sir, Panama is charging 0% tax. Sir, checking for India, India is charging 40% tax. But sir, this entity collectively is paying just a 5% tax because sir, most of the income goes to Panama. So effective tax rate is just 0.5% only. So sir, this is an indicator of BEPS that most of the income is being diverted to the country which has low tax rates. Oh wow, sir. Oh wow, sir. Oh wow, sir. We got your point. Sir, foreign direct investment is concentratedly increasing. Sir, for example, if any of the multinational entity is having more profits, sir, they will increase their investments there so that their profit might disappear. Sir, location of value creation and taxability is different. Sir, for example, value creation is being done at some place. For example, patent is being developed in USA but registered in Panama. Developed in USA, registered in Panama. Sir, value creation is different place and sir, registration is different. Sir, debt received is concentratedly more from high tax paying country. Understand? Sir, whenever we have a multinational entity, it is giving more debt. It is giving more debt to the countries which is having high tax, which is having high taxes. What I am saying is, sir, more debt is given to the countries which is having higher tax rates, and more equity investments is being made to the countries which is having less tax rates. So this is an example of base erosion profit shifting. So these are the 5 indicators which tell sir whether base is being eroded or profit is being shifted. Sir, disclosure of aggressive tax planning. Sir, whenever there is an aggressive tax planning, sir, more disclosure should be made. More disclosure should be made so that disclosing enough would help tax authorities to make informed decisions. Sir, more information should be required to be disclosed. Action plan number 13, sir, it is important. Sir, it is important, sir. Re-examining transfer pricing documents. See, whatever the transfer pricing documentations are being submitted by the entities, sir, there are 3 kinds of documents to be submitted. We had discussed a master file, telling about the data of the legal status, incorporation status, address, so ownership, that is to be discussed in master file. Local file, every transaction to be entered in that local file. CVC reporting, sir, parent entity of multiple group has to be submitted. Sir, this has to be properly re-examined. Otherwise, sir, what will happen? Sir, with transfer pricing, they are going to take the advantage. Sir, making dispute resolution more effective. Sir, for example, India and Panama, if tax is being evaded through Panama, whatever the income that India is earning, it is being transferred to Panama. Sir, there should be an effective tax resolution system now, dispute resolution. If India wants to know any information about Panama, India is asking information and Panama is responding after 7 years. What to do in that case? Money gone now. In that case, sir, there has to be effective tax dispute resolution mechanism to minimize the risk of uncertainty and unintended double taxation. Sir, OECD recommends proper implementation of treaties in good faith. Along with that, sir, mutual agreement procedure available in timely manner and accessible to normal taxpayers also. At last, sir, we have MLI. Sir, what it says, sir, whenever we want to amend a treaty, for example, if India wants to reduce their taxes, for example, from now onwards, like it has 20% tax rate. Now, if India wants to reduce the interest tax rate to 10%, from 20 it want to reduce to 10. Sir, shall India go to every treaty, open article number this, and sir, amend the tax rate for every treaty? Then request every treaty to amend, request every other company, every other entity to amend in their tax laws. So it would be very tedious task. No? Just incorporating small thing in 140 treaties and letting everybody accept that, so that would be very tedious task. No? So for that matter, there came an MLI. a multilateral instruments. Sir, multinationals in 2017, I guess it was 2016, many countries came together, signed this MLI, that whenever there are certain small changes that people want to do in this treaty, they are just going to write in the treaty. This treaty has to be ratified in their respective country. They have to be notified in their respective country. This treaty, sir, will be applicable. So this treaty has to be ratified in the other country also, has to be notified in the other country also. As soon as it is ratified and notified, so there is no other discussion, no other arguments that this treaty will be applying to both the countries. So this MLI is nothing but a sheet of paper. So for example, if you have answer sheet, if your answer sheet is 32 pages, you take 4 pages extra now. You take 4 pages extra. Those extra 4 pages are a part of your answer sheet only. That completes your answer sheet. So if you want to change in the first answer, that is written in your first page, you just cut the first page and write it in the answer sheet now. So that extra sheet, that supplementary sheet is nothing but MLI. And sir, whatever you change, whatever answer you want to change in this 32 pages, sir, you can do that in supplementary sheet, that is that MLI. Sir, that is what MLI implies. So MLI is a flexible tool which will modify the tax treaties according to jurisdiction policies with respect to implementation of the tax treaties. So remember, MLI should be given with compatibility clauses. Say for example, sir, how this will be transferred to DWA, sir, for example, we simply say that interest is taxable from 20 to 10. Which all interest? So whether it will apply to brokerage, whether it will apply to transfer cost, whether it will apply to any other expenditure, sir, whether just interest, whether sir profits, or how, on what it will apply, sir, will it have any impact on any other thing? Sir, we have to discuss, sir, how it will be transferred from MLI to DWA. That must be discussed in that MLI also. Also, reservation clause, sir. For example, if any country does not want to accept that MLI, sir, this is the reduction in tax rate. But sir, if India wants to increase the tax rates, they should have reservation clause now. There should have reservation clause now, that if some country is not willing to accept that MLI, sir, they should be reserved. And sir, at last, yes, sir, covered tax arrangement. Sir, what happens is whenever there is change in treaty, sir, people try to make misuse of the treaty. They use their treaties, they use this MLIs to do tax dodgings. Therefore, to prevent the tax dodging, sir, whenever money flow takes place, when there is change in treaty, that has to be carefully examined to avoid the tax dodging. It is called covered tax arrangements. Sir, all the things you can skip out. Sir, what are the important clauses that are to be referred? Sir, clause number 1. Sir, you have to refer adverse effects of BEPS. Clause number 1, OECD recommendations are important. Clause number 2, sir, reasons for hybrid mismatch arrangement are relevant. Clause number 3, article number 3, you can skip. Action plan number 3. Action number 494B, you have to remember. Action plan number 5, sir, 115 BBF, you have to remember. Action plan number 6, you can skip out. Action plan number 8 to 9, you can skip out. 11, you must remember. 12, you can skip out. 13 must be remembered. 14, you can skip out. Sir, MLI, whatever the basics I told you, that you need to remember, otherwise you can skip out. That completes your BEPS topic. Sir, I just want 5 minutes of your precious times now. 5 minutes of your precious time. Another topic that I am 100% sure that you have not studied anywhere, sir, latest development in international taxation. I am not going to teach the entire topic. I just want to teach you 2 more topics. Sir, OECD made 15 action plans just to avoid the BEPS. Just to avoid the base erosion profit shifting, OECD came together and came up with 15 action plans. But still, these 15 action plans were not sufficient. Therefore, again, OECD met in 2020 and came up with 2 more action plans. So these 2 more action plans are called inclusive framework. 2 pillars of inclusive framework. So these are called 2 pillars of inclusive framework. Sir, what are those 2 action plans? First of all is, sir, reallocation of taxing rights, I should say. And second one is globe rules. 2 action plans came on account of BEPS action plan, OECD 2.0, or I should say BEPS 2.0 gives 2 pillars to inclusive framework. That means I should say 2 more action plans. Sir, what are those 2 action plans? Sir, try to repeat after me. Sir, reallocation of taxing rights. If you want to write it down, sir, just write it down. Write down the example, sir, you will understand. Sir, reallocation of taxing rights and globe rules. Sir, write it down. Two pillars of inclusive framework, so reallocation of taxing rights and globe rules. There are two action plans that came. Sir, what is reallocation taxing rights? Sir, for that matter, we need to understand the concept of residual profit. Sir, what happens is if any of the multinational entity has a revenue of 20 billion euros or more, if any of the multinational entity has the profit of 20 billion euros or more, and sir, it has profit exceeding 10%, then whatever the residual profit is, that should be distributed to market distribution. Up 25% of the profit shall be distributed to market distribution, market jurisdiction. Sir, what it implies, I'm telling. Sir, understand this. To whom reallocation of taxing rates apply? Any entity which has group revenue of 20 billion or more and profit percentage of 10% or more. Any entity which has revenue of 20 billion or more, 20 billion euros or more, and profit percentage of 10% more. Sir, reallocation of taxing rate would apply to such entities. Sir, what to be done? Sir, for example, Apple. We have Apple. It has operations in 120 countries. Example. So it has turnover of $50 billion and it has profit of rupees 10 billion. What I said, sir, reallocation of taxing rights would apply? Sir, it would apply first of all, it would apply on the entities who have 20 crore or more billion, 20 crore billion or more euros in turnover, plus profit of 10% or more. Sir, in this case, sir, Apple is having 50 billion euros turnover. Sir, 10% profit would imply 5 crore. 5 crore. Provision says whatever the profit this Apple is earning over and above 5%. Whatever the profit this Apple is earning over and above 5%. So that is, sir, 5 billion, 5 billion, 50 billion. So 10% would be 5 billion. Sir, whatever the profit this Apple is earning over 5 billion, so that means it is earning 10 billion. Over and above 5 billion, it is earning 5 billion. So whatever the rest, this will be called as residual profit. Over and above 10% profit, whenever you are earning, sir, it is called residual profit. Of this residual profit, 25% would go to market jurisdiction. That means 1.25 billion would be given to market jurisdiction, and sir, they are going to tax. In whatever 120 countries this Apple operates, so this 1.25 billion profit would be allocated to those market jurisdiction, and they are going to tax this profit. Did you understand this point? Sir, what is called reallocation of taxing rights? If any entity has turnover of 20 billion euros or more and profit 10% more, then whatever profit it is making exceeding 10% of that residual profit, 25% shall be taken and shall be distributed to market jurisdiction. And sir, that are going to be taxed by such entities in which it has operations. Sir, we got this point. Second, it is called, sir, globe rules. Second pillar is called globe rules. Sir, for example, again, Apple. Sir, globe rules are applicable for the entities. Listen. Globe rules are applicable to the entities who have turnover exceeding 750 million euros. 750 million euros. Sir, globe rules are applicable. See, ultimately, OECD is the group of people who are developed nations. Except America, whoever the developed nations are European nations. Therefore, European nations talk about euros. Therefore, every figure given here is in euros. Sir, globe rules, that is second pillar of inclusive framework, is applicable to the entities who have turnover exceeding 750 million euros. 750 million euros. Sir, for example, Apple has turnover from USA. Apple has turnover from USA. Sir, Apple might be having whatever turnover. Sir, whatever profit turns out in USA is 500 million. Whatever profit turns out to be in USA is 500 million. Taxes in USA is 50 million. In India, revenue is 100 million. Profit is, taxes are 20 million. In China, profit is 200 million. And sir, taxes are 30 million. Out of this total top profit, sir, out of this 800 million profit, sir, 100 million is being taxed. Therefore, effective tax rate is just 12.5%. Effective tax rate is just 12.5%. Provision says any company who has exceeding 750 million, any company which has exceeding 750 million worth rupees of turnover shall pay minimum 15% taxes globally. In this case, since Apple is just paying 12.5%. This 2.5% taxes should be paid to the entities in which, to the in the countries in which service Apple is operating. So how allocation will be made is a different subject matter that is not relevant. So this has to be distributed in the market jurisdiction. So what I said, just listen to this point carefully. I talked about two basic pillars of inclusive frameworks. The first pillar is reallocation of taxing rights. Any entity having 20 billion euros or more turnover and profit 10% or more, whatever profit it is earning over 10% is called residual profit. Of this residual profit, 25% would go to market countries. Okay, sir, got it. If any of the countries is if any of the entities having, sir, 750 million more euros in 750 million more turnover, then effectively it should pay 15% taxes or 15% of the global taxes. In some countries it would be paying more, in some countries it would be paying less. Effectively it should pay minimum say 15%. If it is not paying 50%, then it should be charged to taxes at the rate of 15%. At least it should pay remaining residual taxes to the other countries of the market jurisdiction. That is what globe rule implies. That is what latest development in international taxation implies. And that is what your entire international taxation implies. Thank you so much. And that completes our international taxation portion. Holistically, it is 7 hours 51 minutes I took to completely explain and do the question answers, relevant question answers along with it. Along with that, sir, 55 minutes, 70 minutes, 60 minutes we took break. So effectively 7 hour session it was, and we entirely did complete international taxation to the fullest depth possible. See, it is not just a marathon, remember. You can refer this marathon at 2x speed. I can with surety say that you can refer at least this with 1.5x speeds, and you will be able to understand everything clearly. This video is all yours. This content is all yours. Do take full benefit of it. Thank you so much for continuing from starting till the end. Thank you so much for having trust in me. Thank you so much for making me believe that I can do this. I can continuously speak for 6 hours, 7 hours continuously in a row, that too in English. So it is all because of you that I have been able to do it, and I have been able to complete this entire session. Thank you so much for being a part of this session. Sir, we are not done yet. Tomorrow we will be having another session on which we will be covering 10 important topics. Understand 10 important topics right away, starting from appeals, revisions. Then we have GAR, we have DRC, we have miscellaneous, we have tax audit, we have black money law, we have clubbing, set off, deductions, and ICDs. These 10 topics I will be covering in 5 hours. 5 hours is the deadline. I have to complete them in 5 hours. I will try to complete tomorrow on. So, guys, thank you so much for your support. It's not over unless we see positive results. We see at least 50 plus marks in your exam. It is not over until then. So, thank you so much for being a part of this session. I really enjoyed this session. And believe me, with this session, now you will be able to score good marks in international taxation. With this, you will be able to score. For sure, you will be able to score. So, do take full advantage of it. Do drop down do drop down your message after as the video ends. How did you take this video? How did you like the video? Do like the video, do share it with your friends, and see you guys in the next one. Thank you so much for coming. Bye bye, take care and enjoy studying. Signing off. See you, Rahul Satija. Many thanks for watching.